All right, good morning, everybody. 9 o'clock here in New York on this Thursday, January the 21st. President Joe Biden's first full day in the White House. Welcome to Yahoo Finance Live. Miles Upton here, joined as always by Julie Hyman and Brian Sozzi. Let's take a look at futures this morning, coming off that record close across the board. A little change here. The NASDAQ is leading the way once again, though, up about 0.2%. But again, not much doing among the majors this after we saw the Dow, the S&P, and the NASDAQ post what many were calling, and I think the data go back to 1928, the best day for the S&P on Inauguration Day in the index's history. Now, this comes as we got more data this morning on the state of the U.S. economy. Jobless claims rising to 900,000 last week. The spread of COVID throughout the country continuing to hold back the U.S. labor market. We're going to get into that in just a little bit. But we begin today in Washington, D.C., where President Joe Biden begins his first full day in the White House. The president getting right to work, signing multiple executive orders yesterday, including actions on immigration, climate change, and, of course, the pandemic response. Yahoo Finance's Jessica Smith and Anjali Khemlani are standing by this morning with full coverage. And Jess, let's begin by just talking through the expectations for Biden's schedule on this first full day as president.
Yeah, Miles, on his first full day, he is largely going to be focused on COVID-19. The first time we might see him this morning is as he watches a virtual prayer service with the vice president. After that, they'll get their daily briefings. And then later this afternoon, Biden will speak about the COVID-19 response, and he'll sign several executive orders, all aimed at stopping the pandemic. He is really trying to send the message that his top priority in his first couple of days in office are all about the pandemic. We saw him in the Oval Office yesterday wearing a mask, signing those executive orders. They rejoined the World Health Organization. He mandated masks on federal property and interstate travel. He also extended the freeze on student loan payments and eviction. So all of those orders aimed at either easing the economic pain or fighting the actual virus. And today he is going to sign 10 more executive orders. Anjali has more on those.
Thanks, Jess. Yeah, so as you mentioned, he really did set the tone yesterday at the inauguration with his speech, saying specifically, quote, "We are entering what may be the toughest and deadliest period of the virus." And he signed that mask mandate, and we know that at least 10 more here today with a focus on testing expansion, invoking the Defense Production Act, reopening schools and businesses, and guidance on how to do so. Of course, very welcome news for a large part of the population. Also looking at health equity and establishing a committee on that, as well as reimbursement from FEMA for vaccine and testing supplies to states. And that's something we know has been the concern, is specifically on the vaccine distribution side, with what states have had to do sort of on their own this whole time. It was with CNN reporting that based on what White House sources have been able to see, there had been no real distribution plan for the vaccines. So they are basically starting from scratch. But of course, some of these actions will also need help from Biden's friends in Congress.
Biden said exactly that yesterday as he was signing those executive orders. He said executive orders are important, but you have to have legislation. Of course, the $1.9 trillion stimulus package is at the top of the list, and Republicans are skeptical about that, to say the very least. In the White House press briefing yesterday, the press secretary, Jen Psaki, told reporters that the White House wants to get bipartisan support on this, but the White House is not going to take other options off the table. Of course, we've heard from Senator Bernie Sanders, who says they could use reconciliation to get this done if Republicans don't get on board. That would just require a simple majority. And when Psaki was asked if there is any wiggle room on that price tag, here's what she had to say.
It was designed with the components that were necessary to give people the relief they needed. So what's challenging is, what are you going to cut? Are you going to cut funding for vaccinations? Are you going to cut funding for unemployment insurance? Are you going to cut funding for reopening schools?
Miles, you may remember that bipartisan group of senators who worked to come up with that $900 billion proposal late last year that pushed leadership to hammer out a deal. That group is planning on meeting with the administration in the coming days, possibly even this weekend. So we'll see if they're able to find some common ground.
Certainly a lot going on down there in Washington. Jess and Anjali, thank you both for that breakdown. Let's just talk a bit here amongst ourselves, guys, about the incoming administration, how things are changing, because I don't know, it kind of feels a little different, doesn't it? Julie, I'll start with you on that. I mean, yes, the president has been banned from Twitter for 2 weeks, but we still kind of have that reflex, that muscle of like, oh, let's meet in the morning and see what happens on the show. But Trump will probably tweet something crazy and we'll just go with that. And I mean, that's just not going to happen anymore. And it's kind of very standard, straightforward. I don't know. You could kind of call it like the corporate White House is back, if that makes sense.
I mean, the White House is back. The traditional White House is back. It doesn't have to be corporate. It's just how the way that things were always done until 4 years ago. So what I'm going to find really interesting here, yes, leaving aside for just a moment the aid package, which I know we're going to dig more into, to talk about the coronavirus attack plan here, so to speak, and the idea that really the Biden administration is coming in here fresh. One of the I think conundrums in thinking about the Trump administration approach to coronavirus is, yes, it looked completely incompetent on a number of different fronts, but there was no counterfactual. Yes, you had it in different areas of the world, but you don't know how bad would it have been in the United States under a different administration. Well, obviously, we're at a different point in the virus at this stage, but here's the counterfactual. Here's a different administration coming in with effectively a fresh start. What is that going to look like? Are we going to see a more competent rollout of vaccines? Are we going to see really the needle being moved in terms of case growth with both seasonal effects, yes, on the Biden administration side, but also mask mandate, modeling different, prioritizing truth and science on the part of this administration. So I think it's going to be really fascinating to watch all of that unfold and to see if the administration can sort of meet those lofty expectations, perhaps, around the coronavirus.
Miles, I really liked your corporate analogy because that's what I was thinking about too. I would characterize the current situation as this. Today is the first time, let's say, a company finally beats on earnings after reporting losses for the past 8 quarters, and Wall Street breathes a sigh of relief. I think that's what you're just feeling today out in the world, which is certainly very, very good. But firstly, this will translate in some form or another to the stock market. We saw stocks really rip higher yesterday as Inauguration Day went along, and how could it materialize? We're about getting ready through earnings season. It's really about to kick into high gear next week, and you could see executives hop onto these earnings calls, maybe not say much about the transition of power, but offer up little comments and bake in a little more optimism than they would have otherwise in their outlooks, because they have a little more predictability in this business.
Yeah, I think it's just going to be real interesting to see kind of what a modern presidency in which the president is not particularly modern, if we can follow that loop, kind of looks like, right? I mean, I think we talked about this yesterday with David Litt. Would this be Obama 2.0? I don't know if that's entirely fair or accurate, but certainly it's not going to be the Trump administration. That we know, and as Julie outlined there, this is, the White House is a very kind of, it has a lot of gravitas when you're in the West Wing, obviously when you're sitting in the Oval Office. And I think some of that kind of went away over the last couple of years. And certainly that is something that we would all expect to come back in the years ahead. But let's dig in a bit more on Biden's economic agenda as we get things underway in the Biden administration. Joining us for that conversation is Greg Dacko. He's the chief U.S. economist over at Oxford Economics. So, Greg, let's just start with the question I think all investors are asking themselves this morning, which is what package will eventually get through in the early part of the Biden administration. They outlined the $1.9 trillion. I don't think the street expects all of it to get through, but what kind of parts do you think will make it through, and how does that bill likely get passed?
Well, you're right. I think we should not expect that the entire bill gets through, not least because the Democrats don't have the 60-vote majority that would be needed to pass everything without the need for any Republican support. But we know that they can act if the Republicans don't want to go along with the plan via reconciliation, which is a process that only requires essentially 50 votes in the Senate, the 50 votes that they have. We think that in the end, via this reconciliation process, we'll probably have about $1.2 trillion of additional stimulus that gets pumped into the economy. And importantly, the nature of that stimulus is going to be geared towards fiscal transfers, towards the unemployed, towards the lower income families. And that should juice up the economy and juice up the recovery in the spring as the weather improves and as the health situation improves. So a positive cocktail for the summer of 2021.
Greg, you're getting the sense early on that President Biden really signing off, really coming out here firing in terms of executive orders here, bringing a lot of things back that former President Trump took away. Do you think, as an economist, do you think this return of bigger government weighs on the recovery from the pandemic?
Not really. I think Biden does have a very ambitious agenda. He's got essentially three objectives. The first one is the health situation, addressing the COVID crisis in a consistent and coordinated manner. The second one is via executive orders. We've seen a number of executive orders being announced and being signed, including on the immigration reform front. And then finally, there is that fiscal agenda, that ambitious fiscal agenda that aims to essentially ensure that we reestablish a very strong economy in the wake of the COVID crisis. Yes, there will be more regulation on the energy front, perhaps on the financial front, but I don't think that's going to be an excessive burden at this point in the recovery. I think the administration is going to want to be very careful about how much additional burden it puts on the economy as we recover from the COVID crisis.
Hey, Greg, going back to the aid package for just a moment, what do you think the timeline looks like at this point in actually getting it done? I mean, out of the gate yesterday, I think it was Senator Mitt Romney that there was a comment from him that he was not going to support the bill as it stood. So that does suggest that there is going to be some back and forth here.
Yeah, I mean, one option is potentially to get bipartisan support for the checks. We know that there was some bipartisan support for the $2,000 checks when there was this whole debate at the end of the year whether they should be $600 checks or $2,000 checks. But I think if there isn't evidence that there will be support for the additional $1,400 to get to those $2,000 checks, then the Democrats will very rapidly pivot to reconciliation and try to get as much in as possible as they can via this process that only requires the 50 votes that they have. They're really keen on getting stimulus out the door very quickly, and using that reconciliation process would then allow them to turn to the second tranche of their agenda, because we know that Biden has talked about the Build Back Better plan, which is aimed more towards infrastructure spending, climate change, R&D, and that's going to be something that they also want to address, hopefully very soon.
And then, Greg, just as you look out to the rest of this year and even into next year, are the balance of risks for the economy still tilted, or I guess not still? Are they tilted to the upside at this point? Because a data series I've tracked is your guys' recovery tracker, economic recovery tracker, and it's started to fall, but it's mostly fallen because the health situation has deteriorated in the last couple of months. A lot of those other measures, production, employment, certainly the stock market, financial conditions, they've held up okay. Does an improving health situation kind of outline, in a better than expected situation, outline a better than expected recovery that could last not just through the second half of this year maybe, but next year and beyond?
Yeah, I mean, I think we have to be conscious of the fact that the reality is that today the economy remains quite weak. We still have a very large number of people filing for unemployment benefits. We saw over 1.4 million in the past week. We still have a labor market that has half of the job losses that it lost during the COVID crisis not yet recouped. We still have small businesses that are struggling. So the situation today is one of a weak economy with very slow momentum. As you highlighted, our recovery tracker showed that weakening momentum as the health situation deteriorated and as fiscal aid started to lapse. But as we look into the spring and the summer, and we get this cocktail of additional fiscal support, elevated savings, warmer weather, and increased vaccinations, those should all combine to lift the economy up, and we could probably see growth around 5, maybe 5.5% in 2021, which is higher than we previously expected, because that will be partially supported with additional fiscal support.
All right, Gregory Dacko, Chief U.S. Economist over at Oxford Economics. Greg, always great to get your thoughts. Thanks so much for joining the show this morning.
Always a pleasure.
All right, again, watching futures, little changed here on this Thursday morning. S&P and NASDAQ set for higher opens. Dow off 1 point, not even a full 1/10 of 1%, not even a full 100th of 1% at this point. We're back with more here on Yahoo Finance Live in just a couple of minutes.
Well, as President Biden kicks off his days in office, his first full day in office, of course, as we've been talking about, he's been signing all these executive orders. But the team that he is assembling, his sort of financial and economic oversight team, is still taking shape. And Michael Barr, according to the Wall Street Journal, is going to be the head of the Office of the Comptroller of the Currency. And our Brian Cheung has been taking a look at this sort of staffing and what it's going to look like in the Biden administration.
Well, yeah, as you mentioned, Julie, the financial regulatory team is really starting to come together under the Biden administration. Very influential when it comes to banking policy. Of course, not many people might be familiar with what the Office of the Comptroller of the Currency is. It's a sub-agency under the Treasury that works together with the Federal Reserve and the Federal Deposit Insurance Corporation as the main banking regulators here in the United States. And as you mentioned, the Wall Street Journal reporting that Michael Barr will be the Biden pick to head that administration. A little bit more about Michael Barr himself. He's the Dean of Public Policy at the University of Michigan's Ford School. He did serve in the Obama administration. He was at the Treasury there. He was an assistant secretary for financial institutions, very knowledgeable in that bank regulatory space, so much so that he actually helped create the Dodd-Frank Act in 2010. Again, that post-crisis framework that was really used to put more stringent guardrails on the banking industry. And this rounds out the appointments that we've already heard about so far. We've heard about Rohit Chopra at the Consumer Financial Protection Bureau, in addition to Gary Gensler, obviously, at the Securities and Exchange Commission. But there's going to be a number of other financial regulatory appointments that they can still announce in the future, which we don't know yet. One example would be at the Federal Reserve Board. Keep in mind that there are 7 governors at the Federal Reserve. Currently, 6 of them were filled, a lot of them by the Trump administration, but there's still one vacancy because the Biden administration's inauguration yesterday officially closed the door on noted gold advocate Judy Shelton, again, a Trump pick for that spot. Now that door has closed, which means that the Biden administration could appoint one more person at the Federal Reserve, which in addition to monetary policy has a lot of regulatory say as well. And Randy Quarles, who's the Trump pick, he can stay on the Fed board through 2032, but his reign as the vice chair of supervision specifically ends in October of this year. So it could be interesting because the Biden administration could replace him at that spot as well. Something worth watching as we get into the middle of this year.
And then, Brian, just thinking broadly about the regulatory framework that the financial authorities are going to be looking at. Certainly, cryptos is a main question here. What are they going to do, if anything, as it relates to that? But also just broadly about the future of banking regulation, particularly since we had a crisis in the spring. All the rules that were put in place, all the Basel rules and the liquidity rules, basically worked, right? I mean, there was no bank that said, I don't have any money, because they already had the money sitting there. Does that make regulators say we should tighten these rules, we should loosen these rules, or is it proof that the current framework is kind of the one they want to roll with?
Well, whenever you say Basel, that's like my energy drink, which Brian Sozzi, he actually drinks an energy drink. But when you say Basel, that's what gets me all amped up. But yeah, as you mentioned, I mean, this is part of an international regulatory framework that was really put in place after the last financial crisis. And we know, for example, that a lot of the banks, as you mentioned, had no problem raising the amount of enormous capital that the regulators across the world had asked them to do after the last financial crisis. So the question, of course, is now that we have a Republican administration that was out the door, which had largely been more sympathetic to maybe slight rollbacks in those provisions, will this Democratic administration be more aggressive about maybe wanting to further increase capital levels? That might be the case if we saw a Lael Brainerd-led Fed, but of course, Chairman Powell is still there, and he seems to be okay with where capital levels are right now. And I think when you talk to many analysts, they'd say, don't expect anything too aggressive when it comes to more stringent rules on the banking industry. Keep in mind that even if there were to be legislative change, there's still a 50-50 divide in the Senate. You still need some moderate Republicans to be on board with any sort of legislation that you have, which could really kind of guide policy somewhere more towards the center, as might be the case for other broad policy initiatives under this administration. Again, worth watching, but I would say for the most part, not many people are expecting that much more stringent regulation, at least in the banking space over the next 4 years.
You know, Brian, there's much more to me than energy drinks. I'm just saying. I know I haven't seen you physically in a year, but, I got a lot of other stuff going on. But, I appreciate the shout out.
Hey, man, it's got to be caffeinated somehow. That's what gets me amped.
Got it. Yep.
All right. Thanks so much, Brian's, for that. We'll check back in with you later. And coming up in just a few, we've got the opening bell for you this morning. Stay with us.
All right, welcome back to Yahoo Finance Live. Miles Ludman here in New York on this Thursday morning, January the 21st. Again, we're looking at futures that are pointing to a pretty unenthusiastic open for the markets. Not a lot going on. We are seeing all three majors higher at this point. NASDAQ futures leading the way, but this comes, of course, on the heels of yesterday's, energetic response, we should say, to Joe Biden's first half day in office. We saw all three majors close at a record high when the closing bell rang on Wednesday. Let's talk a bit more about the markets as they've certainly played out in the last couple of months, what to expect over the rest of this year. Phil Tays is the CEO of Tays Asset Management, and he joins us now to discuss. So, Phil, let's just start with how you're seeing just 2021. I mean, we've had 2.5 weeks of trading here. The action has been enthusiastic, to say the least. Are you surprised by how much that momentum that really kicked off back in November has continued through the early part of this year? Does it have you concerned at all?
Well, so we've been concerned for a long time. We've seen a divergence now between the stock market and the economy. The economy 12 months ago was in much better shape than it is now. The stock market's 15% higher. And so the concern is that if momentum wanes and we see even if the economy continues to muddle ahead and grow, that there could be another divergence. And at that point, stocks could potentially move lower ahead. But at the moment, momentum reigns. And when you get into these situations, you can look back at other markets like 1999, same thing in 2007, where despite valuations, you can see stocks rally for another 12 months or more. And so, there are a lot of challenges ahead for the economy, but when you get into these situations where momentum is driving everything, it can last a while. And so that's sort of the story of the day.
And so even if it lasts for another 12 months, do you feel cautious enough about the potential that it won't last, or that there will be maybe areas of the market that don't perform as well, that you are taking out insurance, so to speak? Or what kind of hedges are you putting in place in case things don't proceed?
Yeah, so that's what's so curious. We have an affiliated organization called the Behavioral Investing Institute. And you get into situations like this where there's so much noise, some of it positive, some of it negative. So it's really hard to gauge what the outcome's going to be. But one of the most predictive things that you can look at is valuations. And valuations, where they are right now, which is around 23, 24 times forward earnings on the S&P 500, puts them in the very tippy-top range of historical measures. So, that's the most predictive way of looking at the markets. And based on current valuations, markets would have basically zero gains for the next 5 years if you're looking at historical numbers. So, behaviorally, when you're in these environments, one of the things that we tell investors to do is to, we reframe it for investors. And when you think about crash, you hear the word crash, you normally think about being delayed and getting to work. But when you're in an overvalued territory, the way crash plays out is that you're in the crash, right? We think that markets are stretched. We think that ultimately, even though we're in a situation where we've got positive momentum right now, we could see markets move lower. So we would strongly recommend that people put in place contingency plans, buy into, with a portion of your portfolio, some hedged equity funds, some strategies that have built-in mechanisms for both trying to ride the markets higher as momentum plays out, but then having some kind of a plan in place to attempt to de-risk if markets turn lower.
Phil, we were joking around in our morning meeting. We saw the latest Powerball winner in Maryland. They won, reported $730 million. Like, wow, what would we do if we had that type of money? Where would we invest? But it ultimately raises another question. You look at the bank earnings the past week; they've seen massive inflows into their wealth management businesses. We're talking double-digit increases. In large part, everybody's chasing market performance. If you do have large sums of money, you've been sitting on a lot of gains. Where do you invest now for the next decade? What are there other alternatives to the stock market? Because I would argue that TINA feeling has been driving the stock market higher. Where else could you put your head?
Well, so there's another question about framing, and I think people try to insist on answering the question: are you fully invested, or do you just write it out, or do you leave the market and wait until you have more reasonable valuations? And we would create an alternative path. We have something we call a behavioral portfolio, and what that portfolio is designed to do is recognize that markets are generally efficient. So you want to be fully invested in a relatively somewhat conventional way. But if you can take maybe 50% of your equities and put it into something that can potentially dislocate or uncorrelate from negative market activity, then you have this built-in mechanism in place to address declining markets. It would be exceedingly difficult to not be invested right now. And if you make the decision to leave the markets, you could be punished for 6 months or 12 months. As you say, you've got all the money on the sidelines. So money could be pouring into the stock market for the next 6 months. But unfortunately, if earnings aren't justified by the price, or prices aren't justified by the earnings companies are receiving, ultimately it fails. So that's the difficult behavioral riddle, is that you have to understand that earnings have to justify the pricing.
All right, there we see the opening bell live on the floor of the New York Stock Exchange. My Teresa ringing the bell this morning. Good old-fashioned interesting PE story there if you want to look it up. Company now going public, $2 billion valuation. There were concerns, I think, during their takeover a couple years ago that it was undervalued or overvalued maybe at $200 million. So quite a saga there. Phil, let's talk finally about the area of the market that everyone seems to want to talk about these days, which is crypto. But maybe let's do it this way. We see the energy unleashed in retail with SPACs, with electric vehicles. Everyone wants to be speculating these days. Everybody's a genius because the market goes up all the time. How do you deal with an environment like that where everybody's a hero because it's just been, the way it's been for the last few months? Certainly the clients that you're talking to may have a little FOMO, even if they're sitting pretty with 10, 15% gains on a nice sizable nest egg.
One of my colleagues here at Taves was talking about how he invested in 10,000 in Tesla and it's worth 200,000 now. So a 20x number. You've got so many people out there that are like that. There's a false assumption being made alongside valuations like that. And that is that you can invest in some of these high-flying companies or Bitcoin, and there's going to be a way to know when markets start to roll over and you can get out. But one of the things we talk about a lot is the fact that, you look at last year, Tesla is a good example. It fell 50% in the first quarter and 34% in September. If that happens again in 2021, you're not going to know if it's the beginning of the end or just a blip in the markets. So it's almost impossible to know when it's just a blip or a considerable downturn in the market. And as a result, if you're an investor in some of these high-flying names that don't really have realistic valuations, you're vulnerable to 25, 50, 75% or more losses. So it's a gamble. I mean, you have to recognize that if you're going to do that, come to it with an approach to find a way to de-risk if things turn lower, and you're just gambling. And that's really all it is.
All right. Phil Tays, CEO, Tays Asset Management. Phil, great to talk with you this morning. Interesting stuff. And I know we'll be in touch.
Thanks so much.
All right. Let's turn our attention now to how markets are opening on this Thursday morning. Yahoo Finance's Jared Blickery joins us now with the latest look at how things are going. Jared, we see stocks are higher, but of course there is one part of the market under a little bit of pressure this morning.
Could that be Bitcoin? We'll get to that in a minute, but let's take a look at the Wi-Fi Interactive. We have the Dow and the NASDAQ opening up at record highs. You can see the Russell 2000 just barely treading water here, but everything in the green by just a little bit in the early going. And I think it's instructive that the mega caps once again are the leaders today. And you can see Apple, Amazon, and Alphabet each up more than 1%. Even Facebook, which has been the laggard recently, up about 0.5%. And that comes over the last 2 days. Some nice performance if we add that up. You can see Amazon's up over 6% along with Alphabet there. And if you look at the sector leadership today, guess what? The top 3 sectors, all FANG sectors, all at record highs. And so we might be seeing this rotation back into some of these big cap names that were kind of neglected over the last few months. So let's take a look now at the software sector, because this is something that's been catching my eye. Yesterday, we had some nice breaks to the upside. Looks like not a lot going on right now, but this is a sector that's also been trading largely sideways over the last few months. So I will want to see if that picks up. And finally, rounding out the tech sector, we have some record highs here. ASML up 3%, Taiwan Semi up 1.7%. So even though it's mixed, we are getting some incremental adds to tech gains here, guys.
Yeah, and Jared, Intel's set to report its numbers after the close of trading. So that should be interesting also to see if that momentum continues. Also got to talk about China tech. And there have been some really interesting developments regarding China as the Biden administration gets underway. Some of it has to do with the outgoing administration, right? Because just before they left, the Trump administration said, indeed, that the Chinese government was perpetuating genocide against its Uyghur Muslim minority. China turned around and then sanctioned 28 U.S. officials, including outgoing Secretary of State Pompeo. And then you also have those companies that are being delisted from the NYSE trying to appeal that. So a lot of movement on China.
Yeah, there is. But guess what? There's a new administration, and you got to think that some of the frostiness in this relationship is going to thaw at least a little bit. We've seen China really just break to the upside here. You can see even Alibaba happens to be down about 2% today. But a lot of these other names, let's just check out the trailing month here. And they've been flying high. Pinduoduo, which I like to talk about, just joined the NASDAQ 100 about a month ago. That's up 15%. Baidu, another high flyer, that's up 34%. Or excuse me, 34% over the last month. And if you take a look at the what I call the canaries, the leaders, this is really instructive as to the breadth of the rally that's going on. Even if we are a little bit overextended right now and have a pullback, this provides some nice fuel for the coming months. Now, here's the KWEB. This is the Crane Shares Trust China Internet ETF. This has really broken to the upside. Chinese tech stocks are simply on fire here. And I should also note that EEM, this is an ETF that I've been tracking for some time, only within the last day or two hit a record high. That's the first one since 2007. So all of this put together, I think, is instructive that we have broad-based rallies here, but we are subject to potential headwinds. And I think the biggest one is from the US dollar, but so far not really seeing much signs of life in the dollar recently, guys.
Yeah, Jared, emerging markets have just been such a conviction call from so many folks for so many years. DataTrack out with an investor survey they published yesterday afternoon, I believe it was, and one of the top conviction trades over the next decade, it was the split between large cap U.S. tech stocks and EEM. And to see both of those higher today, I guess that means everybody gets to go home a winner.
Hey,
all right, Jared
stop
Blickery.
Watch. You know the saying.
That's right. Yeah, I think I wrote a story 2015. Jeremy Grantham's like, I put all of my grandchildren's retirement money in EM or something like that. And it's up a little bit at least. And as you know, the technicals on a 13-year consolidation breakout to the upside, that is certainly something that you'd like to see in the charts. All right, Jared Blickery, we will talk with you during tomorrow's trading session. A lot more coming up here on Yahoo Finance Live on this Thursday morning. Stocks trading at a record high. We're back with more in just 2 minutes.
The European Central Bank met today and held rates steady. Like the Federal Reserve here in the United States, there's a lot of accommodation on the part of the ECB. Christine Lagarde also gave a press conference. Our Tom Belger's over in the UK, and he's got some details for us on the ECB's plan, which, as I said, seems to be holding steady.
Hi, Julie. Yeah, all the expectations ahead of this meeting were for no fireworks in seemingly every analyst's phrase of the day. And that was what we got. No change to interest rates, no change to asset purchasing, not even any sparklers or let alone Catherine wheels in the speech. And you could say what's going on in Europe right now really boosted the case for some kind of action slightly sooner. Christine Lagarde, the president of the ECB, talked at her press conference just now about how risks were tilted to the downside, given the renewed surge in infections, the services sector being really hit hard by renewed restrictions, and the fact the vaccine rollout in Europe will take time. There's been some problems getting vaccines distributed. She did say, interestingly, more urgency was needed in getting EU stimulus dispersed. That's been painfully slow, as one analyst said. And crucially, though, she said that didn't really change the bank's December macroeconomic projections. So the market reaction really has been pretty muted. Most European stocks really followed Asian stocks, and US stocks yesterday higher off the back of Biden's inauguration. And there was a slight rise, though, it's worth saying, in the euro. That was in reaction to this speech. The thing that jumped out most from the ECB's statement, one new line, was saying that they are prepared, and I'll quote this, not only to recalibrate their asset purchases to counter the pandemic shock if required, so I'm slightly paraphrasing there, but equally, she said, and equally was the key word, she said afterwards, the envelope need not be used in full. That's the money that they've put aside for these purchases. Analysts say that second point isn't one that the bank's made before, and it's a slightly hawkish signal. But however you read it, it's clearly the bank giving itself wiggle room, and as Lagarde said, nothing off the table. So maybe some fireworks to come.
We'll see, but it sounds like we shouldn't be holding our breath just yet. Tom Belger in the UK, thank you very much. Appreciate it. And when we come back, we will be talking much more about what to expect from the Biden administration, with particular attention to education. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Upton here in New York. Well, on Yahoo Finance, of course, we tend to focus on what's happening in the economy, publicly traded securities, of course, a little Bitcoin in there. But I think no sector of the economy has faced quite as much disruption as the education sector. Students remain learning from home, or maybe a hybrid model where students are in the classroom half the day, sometimes they're at home. In the higher education space, this has played out all kinds of different ways. Campuses doing quasi-bubbles, some campuses closed to students indefinitely. So let's talk more about everything happening in education and how they are handling the pandemic. Joining us now for that conversation is Simon Allen. He is the CEO at McGraw-Hill. Simon, great to speak with you once again. So let's just begin by kind of going through an overview of how you see the education space today in dealing with the pandemic. As we were just talking in the break, we last spoke in August. There was a lot of uncertainty around how things would play out. It's 5 months later. I'm not sure there's a ton more clarity. How have the campuses you're working with, how have they been faring through this period?
Yeah, thank you, Miles. It's nice to see you again. And you're right. It's been a tumultuous year for education across all sectors: higher education, K-12 education, nursery education. Every level has been dramatically affected, and it still is very much in flux right now. And we are seeing still a very strong preference for hybrid, if you like, remote education, remote learning. That's not going to change anytime soon. If anything, and we were just saying in the break, there is a good chance that this will certainly continue through this semester. And who knows about September? It's very likely still that there will be institutions and certain faculty and instructors that will choose to continue some of the large lectures remotely so that they can really help their students digitally, online, making sure that they get the best material they can. For us at McGraw-Hill, Miles, we've been incredibly busy because of this. And quite frankly, our shift has been helping instructors transform their courses to a remote learning environment, helping them shift all of their material online, making sure they're comfortable with McGraw-Hill Connect. It's our platform that delivers all of our wonderful content, and helping them gauge and navigate the platform so they can make sure that in doing so, they're assessing their students and making them, helping them learn in the right way to keep the outcomes growing and to ensure that their education is not stalled and interrupted.
Simon, it's Julie here. I still have this image of McGraw-Hill primarily as publisher, and I still think of, big, heavy textbooks, of course, which are not happening right now. I wonder, as kids go back to school in person, the migration had already started at universities in terms of bringing those textbooks more online into electronic forms. Is that going to also be happening in more lasting fashion in K through 12? Because you don't think of kids necessarily as carrying their laptops to class as they do on the university level.
That's a great question, Julie. And you're right, we are known at McGraw-Hill proudly as being a textbook publisher for 132 years. We have, however, rapidly transformed our company now where, in the case of higher education, over 80% of our business is now digitally delivered. So that's students coming to our platform, taking our world-class content still, but then augmenting that with all the courseware material and assessment material that we offer through Connect, and also Alex, another one of our very effective platforms. And these platforms are utilizing artificial intelligence very wisely to where we can direct student performance based upon how they respond to certain questions as they go through their course. It really is a way of personalizing the learning process. But you're quite right, Julie, that when you think about K-12, it is a different sector. There's no doubt that higher education is not going to go back to what it was. That will remain a largely digital environment. K-12 is a little different. And I think you can imagine as you go down to the younger age groups in the elementary sector, it's tougher for students then to learn purely remotely. They need the interaction with teachers, and they need the ability to be socially interactive with their friends. I think you'll find that when the day, that fine day comes, when children are back in school regularly, full time, I think you'll still see, though, a hybrid version of learning even there. You'll see, I think, more younger pupils, younger students going online in their labs, in the school itself. I think you're going to start to see multi-screen classrooms where teachers will utilize our material and other forms of material that they'll deliver digitally, even when students are in the classroom. We are still, of course, providing some of those very well-known textbooks that we have across all age ranges in our K-12 business, and we're proudly doing that. That's still only around a half of our business. So already you're seeing a gentle shift towards a digital future, but it is not moving at the same pace, nor would we expect it to, as it is in higher education, where now that business has fully transformed to a digital remote learning environment.
Simon, you mentioned earlier that you're busy right now. Are you busy enough to bring McGraw-Hill back to public markets? Now, you last filed a prospectus in 2017, so you did float that notion out there, and you have said more recently you are looking for ways to improve your capital structure. Going public would definitely help in that mission.
We right now, we're focusing on doing everything we can do because we are so busy, as you say. Our focus is completely on our customer group. We concluded a very successful refinancing in the last few weeks, which we're very, very happy about. Therefore, really, that's allowed us to focus on serving our customer group in a very different environment, making sure that we are establishing McGraw-Hill on a very, very sound footing for the future, and really ensuring that we're still developing and investing huge amounts, hundreds of millions of dollars every year into our technology platform, and making sure that we're still creating the content that we're so well known for to sit on that platform and then be manipulated in a way that's helpful for student outcomes. That, to be honest, has been all the time that we've had. We're dealing with sixfold our normal customer service inquiries to help teachers transform their classes. I'm delighted to say that our customer satisfaction ratings are the highest they've ever been. That's keeping us very busy right now. So I don't see that changing anytime soon.
All right, Simon Allen is the CEO of McGraw-Hill. Simon, if we're speaking every 4 or 5 months, I hope that the next time we speak, the world looks quite a bit different and things are a little bit more opened up than they've been as we've spoken through 2020. All right, Simon, appreciate the time this morning. We'll talk soon.
Thank you. Bye-bye.
All right, a lot more coming up here on Yahoo Finance Live. Down red figures, but again, not a lot going on with the major averages. We're back here with more in just 2 minutes.
Automakers have been having a sneaky low rally this year. And for once, I'm not talking about Tesla or electric vehicle stocks. Brian, I was just looking at the returns this year for Ford, up 27% thus far in 2021, and GM, which is up 34%. What's going on?
Yeah, well, here's a little bit of hashtag breaking news, Julian Miles. The top trending ticker on the Yahoo Finance platform is not Tesla, NIO, or Xpeng. It is Ford right now, and it's interesting because there's really no news out today on Ford except the fact that the stock is up here in the early goings, which ultimately got me to thinking, what is going on here? Ford shares have made a strong move, up 23% year to date, as you mentioned. General Motors up 31% year to date. And I boiled it down to three reasons, essentially. One, I think you're seeing a spillover of Tesla mania into some of these old school auto manufacturers here. And the stock market and investors and Wall Street is finally starting to realize Ford and General Motors, they ain't making horse and buggies anymore here. They are making electric cars to compete with the likes of Tesla over the next decade. You look at Ford. Here. Their first electric F-150 that will come out in 2022. Our very own Praz Subramanian, he is just now testing the new Ford Mustang Mach-E all-electric SUV. Looks like an interesting truck. By all indications, that has seen very, very strong demand. And the company also has the new Bronco coming out, not electric, nonetheless, very exciting vehicle. And then you look at GM, they are well on the path to deliver 30 new electric vehicles by 2025. So I think that is starting to excite a lot of folks on the street. Number two, you're also seeing, I think, a lot of analysts betting on big guidance from GM and Ford when they report earnings in a couple weeks. Both these companies have cut a whole lot of costs out of their business. They all, I would say, have some of the most exciting product lineups they have had in the past few years. That could push up estimates. And then last but not least, strong truck pricing. You look at some of the recent analyst notes out there on Ford and General Motors. Truck pricing is very strong, and that could only strengthen further if we get a new fiscal stimulus plan. You get out there, more job sites back out there happening. Certainly that will be helped by the vaccine, fueling truck sales. And as you both know, guys, Ford and General Motors, they make the bulk of their profits still on big trucks.
Yeah, and Sazi, I think that news from Microsoft and Cruise the other day certainly still ricocheting through the markets. And I think also when you look at where all the heat has been in the market, and we've talked so much about the retail energy, the speculative energy, it's all been in the auto space. And so I guess to me, it's almost like it's about time that Ford and GM start getting some more of that love. If everyone likes everything that's happening in auto development, from the LiDARs to the solid state batteries, the other self-driving mechanisms, I mean, this is even leaving out Tesla, which of course is an auto story, but also its own kind of story. It makes sense that eventually we would see Ford and GM get in the mix. You have the pandemic tailwind. People like driving cars now. The kinds of cars, Sazi, as you outlined, are exciting to investors. And also, guys, if I've heard one, I've heard 500 pitches on why GM is such a great value stock. The stock went absolutely nowhere for a decade. Now it is finally busting out. And we see the performance here over the last couple of months. Ford has doubled, GM has more than doubled over the last 6 months. Ford is up 70%. So after a long time of looking at these businesses and investors wondering why the stocks didn't go up, well, here you go. Christmas has come in January 2021.
And just think about the optics here. You have an entire market looking for new opportunities. And to your point, Miles, you have GM shares trading about 8 times forward earnings, Ford 9.5 times forward earnings, GM stock yielding about 4%, Ford yielding about 3%. And now the stories have started to improve. And if you're an investor with a lot of cash right now to you put to work, why not take a gamble on these two stocks?
Or you could continue to gamble on Tesla, which trades at more than 1,000 earnings.
Yeah, why not?
All right, we're going to take a quick break. When we come back, we'll be talking more about the stimulus prospects under the Biden administration. Stay tuned. It is 10 a.m. on this Thursday, January 21st. This is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udland and Brian Sozzi. 30 minutes into the trading session or so, and we don't have a lot of movement for stocks today. The Dow and the NASDAQ earlier both touched intraday records. The Dow, though, has been bouncing between gains and losses today. So a bit of a pause after the big push upward for the major averages yesterday. And of course, it's the first full day of Joe Biden's presidency as he signs executive orders targeting the coronavirus pandemic and girds for a battle in Congress on his aid package. Americans are staying put for longer in their homes. That's crimping already tight housing supply. We'll discuss the outlook for housing this year. And perking up your flaccid cactus, metaphorically speaking, that is, the CEO of Hims and Hers will join us on his first day of trading following a SPAC deal. But we do start with what is going on in Washington, because it seems like the honeymoon period is already over. A day into Joe Biden's presidency, there's a lot of talk about what kind of reception he will get from Congress on his aid package. To talk more about that, we're joined by Clayton Allen. He's Eurasia Group U.S. Director. Clayton, thanks for being here. So, what is this battle going to look like? And is it going to be as contentious as some of the early reports seem to indicate?
Well, first, thanks for having me on. Very happy to be here. And I think you're right. This is going to be a contentious fight. The honeymoon period for Biden was probably always going to be relatively short. We just went through possibly the most contentious transfer of power in the last 150 years. So it makes sense that he would face a relatively contentious sort of incoming reception. The fight over his stimulus package is really going to come down to cost. And this is a fight that's been going on really since the beginning of the pandemic. You have Republicans and some moderate Democrats, it must be said, who don't like the idea of a $2 trillion plus kind of stimulus package coming on the heels of the $900 billion stimulus package that we moved late last year. And that's really the center of the argument. It's Democrats want to spend a lot of money and they want to do things like push state and local aid. Republicans don't necessarily want to do that. And it's going to be really hard for Biden to get buy-in from 10 Republican senators, which is the threshold he needs to clear to move a stimulus package via regular order. He can move things, though, via reconciliation. That doesn't seem to be his immediate focus, but we think that's where he ends up. And that opens the door to pretty major stimulus going with only 51 Democratic votes. The punchline to all this is that we expect that there will be massive stimulus in the next several months. We're looking at 1.5 to 1.9 trillion as our baseline expectation.
And Clayton, maybe stepping back slightly from the details of what Biden may or may not get through, just there seems to be a sense in the last 24 hours of, okay, return to normal. Donald Trump is gone. Now we get back to good old-fashioned Washington, D.C. style politicking. But when I remember what happened in the Obama years, it wasn't like that was all, warm and fuzzy. Nothing got done. That was when the hostility between the two parties really started to ramp up. I'm not sure a return to that really does a whole lot in advancing, your infrastructure bill, Green New Deal, all this stuff. How do you see, do you see more gridlock? It just is warmer and fuzzier because, they do regular press conferences and the president doesn't tweet his kind of, stream of consciousness.
I think you hit the nail on the head. Everybody talks about a return to normal, but people seem to forget that the normal for 8 years before Trump was not a lot getting done and certainly not a lot moving very quickly. That seems to be kind of where we're headed. Now, Biden has one major advantage. He does have admittedly narrow majorities in the Senate and the House, and that does let him do a little bit more. I mentioned the reconciliation process. That's really crucial to Biden's ability to push things through, where Obama maybe faced a more obstructionist, certainly Republican House after 2010. You are right, though, that the mood of D.C. is going to change, and you shouldn't overlook that. That is important because it turns down the temperature in the kind of disagreements and sort of procedural and legislative back and forth that we have. If everybody is a little bit more civil, that opens the door to more backroom negotiations. It lets people have a little bit more latitude in working across the aisle. Now, how much of that's actually going to get done? That's an open question. We're still a very divided country. We're still a very divided city. We have a growing progressive left. We have a growing far right. And those two groups kind of pull Congress apart. So It's still anybody's guess as to how much we're actually going to see get done. But the two things to really focus on are Biden has some tools that Obama didn't have later in his presidency, certainly after 2010, namely majorities in two chambers. And the temperature of the rhetoric in D.C. will start to come down in the next several months. Both of those are pretty important.
And of course, he's using the executive orders as well, as we have seen in the first day and a half of his presidency. Just want to mention that Pete Buttigieg is undergoing his nomination confirmation hearing. It has begun in the Senate Commerce Committee, and you see there Senator Roger Wicker, a Republican of Mississippi, who is speaking at the moment. And so, Clayton, that brings me to the agency over which Buttigieg is expected to preside. Dare I say infrastructure? Can I say the word? Well, once again.
Every week is infrastructure week, isn't it?
If the aid bill isn't going anywhere, does infrastructure have a prayer?
That's a really good question. And there's an interesting dynamic at play. And this comes down to the people that are the incremental 50th vote in the Senate for Biden. People like Joe Manchin from West Virginia, where, he's much more moderate than the rest of the Democratic Party. He is much more willing to take positions that are outside the Democratic mainstream. So he's someone to really watch on this. Manchin's been a little bit skeptical of some of the more expensive stimulus provisions we've seen proposed. Namely, he's kind of leaving the door open on $2,000 checks and really hasn't said if he supports or opposes them. So he might be someone who says, look, I want the stimulus package to maybe be closer to 1.6, 1.7 trillion, and maybe we can spend money later in the year. The more you spend on stimulus now, it's going to be harder to get that infrastructure package through later in the year because both of these things are going to be deficit financed. This is kind of a wonkish point, but usually you have to pay for things that you pass through Congress, except things that relate to COVID-19 and climate change, based on House rules that exempted both of those from PAYGO. So infrastructure and COVID stimulus can both move through deficit financing. And that's something that deficit hawks like, Ron Johnson or other Republicans really hate. And so if you spend a lot of money that's deficit financed early in the year on stimulus, it's going to be really hard to get something through later in the year on infrastructure that's also deficit financed. That said, infrastructure is something that generally has a lot of bipartisan support. So I think that people are holding out hope that that's still something that you can get a lot of people together behind. It also has the effect of providing stable long-term stimulus into the economy, which is another major benefit.
Clayton, I have 45 seconds left. The President Biden has not hidden in the early going. He wants to put the U.S. back on the world stage, rejoining the WHO, calling Justin Trudeau today on the docket for him. How do you think, what's his first step with regards to China? Does he bring China closer into the fold, or does he continue the policies put forward by former President Trump?
So this is an area where I think that people's expectations might be a little bit out of step with what's actually going to happen. Over the last several months, I think you've had a lot of people say Biden's going to have this sea change in whether it's tariffs or other approaches to China. And the reality is maybe a little bit different. The tariffs that are in place right now probably roll off very slowly, and they only come off in response to some really concrete concessions from the Chinese. In terms of other areas of whether it's cooperation or confrontation, Biden does seem set to take a more aggressive approach than the Obama administration did, certainly. But we expect that Biden's going to lean more on organizations like the WTO and other multinational, multilateral organizations to exert that kind of pressure on China. So aggressive, yes, but aggressive in a different way to Trump.
Clayton Allen of the Eurasia Group. Thanks so much for being with us, Clayton. Talk to you soon.
Thanks for having me.
And let's turn back to the markets now, and not just the market reaction to all that's going on in Washington, but just a trajectory generally. Daniel Morris is back with us. He's BNP Paribas Asset Management Chief Market Strategist and co-head of its Investment Insight Center. Daniel, good to see you. You said in your notes to us, equity markets are perhaps not as frothy as some would suggest, because there have been a lot of sort of warnings about bubble areas of the market or even the market as a whole. What is telling you, what are the indicators that you're watching that show you maybe it's not quite as bad as some are saying?
Well, let's start with some of the indicators that do suggest there is, I don't know if I'd go so far as to say euphoria, but certainly high expectations. So if you look at the put-call ratio, for example, that is quite low. So as a contrarian indicator, that would suggest you had the potential for a bigger drop in the market. But if you look at the two parts of that ratio, the puts and the calls, and why is the ratio so low? It's not because you necessarily have so few puts. The number of puts right now is about average, but you do have a lot of calls. So that's why the ratio is low. But if you think about the environment that's ahead of us, coming out of a recession, uncertainty certainly around how things are going to develop around the pandemic. Things still could get better in terms of the rollout of the vaccines. The questions that, of course, we just discussed on how much stimulus we're actually going to get. So a lot of uncertainty, but at the same time, you would appreciate there's a decent amount of potential upside in that. And so why not have calls on the market in case things do go better than expected? So yes, the ratio is low, but the motivation behind that I don't necessarily find so confusing. Other things you can look at, bulls to bears ratios, elevated for some of the indicators, but not at extreme levels. And probably one that I think is quite telling for me, if you look at fund flows and compare the situation today with what you had back in 1999 and 2000, when investors were kind of selling anything they could to raise cash to buy equities, you had huge inflows into equities in the run-up of the tech bubble. You don't see that now. You haven't seen inflows into equities for quite a while. And if anything, over the last couple of weeks, you've seen redemptions. So not to say there isn't a risk of a downturn in the market. In a sense, there always is. But at the same time, we see, in general, our market indicators certainly signaling enthusiasm, but not an extreme level where we're anticipating a very significant drop in the market.
Daniel, what's the one thing that could cause a market correction in the first quarter? Because to some of your points, I only see a lot of optimistic indicators. You have the Fed essentially printing money. You have the COVID-19 vaccine rollout continue. Have companies starting to perhaps turn the corner on their earnings growth. Is there something you're seeing out there that could really surprise people?
Well, I think if you highlighted really the three potential risks that are out there that could upset the market. But at the same time, I think we do appreciate what those risks are. We've already had a less smooth rollout of the vaccines than we might have thought when we had the initial news of their high efficacy rate. But we all appreciate that may continue to be a challenge. But nonetheless, we're moving to a point where you're going to have much wider availability than you mentioned. We've talked about the stimulus, so perhaps it turns out Congress is extremely obstructive, and instead of 1.5, it's a 1 trillion or 500 billion. Certainly, that is relatively speaking disappointing. But on top of the 900 billion we just had, that's still a lot of money that's going to be coming into the economy. But again, it's always the reality versus the expectations. And then the one that conceivably really could upset things, so here the probability does still seem to be quite low. Again, it's around inflation. Now, on one hand, the Fed wants inflation. We all want a bit more inflation, and we're looking for above trend, above target growth for inflation, above 2% into next year. It's just if you saw a much more rapid acceleration of inflation expectations. But even then, with the Fed continuing with this quantitative easing program, you could have an increase in inflation expectations, but nominal yields likely to remain contained thanks to the Fed. And so that removes some of the risk of a higher discount rate to equity markets.
Well, and then Daniel, related to that, maybe this is the positive side of an reflationary trade, we should say, is what we've seen in value stocks, particularly in the banks, as rates have gone higher. How much higher nominally do you think the long end of the Treasury yield curve can go? And I mean, I won't ask at what point does it become a concern for the markets, but how long does this tailwind for some of those beaten down trades last?
Well, I think that's one of the crucial questions for this year. I mean, we've had this rotation out of growth and into value for a while now. We do think there are still legs on this trade, but I think at the same time, we need to have reasonable expectations about how far it can go. And it really does come back to at least partly the Fed. You do want to have higher interest rates, certainly for net interest margins for the banks. You want to have higher oil prices for the energy sector, which has a good weight in the value indices in order to pick up. And we think that can continue for a while. At the same time, even 2% Treasury yields on 10-year Treasuries seems quite high at this point. So even if we do expect the rotation to continue, it's certainly not going to reverse the underperformance that you've had for value, arguably for the last decade or so.
Daniel, good to see you. Daniel Morris of BNP Paribas. We'll catch up with you soon. And when we come back, we'll be getting another check, not just on the broad markets, but also on some interesting movers in today's session. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles O'Donnell here in New York on this Thursday morning. Markets are higher across the board. Not a whole lot going on in the major averages, though underneath the surface we do have some big moves, relatively big moves coming from some of the biggest stocks in the market. Yahoo Finance's Ines Ferre joins us with some of the details on these movers. Ines.
And Miles, let's take a look at United Airlines, because United Airlines reported its quarterly results yesterday after the close. Quarterly loss of $7 a share. That was larger than what the street had been expecting. If we take a look at our Wi-Fi interactive board, you can see the travel stocks, a little bit of a mixed picture here with UAL, the biggest decliner right now, down 5% today. United Airlines also having the revenue coming in below what the street had been expecting. The airline is hoping to cut some $2 billion in annual costs through 2023 as it's trying to make its way through a recovery. Of course, it's been tough for the airlines that have been hit by the pandemic. Taking a look at the NASDAQ, because we're seeing quite a bit of action on the NASDAQ. The NASDAQ earlier hitting an intraday high, the Dow as well. But if you just take a look at some of the big cap names here, you can see that these are in the green. You've got Apple that's up more than 2%. A headline out of Apple, some reports coming in saying that Apple's VR headsets are set to arrive as soon as next year. And those headsets would be for $1,000. So you can see that Apple is up almost 3% this morning. We've also got Amazon that's up more than 2% right now. Amazon's price target at BofA was raised to 4,000. So Amazon getting a nice bump here, perhaps on that analyst call. And also you've got Alphabet that's up more than 2% right now. Tesla today taking a bit of a breather. Facebook up more than 1.5%. I do want to mention Netflix, which yesterday had seen new highs. Today it's taking a breather, down about 1%. I also want to show you Mercado Libre, if I can find it here on our Wi-Fi interactive board. Mercado Libre is also seeing new highs today as well. And then just taking a look on the Dow, you can see the Dow Action United Health Group up more than 2%. We've got the sector action that's looking a little bit like what we saw yesterday. You've got technology that's in the green. You've got consumer discretionary in the green, and also communication services. We had some FANG leadership yesterday. We're seeing some FANG leadership today as well. But we are seeing that energy is under pressure, down about 2%. And you can see on the Dow, Chevron down more than 2%, one of the laggards on the Dow today. Miles?
All right, Nez Perez with an overview of how things stand. As you noted, Nez, interesting to see the big cap tech stocks pick up the slack as real leaders here in the market after kind of not doing a whole lot in terms of leadership, at least since the election. We'd really seen some of those cyclicals, industrials, financials doing a lot of the legwork there. Just another name to call out as we head to break here, and that's what's happening over in the home builders. Take a look at XHB. The ETF is up about 1.5%. The individual names, KB Home, Toll, Pulte, all up better than 3% earlier this morning. More crazy data out of the housing market. Housing starts, building permits, 14-year high in December. Just the latest piece of housing market data that we are discussing as since the housing bubble. Obviously, conditions on the ground quite a bit different, but this market in a place it has not been in quite some time. And coming up right on the other side of this break, we're going to talk more about everything going on in housing. We're back with that in just 2 minutes.
Even though we've seen some tepid action in the major averages today, it's enough to push them all to intraday records. All the S&P 500 just now joining the NASDAQ and the Dow there. We did get some housing data this morning that was positive. Housing starts at about 1.67 million on an annualized pace. That's up 5.8% month over month, and that is the best pace going back to 2006. To talk more about the housing market, we're joined by Mark Fleming. He is First American Chief Economist. Mark, it's good to talk to you. You know, we also saw a story this morning in the Wall Street Journal that looked at Redfin data that showed people are staying in their homes for longer. So there really seems to be a supply issue here. Is there any sign of that with that hot starts number this morning? Any sign of that being alleviated?
Well, nothing sells like a shortage, right? And we've been basically underbuilding relative to demand for shelter for 11 years now. And the good news is we see in the reported data today that the housing starts are up 30%, to a high not seen since 2006. Permits are also up. I mean, the construction industry is responding to a significant shortage in the housing market. And as you said, most people who are already in homes, existing homeowners, are basically sort of hunkering down and choosing to stay put. So it's all about supplying the new homes to the market, because all existing homeowners are busy locking in 2.7 or lower 30-year fixed rate interest at the moment.
And how concerned are you, Mark, about the price activity we're seeing in the markets? That might be holding back a lot of buyers, but is this starting to, in your view, start to take us back to the housing bubble over a decade ago?
Prices are high, but people buy homes not at the nominal price, but based upon how much per month. And when you can get such low mortgage rates, as we're at 50-year historic lows, give or take a tenth or so on any given week, that generates a lot of house buying power. So in terms of monthly burden, housing is actually still quite affordable. Now, not in every marketplace, it depends, but it's not the same as before in terms of sort of bubble territory, really because of the dynamic of such low interest rates today.
Mark, as you look at some of the dynamics we've seen in housing this year, and I think the big one that everyone loves to talk about is folks leaving the city for more suburban locales. How much of that do you think is new demand for those homes rather than pulled forward demand? Do you think this sets both of those, locales on a new trajectory, or is it where the market kind of thought it would head, maybe just, through 2025 instead of all at once?
Right. Is there a pandemic-driven flight to the suburbs? I would first start to say there's been sort of a longer-run demographic trend of flight, if you will, to the suburbs, and that is all of these millennial first-time home buyers, aging into household formation, having families, and making the choice to become homeowners. That's really the demand story in the housing market right now. We're already choosing the suburbs, just like every other generation, for the family raising. When it comes to the pandemic specifically, we only have really one market that we could identify that was sort of really being driven by this pandemic, and that's New York. And if you think about it, New York is the most densely populated city in the country. It's heavily reliant on transportation, like small metal tubes underground packed with people, all not really good in pandemic. But most of the rest of urban America actually looks a lot more suburban. Think of Houston and Charlotte and all of these other markets. So I think it's really much more of a longer run demographic story, the shift to the suburbs, than a pandemic one.
That's a really good point about some of those urban areas. We here in the New York area tend to think of mostly New York when we think of urban.
Oh, you're special. You're special up there.
Yeah, I guess so. What's going on with pricing here, Mark, going forward? Are we going to see, or are you already seeing any signs of stabilization?
Yeah, there are some markets, mostly in California, where even with the low mortgage rates, house prices have begun to sort of outpace the affordability or the buying power of the people in those markets. So that's slowing down appreciation. But the longer run issue here is, as we started the segment, is so few people listing their homes for sale. The inventory of homes for sale is barely 1% of the housing stock. That's extremely low. And you put that against all of that millennial demographic demand. And, Econ 101 says lots of upward price pressure. Will it remain 8, 9, 10% like we've been seeing in the last few months? Maybe not, but 4 and 5%, a slowdown in house price appreciation to 4 or 5%, is still very strong market, because prices are going to force the balance back between supply and demand, which is out of balance at the moment.
Right. All right. We'll see what happens. Mark Fleming, First American Chief Economist. Good to see you, Mark. Thank you.
Thank you.
Well, coming up, first day of trading for Hims and Hers following a SPAC deal. We'll be joined by the CEO next.
You've probably seen their commercials for erectile dysfunction meds, but today Hims & Hers will look to find its own stimulation via the stock market. The consumer product seller began trading on the New York Stock Exchange under the ticker symbol HIMS after doing a SPAC deal with Oaktree. Joining us now to discuss is Hims & Hers co-founder Andrew Dudum. Andrew, good to speak with you this morning. Full disclosure, I'm surprised to see the market reception here to your stock in the early going, down slightly. Are you surprised, and anything you put your finger on why this responds?
You know, the beautiful thing about the market is it goes up and down, and you don't really know. The stock's up 60% in the last month or so. So I think a lot of that SPAC dynamic is built into that growth. Because of that structure, you have a little bit of a different dynamic than a traditional IPO where they pop overnight. So, you know, we're really excited about where the stock is trading today. And I think most importantly, we're really excited about the next 5 and 10 years of us innovating in the healthcare system.
You know, Andrew, I'd love to just take a step back if I can and ask about what the model is here. As Brian mentioned, we were just chatting, before the break. I think a lot of our viewers are probably familiar with the commercials. They know that Hims is a brand, and I think the brand is quite strong. But what part of the health pharmacy system are you really going after, and what do you see as the opportunity there?
Yeah, the opportunity with Hims & Hers is really to rebuild essentially the healthcare system in a consumer-first way. So anybody in this country can go to forhims.com or forhers.com. They can identify a condition such as maybe anxiety and depression, or a dermatology issue such as acne or aging that they might be concerned with, and then immediately get connected with a licensed physician in their state, get the medications they need, a personalized treatment plan for them, and then have that delivered to their door, all for a price point of roughly $20 to $30. So we operate outside of the traditional healthcare system. We've rebuilt everything from that consumer front door, that brand that people know across this country, but have also built the distributed network of physicians and providers across the country, our own EMR, our own 300,000 square foot pharmacy and fulfillment center, to be able to deliver this start to finish healthcare consumer experience in a way that really hasn't been brought to market today. And so I think that's so much about what has been driving the acceleration of the business, growing 90% year over year last quarter, 76% gross margins, and having powered close to 3 million medical visits in just the last couple of years since launch. It's just really unprecedented growth when you think about the fact that we're living in a healthcare type of experience.
Andrew, it's Julie here. It's one thing to diagnose online something like baldness, pretty obvious, right? But how far does this go in terms of what you're going to be able to do and what your addressable market is and what your plans are?
You know, it's a great question. When we talk to our board of directors, which is made up of incredible healthcare executives and leaders in this country, Dr. Toby Cosgrove from the Cleveland Clinic, our chief medical officer, Patrick Carroll, who is the chief medical officer of Walgreens, we debate, what portion of the U.S. healthcare system is going to be moved to a digital first experience like Hims or Hers. And the overwhelming consent is something around 75 to 80%. So that means 75 to 80% of the reasons that you go into a brick and mortar hospital will eventually in the next 5+ years be moved to a digital first world. And that might include at-home diagnostics, as an example, at-home testing. It might include at-home continuous monitoring systems on your body, on your Apple Watch for glucose management, as an example. But when you think about the fact that 80% will be moving to a brand or a system like Hims and Hers, and then you realize and step back that the US healthcare system is about a $4 trillion market, this opportunity is massive, right? And I think it's really the earliest of innings in the next 5 and 10 years. And the regulations have just made it possible. And I think the consumer expectation has also just made it possible where you can now have a digital experience where you can pick up your phone and access great healthcare. And I think we're all really excited about what that future could look like.
Andrew, is this the year your company will be able to accept insurance?
It's something that we'll likely be able to roll out either this year or next year. It's a capability that is really important specifically for those individuals that need medications or treatments that are highly specialized. And in most situations, those are on-patent drugs. As an example, Truvada is an amazing drug, prevention of HIV with 99+% efficacy. But that drug is near $2,000 per month. And until that gets fixed, us being able to offer insurance on the platform will unlock our ability to treat people with these medications that otherwise do not have generic options. However, for the majority of our business, there are great generics available. And because of that, we're able to not only help treat the patient, diagnose the patient, give them a formulation, but also have that medication shipped to their door, all for a very simple price of $20 to $30. And so, that generic dynamic makes it really affordable from a cash pay model standpoint. But with insurance, we'll also be able to unlock other medications that do not have those availabilities.
Andrew, walk us through some of the numbers here. So 2021, you're looking for 30% year-over-year revenue growth and an adjusted EBITDA loss of $29 million. Now, your sales projection, the growth rate, that'd be slower than last year at about, 67%, and your losses are expected to increase. Has something shifted in the business, or is this you guys being conservative out of the gate here?
We like to be conservative out of the gate and make sure we can hit and beat expectations we put out as a young company. I think that's really important to build credibility and trust with the street. But when you look at the business, even if you look at last quarter, the business is growing 90% year over year with 76% gross margins and increasingly improved cash efficiency quarter over quarter. And so I think what we have here is a business that inherently has incredibly robust revenue potential, given the fact that we operate in so many different verticals and so many different conditions. And then given the verticalization we've built, also inherently high margin structures, right, with 76% gross margins. So I think that combination of phenomenal revenue growth, high efficiency and margin structure, as well as being, I would say, on the forefront, and in many ways, I think the first inning of what will be a very long baseball game in this revolution in digital healthcare in the next 5-10 years, will make for an incredible investment opportunity for the public markets, one that frankly, as a capital markets investor myself, I haven't seen in a very long time. And so I think we're all very excited about that combination of factors that you have here with Hims and Hers.
Andrew, real quickly before we let you go, when might the market see fertility and diabetes products from you?
That's a great question. Both of those categories, along with other chronic conditions such as hypertension, high cholesterol, are really important to us as a team because we see them with very high prevalence within the thousands of patients that we treat per day. To date, we've seen almost 3 million medical consultations come through the platform in the last 3 years. And so we're able to identify these conditions, such as those you mentioned, that our customers are really struggling with. And so what you'll see from us is every year us launch a couple of new major categories and really invest in making those experiences wonderful, affordable, and beautiful to encourage people to try to get some care. So we're hoping, this year or next year, you'll be able to see some of those new chronic conditions enter onto the platform.
All right, we'll leave it there. Andrew Dudum, co-founder and CEO of Hims and Hers. Good luck in public company life. We'll talk to you soon.
Thank you.
All right, do stick around. Much more ahead on Yahoo Finance Live.
On the latest episode of Influencers with Andy Serwer, Yahoo Finance editor-in-chief, Andy Serwer sits down with New York City mayoral candidate and former Citigroup executive Ray McGuire to talk about his 2021 run for New York City mayor, as well as his expectations for the Biden administration.
I love this city. I love the city. It's where I met my lovely wife, Crystal, and where we're raising our 3 children, Leo, who is 8, Ella, who's 18, and Cole, who's 20, who will this evening start as a starting point guard for the Orlando Magic. But, right now, this city is suffering. We're managing 3 existential crises: crisis of the pandemic, crisis of the economy as a result of that, and crisis of racial and religious segregation. So what I've done is kind of how I got here. Who I am will inform why I want to be mayor and why it's so important. Who I am, and is I came from the other side of the tracks. The other side of the tracks. I was raised by my single mother. I didn't know my father. My single mother and my grandparents raised me and my 2 brothers in a home that at any point in time had half a dozen foster children with us. And I grew up across the street from the Howard paper mill. And sometime it emitted fumes that were so strong that the only way that we could breathe was to open the refrigerator door. And I knew when my mother, who was a social worker, had to make the debate between putting food on the table or paying Dayton Power and Light the gas and electric bill, or putting tithes in the church. And I know what it's like when you hear that conversation taking place. And I know what it's like when you have no money and you have to wash the tin foil. And what it's like when you get to the end of a bar of soap, you put as many of them together as you can and boil them to convince yourself that you have a bar of soap. I know what that's like. So I know what it's like not to have. And I know what my mother sacrificed for me and my 2 brothers to get here. My mother sacrificed so I can have an education. And it was education and her sacrifices that allowed me to get here. And so when I came to New York, I had 3 things. I had a great education, I had a lot of debt, and I had no money. And New York has been great to me. It gave me the opportunity, with all the sacrifices and with the education, to come here and to compete in one of those most competitive fields that exist anywhere. And to do that for 36 years at the highest level. So, Annie, I take my lived experiences, how I got here, my foundation, and my knowing what it's like not to have, and what I've been able to do in business on Wall Street, in business, managing and leading for 36 years, and the relationships. And I bring all that together, and it's a city that I love, and it's at a point in time where you can make a difference. And so I can make a difference in the lives of so many, especially those kids, Black and brown, who look like me. And that's what this is about. And that's why I'm running.
You propose, Ray, an economic recovery plan called Go Big, Go Small that calls for major investments in infrastructure, skills for training workers, support for small business. And you say it'll be the biggest job plan in generations. Why focus on those areas in particular?
Because right now we are in the midst of a crisis. And what I've written about is today, George Floyd and COVID have been the big reveal to 400 years of systemic inequities in education and in the economy, in healthcare, and in the criminal justice system. And what my Go Big, Go Small vision is to make certain that we do, and I lead the biggest economic recovery, inclusive economic recovery in the history of this city. It is fundamental. It is fundamental for this city to achieve the greatness that it so deserves, that we fix the economy. You got to go big, you got to go small, you got to fix the small businesses, and you got to put people to work. So my strategy is to employ hundreds of thousands of New Yorkers, all of whom live in New York within the 5 boroughs. I don't want to import the talent, so that we can grow our way out of this crisis. And we can do that. We did in the 70s. At the height of the Great Depression, we built the Empire State Building. We built the Chrysler Building. We got out of the 70s when business, labor, and government came together. And we can do this today. We got to make it inclusive, because up to this point, it hasn't been.
Let me ask you about COVID, Ray, because There's news that New York City is running out of vaccines. So how would you assess the way that Bill de Blasio and Governor Cuomo have handled the pandemic and the distribution of the vaccine, and what would you do differently?
So what I would do differently is you have to plan for this. And given what I've been able to do for 4 decades, is plan. You have to plan for worst case scenarios, and you have to not only plan, you have to go through scenarios, and you got to get the right team in place. We knew the vaccine was coming. We knew the vaccine was coming. We should have spent endless days planning for how we're going to distribute it, for one, endless days planning on informing New Yorkers of the impact and the necessity to take the vaccine, while also emphasizing what we have been somewhat effective at, social distancing and mask. I would have overplanned for this and communicated with the New Yorkers in a way that didn't actually happen, which is why we're managing today through the poor management of the distribution of this and the poor management of how we inform New Yorkers.
You've raised a bunch of money so far, Ray. I think maybe $5 million, a lot of it from wealthy backers. There'll be questions about whether New Yorkers can trust you, that you'll look out for their interests, the working people, when your campaign draws on so much support from wealthy individuals.
Well, I want to be clear about this, Andy. We've been able to attract contribution from 3,700 people across the spectrum, which is how I exist. I'm fluent in the streets and the suites. We've identified some high dollar donors, but we got some low dollar donors as well. And it's all New Yorkers who've come together, regardless of race, creed, zip code, color, to participate in my campaign because they recognize they want something different. All the promises of the past have not been fulfilled. As a matter of fact, it's gotten worse. It hadn't gotten better. It's gotten worse educationally. It's gotten worse economically. It's gotten worse in the healthcare system. It's gotten worse in the criminal justice system. It has gotten worse. So people want a change. They want something different. I'm like Shirley Chisholm. I'm unbought, unbossed, unbound. My sole focus is what's in the best interest of New Yorkers. That's it, especially the Black and brown people look like me who've not been included. So I welcome all contributions. How can they trust? Look at my track record. Look at my track record of doing what the great leaders have told us we should do, standing on the shoulders of the great leaders. And what they've done is extended a ladder. So look at the number of mentees that I have across the city, across this country. If you look at Black Wall Street and Brown Wall Street for the past 2 decades, for the most part, have had some impact. Look at the Capitol. Not only have we been able to serve as an example, but look at the factual Capitol. We've taken people from no class to lower class to middle class to upper class, gotten capital into the community so people can participate, so they can take the examples and the shoulders on which we all stand. Given the opportunity in education and given the opportunity to recognize there are things out there they can do, they've been able to rise up, to lift up. So I'd be prepared to take my factual history compared to all the promises that you've seen across the board. Look at the facts. We don't trust anything, trust the facts, not the false promises, but the facts.
Every day, it seems, brings at least one new SPAC to market or a SPAC deal to market. We just talked to the CEO of Hims & Hers, which is going public through a SPAC transaction. And so it stands to reason that there are now SPAC ETFs also. There are two of them existing, and the Wall Street Journal reports today that a third one is coming on Tuesday. The hedge fund Morgan Creek Capital Management and Exos Financial are teaming up for this new SPAC ETF. And so you wonder if you reach like these various derivatives of these various financial instruments, does that increase the already maybe frothy, bubbly nature of this particular asset class? And I still am trying to figure out if SPACs are really a new type of, I mean, they're not new, but are they a type of asset now? I don't know. There are a lot of questions around all of this. I know you think a lot about this, Miles.
Yeah, I mean, as far as I could tell, reading SPAC prospectuses and reading the S1s and all that, SPACs are not asset classes. It's not an asset class. It's a financing scheme. We've been over this many times. But, you know, I think we're seeing it happen as well if you look at what's going on over with the ARK ETFs. And that, of course, is Cathie Wood's group over there, ARK Invest, and the number of funds they have. There is absolutely, undeniably a circular relationship between funds that hold certain securities and the price of those securities. And so if we get now additional SPAC ETFs, which are going to be funds that hold stocks that went public via a SPAC, that creates a bid for those names if the inflows into the derivative product, in this case the ETF, remain strong enough. And I know that this is something that really upsets a lot of traditional stock pickers who don't like the fact that derivative plays on the primary asset, in this case, the equity that trades on the public market, creates a bid for that and distorts the value. I know people get very upset about this, but this is also the modern market. There have been more ETFs than stocks for some time now, and it should surprise no one that the funds, the basket of these stocks, is more important than what happens to the business that the stock represents a ownership stake in. And so this is certainly, I guess, the natural outgrowth of that. And since everything happens faster, it makes sense that we have multiple SPAC ETFs within just a couple of quarters of SPACs really becoming the primary way that so many companies now come public. Just spoke to one a couple minutes ago.
So here's now the next question. Is the next SPAC a Powerball SPAC? Because somebody just bought the winning ticket, $730 million ticket in Allegheny County, Maryland. We don't know yet, or maybe we won't end up knowing who bought it, but hey, why don't they start a SPAC? There you go.
Yeah, you know, I have been thinking about this one all morning long here, guys. And what do you do? Let's say, so 730 million get cut in half, maybe by taxes. You bring what home? 350, $400 million. What do you do? I mean, do you go try to get to billionaire status quickly? Do you put it all on Tesla? Do you put it all in black and just hope that it doubles again or triples over the next few years and become a billionaire? Or you just go out and buy some really pricey real estate and dividend stocks? I don't know. These are tough choices that I'm sure this winter will have to think about. And I don't know. Hopefully they're watching Yahoo Finance because we have all the analysis they need to know.
Miles, what do you think? What are you doing with the money?
I'm going to just not tell anyone, and you guys will get a cryptic email from me that I've resigned Yahoo Finance. You'll never see me again. I'll delete all my social accounts. Mega Millions is Friday night, so I know that, you know, unless the person who won is a Yahoo Finance viewer, which, of course, the chances of that are quite low, for everyone out there, Mega Millions, Friday night. I think it's over 900 million now, so still some time to dream
still have a shot.
Yet, but
you can
if I win, I'm gone.
A couple million, Miles.
Yeah, if I win, I'm gone off the grid. It's been nice knowing everybody.
Well, thank you for that parting message anyway. All right, on behalf of myself, Miles, and Brian, have a great day, everyone. Good luck to you if you've bought that ticket.
Welcome to Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing records across all three major indices for yet another day today. The Dow up 41 points. The Nasdaq, the biggest gainer so far, up roughly 80 points, about 0.6%. Not the big gains we saw yesterday, though. Wall Street's rally taking a bit of a pause as President Joe Biden gets to work on his first full day in office. The coronavirus vaccine rollout, economic stimulus, and climate change firmly in focus. Reversing course at the WHO. Dr. Anthony Fauci vowing the U.S. will work with the World Health Organization as the country hits a new record in COVID-19 deaths in a single day. And the business of meditation, from a popular app to a new Netflix series. We're going one-on-one with the co-founder of Headspace to discuss the focus on mental health during the pandemic. We begin today, though, at the White House. President Biden laying out his roadmap to get the country out of this public health crisis. He's also preparing to sign another round of executive orders. Let's bring in Jessica Smith for the very latest on that front. Jessica.
Yeah, Kiko, on his first day, his first full day in office, President Biden is largely focused on fighting the pandemic. He made it clear yesterday that this is his top priority. We've already seen him sign several executive orders, including mandating masks on federal property, extending the freeze on student loan payments and evictions, and several other measures, all aimed at tackling the pandemic. Now, today, we do expect to hear from him later this afternoon as he outlines more of his administration's plan to respond to the virus. He'll also sign about 10 executive orders. Those will all have the goal of expanding testing, bolstering access to treatments, and improving data to fight the virus. He also is going to invoke the Defense Production Act to speed up manufacturing of vaccines, of PPE, and of COVID tests. At the EO signing yesterday, he acknowledged that executive orders are important, but that he's also going to need legislation. He is pushing this $1.9 trillion stimulus plan, but Republicans are very skeptical about this, to say the least. The new White House Press Secretary Jen Psaki was asked if there is any wiggle room in that nearly $2 trillion price tag, and here's what she had to say.
It was designed with the components that were necessary to give people the relief they needed. So what's challenging is, what are you going to cut? Are you going to cut funding for vaccinations? Are you going to cut funding for unemployment insurance? Are you going to cut funding for reopening schools?
Now, she also said the White House would like to do this in a bipartisan way, but the White House is not going to take any option off the table if Republicans don't get on board. We do expect to hear from President Biden again later this afternoon. He'll sign those executive orders, and he'll really give us more details about the plan to fight the virus. Again, that starts at 2 p.m. Zach and Akiko.
What was it? I mean, it's a busy first full day, but it was a busy day yesterday for the president too, giving speeches pretty much all day, walking around on TV. But when it comes to confirmations, that was one thing that may not have been as quick as people would have liked. I only counted one that came through yesterday. What are the expectations for those coming through now to really get his team set up and start working?
Yeah, there was one yesterday. Today, Mayor Pete Buttigieg is for the Commerce Committee. Seems like he'll be on track to be confirmed. The Republican chairman, at least the chairman for now, did say that he expects him to get confirmed. The timing is still up in the air about the rest of these votes. It could happen sometime next week, but again, really still up in the air. We know that leaders Schumer and McConnell are still working out their power sharing agreement. They'll get in the swing of things most likely in the next couple of weeks.
Okay, Jessica Smith with the very latest on that front. Let's bring in Josh Lipsky for some reaction to that. Josh is the Atlantic Council's Geoeconomic Center Director. And Josh, you just heard from the new Press Secretary Jen Psaki there, talking about the challenges of that $1.9 trillion stimulus package being passed, but also sort of putting the onus on the Republicans to say, well, these are all things the country needs to address. What do you want to cut? How smooth do you think the process is to get the stimulus in its current form passed?
It's a great question. Hey, Kiko. Hey, Zach. Great to see you. So the answer is it's not going to be very smooth. This is a difficult process. We're talking about $2 trillion or something around that. After we've already spent $4 trillion, you have now a Republican minority, but very thin minority, thinking about how they need to work with the Biden administration, but also talk to their base and think about their path forward. So what the Biden administration offered, as the press secretary said yesterday, was their offer. It's a package. They're open to negotiation. They're bringing in Senator Murkowski from Alaska, Senator Collins from Maine this weekend. They're open to hearing their changes that they'd like to see. And I think the White House was very upfront yesterday, something we haven't heard from the podium in recent years, saying these are our priorities. If you have changes, what would they be? And I think the big pressure point here is going to be on state and local funding. That's where Republicans will want to see cuts, and that's where Democrats see a real priority that's actually been underfunded over the last year.
Yeah, that's been one of the main sticking points, too, in negotiations before President Biden took office as well. But when it comes to kind of the funds necessary out there right now to get the pandemic under control, that does seem to be one area of spend that also perhaps could be agreed upon. What's your take on that in terms of where the money going to that effort might need to grow, considering there have been a lot of questions about what the federal setup looked like under the Trump administration?
Right. So the new COVID coordinator, Jeff Zients, came in today and said, it's not that we have to revamp or restructure the COVID vaccine plan. There was no COVID vaccine plan. And I think if you combine that with the jobless report we saw today, 900,000 on the weekly claims, I think they have a strong case to make that it's vaccinations, vaccinations, vaccinations that are the key, not only for U.S. health, but also for the U.S. economy. And that, to me, is going to be the big difference you see from this administration on their economic messaging. They see the health and the economy deeply intertwined. I think the previous administration saw them as almost countervailing forces. And I think that's the message you're going to hear from the president today when he comes out and finally outlines a national COVID strategy, which I think the markets and more broadly the country have been looking for.
Another issue that we've already seen take center stage here is the issue of climate change. We saw in the initial executive orders that were signed, the U.S. rejoining the Paris Climate Accord, also the president revoking that permit for the Keystone XL pipeline. It feels like increasingly climate isn't just sort of an issue about the environment, but a business issue, an economic one for this administration. How do you see that shaking down? And how do you think Biden makes that case to those who say this is not the time to be focused on something like this?
Well, no, it's a great question. And, you know, I was so struck in Janet Yellen's hearing where she said, we are creating a climate hub within the Treasury Department. And you can bet a lot of people at Treasury right now are thinking about how to operationalize that idea. And so climate is now a whole of government effort. It's the State Department, it's Treasury, it's the Pentagon, and they see it, just like the health concern, as part of the economic revitalization as well. They see it as actually the biggest key to Biden's jobs program over the next 4 years. So again, all of this in their mind is tied together, the four crises as he laid out yesterday. And I just think it's not separating out climate and the economy, climate and health. It's climate and everything together. And we've never seen a whole of government approach to climate. You know, Kerry's going to do this on the international side, but on the domestic side, we'll have Gina McCarthy and others. So it's really a sea change in the way we think about climate and elevating it to a cabinet level role. This is a big change in government, the likes of which we haven't seen probably in 30 years in terms of prioritizing an issue set.
Yeah, I mean, on the climate front, it's kind of indicative of a shift here, as well as, you know, it's not just climate we're talking about, but across the board, issues where Biden has been very different than what we saw under President Trump in making sure the United States returns to a global stage as a leader. Outside of climate, though, obviously, all economies right now are kind of grappling with the pandemic and the response to it. So how do you see maybe the economic response under a Biden administration maybe cohorting with the rest of the G20, other nations out there, our allies, to coordinate what we're trying to do back here at home?
You know, so this is the big question for Biden on the international economic front. And really the question of 2021 from a global economic standpoint is about debt and deficits. And will we basically repeat the mistakes of the 2010s and let debt, deficits, austerity measures take over, which would be smart economic investment policy? And I think, you know, again, Janet Yellen brought this up. It was very interesting in her hearing where she said the key factor is not GDP, you know, debt to GDP ratio, which we always talk about. We're at the highest since World War II. The world is as well. But it's actually interest on the debt. And we're lower than we are now in 2008. And this to me is the key. It's sort of technical, but it's so key. And you could see the senators sort of perking up and trying to internalize this. And so what Biden's going to do is say, we have to make smart investments in the US. And if he can get the $2 trillion package, then he's going to go to the G20 and say, we did it, you should do it too. And what he's hoping is to create a virtuous cycle of spending in 2021 that spills over back into the United States and basically puts the global economy on a better trajectory for the whole decade. This is the big gambit for Biden. Not only can he get the spending at home, can he get it across the world? Not easy to do after a year where we've seen extraordinary fiscal and monetary spending.
Yeah, I mean, how optimistic is that, Vida, when you talk about this sort of becoming the cycle, or that's the hope, at least for Joe Biden? We've already heard grumblings here in the U.S. from some lawmakers who say, look, let's wait until we see the impact from the stimulus package that was passed in December, until we decide to go big yet again.
Right. And this, I think, is going to be the key messaging issue for them. But I think they're sort of buffeted by what's happening in the job market, because we're seeing this risk of a double dip, not just in the US, but the Eurozone as well. And Lagarde spoke to this today in her press conference. And because the winter is so difficult, because of the new strain, because of the uncertainties with the vaccine rollout, I think they actually have a stronger case to make on economic relief than maybe it was even apparent 6 weeks ago. So this is what the Biden administration is saying. It's a very simple message to both the US and the world. Don't risk it. Don't risk going too small. Better to go too big. And this is not an easy thing to message when you only have 50 votes in the Senate, but that's the message they're leaning into. And I think, odds are they're actually going to be successful. And the key thing for them is this is not 2010. And let's not repeat the mistakes of the past. And Biden knows all too well the risk of going too small and the implications for that over an entire decade of economic growth or lack thereof.
Yeah, going big, sort of the overarching theme for Janet Yellen's confirmation hearing a few days ago. We're going to continue to watch this. Josh, always good to get your insight. Josh Lipsky joining us there. Let's turn our attention back to the markets now. Specifically, we are watching shares of Union Pacific right now under pressure, down nearly 4% on the back of its earnings report. Adam Shapiro here to break down the number for us, along with the CEO of Union Pacific. Adam.
Thank you, Akiko. And we do have Lance Fritz, the CEO from Union Pacific, standing by. And Lance, congratulations on beating on the top and bottom line. Stock is under pressure right now, but let me throw out some of your metrics where you achieved in the quarter and also full year. I mean, revenue was $5.1 billion. It was barely down 1% year over year. And 2020 is one of those years that will always have an asterisk. Your net income, the adjusted net income, was 1.6 billion, and you had warned us about the 278 million pre-tax charge you were going to take. So that was up 13% year over year, but it's the operating ratio. That operating ratio in the quarter was a record 55.6%. You attributed that to lower fuel costs. I'm going to ask you a little bit later in this interview what happens when fuel costs go up, but I got to ask you right now, what you see in your metrics, what do they tell you about the future of the economy?
Yeah, Adam, thank you very much for having me on your program. And also, thanks for highlighting just how terrific the fourth quarter was. The women and men of Union Pacific did a tremendous job of overcoming a fair amount of headwind. And while you highlighted fuel costs being down, what really drove the quarter was a bit of growth, 3% up in units, and a lot of productivity, $170 million in productivity. So it was a great close to the year. That postures us when we pivot and look to 2021 for the guidance that we provided this morning. We said we expect growth to be something like 4 to 6% in units. We expect another $500 million in productivity. We expect pricing to be above inflation. And we expect all that to generate 150 to 200 basis points of margin improvement. All in, that's a really good look at 2021.
The reason you're one of our top CEO interviews during quarterly reports is because you are shipping so much of the stuff that is necessary to keep an economy on track. So let's talk about some of the freight picture here. Coal and renewables in full year 2020 for the quarter, at least, that was down. What was it, about 16%? Yet grain and grain products was up 20%. I imagine we're going to consider the grain and food shipments are going to increase going forward?
Yeah, so as we look at the two commodities you just mentioned, we talked this morning about specific headwinds in coal, and that is related to the conversation that happened before I got on in terms of climate change. There's a long-term decline in the use of coal in the United States as a power generating fuel, and that's continuing. And we said, as we look into 2021, we think the decrease in coal shipments might be as much as a 1 percentage point hit to our overall unit volumes. So offsetting that is going to be a pretty strong grain market. And grain right now is about export, and exports about the Chinese into the U.S. market for soybeans. Part of that is they're supplying their own hog farms that have been rebuilt after a big swine flu epidemic that they faced earlier. And also it's about fulfilling some of the commitments they made in the phase one China deal. There's other strength in the economy. We think housing is going to be pretty good. We think the automotive industry continues to recover. What we really are keeping a strong eye on is what the consumer is going to do. Are they going to stay as strong as they are in e-commerce and build off that? And what's going to happen in the industrial economy?
So when you bring those things to the forefront, where I get a disconnect is I'm looking at the stock under pressure right now. And I know of late, there's an article that short interest has increased on the stock. But yet when you look at the 52-week range, your shares have more than doubled over the last 52 weeks. What would you say to those short interest folk who are putting pressure on you right now? And I realize the CEO doesn't want to deal with the day-to-days of the stock market, but what are they missing?
Yeah, Adam, let's broaden that out to just what is the message for our shareholders? And for our shareholders and really all stakeholders, the message is we did a hell of a job in 2020 in a very difficult environment. We improved our operating ratio by a pretty substantial amount with down volume, and we generated $780 million of productivity. When you pivot and look into 2021, we think all three stools of margin improvement and growth are in place. We think unit volume is going to grow. We think we're going to be able to have a pretty decent pricing outcome, and we're anticipating another $500 million in productivity. The story looks good to us as we look forward. Now, whether or not we get some of those guidance items right, whatever the outcome is, we're going to make really good with what's presented to us. If there's greater volume, that's awesome. If there's greater price opportunity, fantastic. If we have the ability to drive more productivity, we will. But net, given the uncertainty of the year and what we're entering, that's how we're looking at the year. And even in that context, looks like a pretty darn good year in 2021.
And your cash and cash equivalents as you go into the year are 1.8 billion roughly. But let's look at some of the 2020 achievements. Your freight car velocity, an improvement of 6%. Your terminal dwell time was an 8% improvement. So it looks as if you go very strong into 2021. Your debt, roughly 28 billion overall, most of it long-term, 26 billion. So that's very manageable. What is the hiccup that might cause you concern in 2020?
Yeah. Well, one thing I want to address, Adam, and you'll appreciate this. We mentioned it, but it wasn't really picked up that strongly. We increased our debt year over year by about $1.5 billion from 19 to 20, and we reduced our cost of debt, our interest, by about 20 basis points. That's a hell of an outcome from the Treasury team. In terms of what we look at in 2021 and what might happen that would be a downside, we need to see the COVID pandemic get under control. That's a predicate. So the talk about that the Biden administration is focused primarily, laser focused on getting vaccines into arms, we think is absolutely the right thing to be doing right now. We also think we need to continue to see global trade continue to grow and enhance. So not just in the United States, we've got to get COVID under control around the globe. And predicated on that, we need to see the industrial economy continue to improve. That's a big mix impact for our business. And it's also got a lot of carload potential just overall. Then the last thing we got to make sure happens is that consumers are healthy. And that speaks to the debate that's going on right now in terms of the next stimulus package and the question of how big and what's required to make sure that consumers are healthy, they continue to stay confident, and they grow in that confidence.
I just want to shift very quickly in my last question to you to the political situation, because you did bring up the Biden administration. Union Pacific has put a temporary pause on all political donations. Why?
Yeah, you just got to look back to what happened on January 6th, and that was a strong indicator to us that things have gone haywire in our political system. So we've made the decision that we're going to pause. We're going to evaluate who and how we distribute contributions to before we get back into the business of helping candidates and elected officials understand what's important to Union Pacific. So that's what that pause is all about, Adam.
Lance Fritz, always good to see you, the CEO from Union Pacific. And Zach, as I throw back to you, one thing that I like to point out to more conservative, risk-averse investors is that their dividend yield is close to 4%. So as an old friend of mine used to say, I'm not mad at that. Zach?
No harm in pointing out strong dividends out there, Adam. Appreciate that. We're going to take a quick break here on Yahoo Finance Live, but when we return, we'll be digging into the incoming administration's plans to tackle the pandemic, what President Biden has on the docket to increase America's efforts in the 2021 outlook there. Stay with us. Welcome back to Yahoo Finance Live. On his first full day in office, President Biden is already beginning a new era of trying to tackle the coronavirus pandemic here in the U.S. Beyond just mandating masks on federal lands and in federal buildings, the president also signaling the re-inclusion of the U.S. in the World Health Organization there, as well as making good, or at least starting to make good, on his promise to deliver 100 million vaccine doses to Americans within his first 100 days. For more on those efforts and perhaps a shift away from what was being done under the Trump administration, I want to bring on our guest today. Dr. Jessica Osterman is emergency medicine physician in Los Angeles. And Dr. Osterman, appreciate you coming on here. Obviously, California right now is a key hotspot in what we're seeing play out as cases continue to rise in the U.S. But I'm curious to get your take on maybe what you're seeing through those first executive actions from President Biden in a way that it might signal a very serious shift to tackle the pandemic here in 2021.
Yeah, I think I speak for a lot of my colleagues when I say that we're very excited to see a coordinated federal effort moving forward to kind of regulate distribution of vaccines, testing across the country, as well as some strategies to reopen schools and businesses. And I think we've all really been in search of sort of a coordinated federal effort that can trickle down to the state level. So I'm really excited to see what Biden's done today.
There's been a lot of confusion around vaccine rollouts across the country, particularly in California, though. Gavin Newsom a few weeks ago saying that, look, hold me accountable for administering those 1 million doses initially. Now there's reports that because of some technical issues, it's hard to track how many actually got those vaccines too. Can you speak a little more to what's happening on the ground there? Do you have any more visibility on what the availability of the vaccine is in the state?
Yeah, I do think at least in LA County, the rollout of vaccines has been a little slower than we expected. I think we are at a good level at this point in getting our healthcare providers vaccinated. But I think kind of that 1B rollout has been a little bit delayed because the healthcare vaccination strategy has taken a little longer than expected. But I'm hoping, as I say, with a more coordinated effort from both the national and the state level, we can really get back on track and start rolling out these vaccinations at a higher speed to get the population vaccinated and safe from this coronavirus pandemic.
Yeah, and to Zach's point that he made earlier, California, certainly Los Angeles County specifically, has really been the epicenter of this pandemic or this most recent surge. There's been a lot of talk here about the new variant that was found in this state. How much of that do you think contributed to really what was those deadly numbers that we saw back in December that seemed to finally be tapering off just a little?
Yeah, I'll tell you from my clinical standpoint, I think that the variants that we are seeing circulating around the population now are quite different and more infectious than what we were seeing at the beginning of the pandemic. We're seeing a lot of younger, healthier people that are much sicker than they were back in March and April when this all started. And as you guys have seen the numbers, probably they're saying that about 1 in 3 Los Angelinos are infected with coronavirus at some point. So whatever is out here is definitely spreading faster.
Yeah, and just kind of looking ahead here to what you were talking about in the federal response, coordinated federal response. It was interesting to see Pfizer tell a number of news outlets today that they would be open to coordinating with specific states in rolling that out. Of course, that's something that in New York, Governor Andrew Cuomo had been pushing for. When it comes to maybe that shift, though, there are a lot of people in the medical community that look back to kind of what happened with ventilators and how that became what some people described as an eBay, with all states competing to get those in limited supply. Is that a concern as a doctor that might be out there when you think about the rush to get all these vaccines to Americans?
Yeah, absolutely. I do think that when you put it on individual states to reach out and try to obtain these vaccines and distribute them, you are dealing with inequalities based on individual state governments, individual health departments. And so I do think that there needs to be something, at least from the federal level, that states can then implement. But I think there needs to be a federal strategy first for obtaining these vaccination doses and then distribute to the states equally.
And Doctor, just going back to what you're seeing on the ground there, how have things shifted over the last week? If you look at the numbers specifically, it feels like there's at least a leveling off. The numbers are still high in terms of case counts, hospitalizations, and deaths. But what are you seeing in your hospital?
Yeah, we are seeing the number of patients total coming in going down. I think people are actually taking this seriously now, given how infectious this current surge is. And they are staying home. They're not coming to the ER for things like medication refills and for medical complaints they've had for a long period of time. But we are still seeing mostly coronavirus patients come in, and we are very overloaded in the hospital in terms of ICU beds. As I mentioned before, a lot of these patients are much sicker, requiring ventilators and ICU level care, and we just don't have that capacity in the hospitals that I'm working at. So a lot of those patients are continuing to board in the ER, which is really just backing up the whole system.
Well, I mean, the idea of maybe potentially cases finally leveling off would be very welcome and very good news for everyone here. One of the other key positive, I guess, silver linings from all of this, with people wearing masks and social distancing, that caught my eye, was the drop in flu cases, which is kind of shocking when you look at that in where we are. in this pandemic, comparing this year to years past, cases are shockingly low, almost at zero here. I'd be curious to get your take on that, doctor, as maybe being, one of the positives to come from this is people might in the future, if we have to get vaccines and booster shots here, tying it to coronavirus might actually increase the idea of Americans going out there and getting flu vaccines.
Yeah, absolutely. I think as healthcare providers, we were all kind of dreading this winter because of the convergence of the potential flu cases and COVID cases. But at my hospital, actually, we haven't had one flu positive report from our lab, which is really shocking and fantastic to see, because it does show that having flu shots, wearing masks, washing your hands, and generally taking those public health measures really do make a big difference. And if we could see the flu decrease like this every winter, I would be thrilled.
Yeah, it's nice to at least end on a positive note on that front. Dr. Jessica Osterman, emergency medicine physician in LA. It's good to talk to you today.
Thanks so much.
Coming up, breathing in and breathing out. If you are like me, you've probably been listening to that calming voice in popular meditation app Headspace. Co-founder Andy Puddicombe will join us to discuss the booming business around mental health. We'll be right back. Downloads for mobile mental health apps have surged during this pandemic as the COVID-19 pandemic takes a psychological toll on people. That has led to a boom in business for Headspace. Let's bring in the co-founder of Headspace, Andy Puddicombe. We should also note that he's also a former Buddhist monk. Andy, let's talk about the growth that you have seen, though. Walk me through some of your numbers here. Early on in the pandemic, of course, there was a lot of attention on Headspace. Clearly, you have sort of expanded beyond the app now.
Yeah, I think, early on in the pandemic, I would say even if you go back, rewind to sort of March and April of last year, we saw downloads sort of double overnight. And a huge amount, as you say, a huge amount of attention, I think, recognition that it wasn't just physical sort of illness that people were in danger of. A lot of people were struggling kind of with their mind. And we saw that extend sort of beyond just sort of the consumer base as well, right through into sort of B2B, for example, and business organizations looking at how they can better look after their team members when they're at home, often in very sort of challenging situations. So we've seen across the whole sort of business quite a big increase over the last 12 months or so.
Yeah, there's no shortage of reasons here in the pandemic to focus in on mental health and really try and meditate. And obviously, the benefits out there have been proven in certain studies. But when you think about the increasing competition, I was shocked to see one I guess, article looking at more than 2,500 apps launching since 2015 to focus in on the meditation space. What is it that you at Headspace do differently to maybe help people on that journey?
Yeah, it's amazing. When we started back in sort of 2010, and we launched the app in 2012. And at that time, there were no other meditation apps, and I hear there's over sort of 5,000 now. So you're right, a lot of sort of attention in the space. We decided very early on to focus on two things, and that's authenticity and science. We feel that we didn't come up with these things. Meditation's been around for sort of 2,500, 3,000 years, and we look at that as R&D, and that's a lot of R&D. And it works because it's sort of been, that authenticity's been sort of looked after over the years. So we try not to mess with that too much, but at the same time, we try and give it additional sort of credibility by sort of measuring the scientific benefits of meditation and mindfulness. So we have over 75 sort of clinical trials in process. 25 are already completed and have been published. But for us, that's a really important thing, to try and bring together kind of that, as I say, that authentic sort of essence and mix it with sort of modern day science.
Yeah, it does feel like there has been a real shift in the way at least Americans look at meditation and how effective that is to the way we live every day. You've already got a Netflix series out as well. Where do you see the business going from here? The app, as popular as it is, I imagine isn't where you plan to end Headspace.
Well, I mean, I think like all of these things, like our vision was to improve. We set out to improve the health and happiness of the world. It's still our North Star. The app is obviously an integral part of that. It allows us to reach an incredible number of people around the world. The Netflix show was really exciting because I think, when we first launched, people were like, really? Meditation on your phone? But isn't the phone stressful? And in the same way, when we launched on Netflix, it was like, really? Meditation? Isn't that just, on entertainment platform? How can that work? And what we discovered is that it's reached a huge number of people in the same way that when we launched on the phone, it was meeting people where they were. In the same way now, through Netflix, we're meeting people where they are. And we'll continue to do that. I think where you'll probably see the biggest shift is within healthcare. So we have a big science and health team, and they're working to sort of integrate Headspace fully into sort of medical environments to ensure that we get to a stage where sort of meditation is democratized, where anyone can get access to it. And hopefully in the future, people will even have it paid for by their healthcare insurance.
Yeah, I could see that happening. I mean, for someone like me who maybe hasn't, been attached to the meditation space, we've had Deepak Chopra come on the show a number of times. He's personally tried to help. There's obviously the apps like Headspace out there. There's podcasts now. There's a lot of things. For whatever reason, very difficult for me to get involved. But when it comes to maybe the surprises that you've seen since the space has grown, what has shocked you the most? Is it kind of the people who maybe hadn't focused in on meditation now being drawn into this? Is it the money that's now attached to this space and investors finally embracing meditation for what it can be? What to you as the founder of Headspace stands out?
It's a great question. I think the efficacy hasn't surprised me. I'm really happy to see the science kind of catch up and to prove that there are kind of very real benefits. I think that the surprise is more the sort of the background. It's not just meditation. For me, this is about kind of the health of the mind, and it's sort of the health of the mind catching up with the health of the body. We've had decades where we've talked about how important it is to look after the body. And yet we've kind of ignored how important it is to actually be happy internally, regardless of how healthy we are on the outside. So I think it's that commentary and seeing it's more sort of socially acceptable now for people to talk about their internal struggles, to have permission maybe to talk about struggling with sleep or feeling anxious or feeling stressed. And I feel like that's the starting point. Unless we can talk about those things as a society, as a community, then nothing really changes. So that's the thing that kind of makes me happiest. And hopefully that's a trend that will continue on.
And Andy, you said earlier about integrating Headspace into the medical space. What exactly does that integration look like? What are some of the conversations you're having around that?
Yeah, so right now, for example, in fact, a good number of our referrals come from doctors or from therapists. The difference is that right now, sort of consumers pay direct for that. I think in the future, and we're already kind of partnering with some large health insurance companies, but in the future, I think there's the potential for that to be covered by your health insurance. But also to have it part of a system of care. So we've chatted with hospitals about when patients go in for surgery, for example. How could we best prepare a patient for surgery in reducing anxiety, in making sure they feel better prepared? Likewise, on the other side of that, when they're recovering, how do we help to create the most conducive conditions for recovery? So, it's an interesting space, right? You're lying there in hospital. You actually can't do a huge amount. And it's very easy to just look for distraction when actually we could use that time to actually improve not only the health of the mind, but actually to increase the speed of recovery in the body as well.
Yeah, a lot of people finding themselves with more time to do just that. But Andy Puddicombe, Headspace co-founder, appreciate you coming on here to chat that today. Maybe I'll go ahead and give it another try after we wrap up here. Thanks again. Gonna take another quick break here on Yahoo Finance Live. But when we return, digging into that rotation we're seeing play out from small caps to mega caps, back from the dead. We'll chat that with Jared Blickery right after this. Welcome back. We still have the Dow in the red here, but while that's playing out in today's session, we're also seeing noted strength among the FANG names, all of the FANG names in the green in today's session. That's something I have not been able to say for quite some time. I want to bring on Yahoo Finance's Chartmaster and Jared Blickery for more on that rotation we're seeing play out away from the small caps. Jared?
That's right, day two. And let's take a look at the market action here. A lot of red on the world indices, but not in the NASDAQ. We can see that's still up 36 basis points. And it's been this rotation over the last 2 days into the mega cap names. So let's take a look there. We can see Apple's up about 2%. And I'm having a little bit of a technical difficulty, so I might not be able to change the boards here. But I do want to mention that over the last few days now, we have seen this rotation out of small caps that we're talking about. Not much movement in the bond market, and it looks like I have the touchscreen back here. So let's put that back. We can see over the last 2 days, some of the names that stand out here: Apple up over 6%, Amazon right there with it. Alphabet also up 6.5%, even Facebook climbing back. It is now in the green for 4%. And here's the sector action for today. You can see the only 3 sectors in the green here. The outperformers are those FANG sectors. So consumer discretionary, that's Amazon, that's in the upper left. Tech, that has Apple and Microsoft, and communication services, which is Alphabet, Facebook, and Netflix, that's up as well. Now to the downside, real estate and energy are the biggest laggards. Energy is off about 2.5% now. Now here's the Dow, and we can see a lot more red, not concentrated in those big names to the left, but we're seeing financials underperforming. JP Morgan is down 1%. And so this is really a reversal underway here from what we saw, prior to the inauguration day, guys.
Jared, I know you're watching Bitcoin closely as well. An 11% pullback today, 2-day sell-off, wiping out $100 billion from the crypto market. What's going on there?
Yeah, pretty soon this starts to get to be real money. You can see here's the intraday price action from midnight UTC, and it's from the upper left to the lower right here. But you take a look at what's happened over the last month, and I pointed this out yesterday. We had been consolidating, and we saw the beginnings of a breakdown of this pennant formation yesterday, and we're really just sinking towards this price level, this big round number, which is 30,000. And it's pretty incredible that the market was consolidating between 30,000 and 42,000 up here. Now, if 30,000 goes, probably looking at 25 or even 20,000 to the downside. So could be some more volatility and pain out there for the hodlers.
Yeah, those who've been holding long know the pain, but also the rewards that come with the long hold. All right, Jared Blickery, thanks so much for that. Coming up, antitrust enforcement under new leadership at the Department of Justice. With Attorney General nominee Merrick Garland leading the helm, where does that leave the crackdown on big tech? We'll discuss after the break. Welcome back to Yahoo Finance Live. Critics of big tech are urging the Biden administration to stay the course on antitrust cases in the face of some notable exits at the Department of Justice. This coming, of course, as Attorney General nominee Merrick Garland takes the helm at the department. Let's bring in Alexis Keenan for that story. And Alexis, when we talk about notable exits, one name that's really stood out, and that is the Assistant Attorney General of the Antitrust Division now exiting. A lot of concern about whether, in fact, that hard line will continue.
Yes, Akiko. And so it's starting to shape up, at least with that nomination of Merrick Garland. Of course, still waiting to hear on his Senate confirmation, and also outgoing Antitrust Division Chair Makim Delrahim. He has stepped down as of the 19th. And so that position is going to be incredibly important as well. But a lot of handicapping going on to try to predict the influence that a Merrick Garland would have on industries, especially big tech. And so far, of course, the department under President Trump has filed an antitrust case against Google and also has those investigations ongoing into suspected antitrust conduct by Facebook, Apple, and Amazon. And then Google has those 2 additional lawsuits brought by states' attorneys general. And then, of course, the FTC also weighs in this equation, having filed already a case against Facebook, and they are continuing their investigation into Amazon's practices. Now, in talking, though, with both practitioners as well as former DOJ prosecutors and also academic experts, all who specialize in antitrust, the consensus that I got from those folks is that these tech companies can really count on a very tough yet fair opponent in a Merrick Garland should he be confirmed. For one, they say that he brings a judge's perspective, and that will really help narrow these allegations down into allegations that he deems winnable. Also saying that Merrick Garland, as a federal prosecutor, former federal prosecutor that is, and having spent a career in government, now as a circuit appellate court judge, that he will be perhaps sympathetic to the law enforcement view of the world. Also, he taught antitrust at Harvard, his alma mater. And so that really gives him a kind of subject matter expertise that isn't always the case with an attorney general, who's oftentimes and is called upon to be a real generalist across all areas of law. Still, though, that greatest influence will probably come from the new head of the Antitrust Division. One name that's been dangled out there, Renata Hesse, has been objected to by some anti-monopoly groups. They oppose her as someone who has already advised big tech companies, Amazon and Google, and saying, you know, maybe that's not the right fit, because as we had with Delrahim, he had to recuse himself from the prosecution of Google, so couldn't even be involved there. Akiko?
Okay, Alexis, certainly concerns also about Rohit Chopra exiting the FTC too, because he has been quite critical of Facebook. Zach?
Yeah, well, it's one of those issues we're going to keep tracking here. Obviously, President Biden has stressed the response to the coronavirus pandemic, number one. But once we get into the heat of his administration, we'll see some of these things come through. Going to take another quick break here on Yahoo Finance Live. When we return, breaking down the big push here in the moves in the market as we see those mega cap stocks continue to lead higher. Facebook in the green, though. Note the lone exception here to note there being Netflix in the red. We'll be right back after this. Welcome back to Yahoo Finance Live. The NASDAQ remains the big winner today, and the Dow still in the red. Want to highlight a couple movers here, as we are seeing United Airlines trade significantly lower today after they reported earnings yesterday. The stock's off nearly 7% after we got the updates from the CEO on the call this morning, mentioning a few things, including some significant cost reductions due to the pandemic. For more on that, I want to get to Yahoo Finance's Ines Ferre, who has the latest for us. Ines?
And Zach, the airline is hoping to cut about $2 billion in annual costs through 2023 as it's making its way through a recovery. But really, management is saying that given the spike in cases, first quarter revenue is expected to remain down 65 to 70%. You can see UAL this morning down about 6% on our Wi-Fi Interactive board. Also, United Airlines, Jerry Latterman, CFO of the company, said that before COVID, we modeled our worst case scenarios based on the financial impact of 9/11 followed by a recession. It turns out we weren't even close, he said. You can see this year chart 1 year back down 50% over the last year. Taking a look at some of the other airlines this morning, we're also seeing, of course, American Airlines down 2%, Delta Airlines, so really dragging down the travel segment as a whole. Looking at the NASDAQ, where we're seeing a lot of the action this morning, we're seeing that Apple is up more than 3%. Bloomberg came out with a report about Apple's VR headsets set to arrive as soon as next year. Reportedly, those would include a fabric design and also a fan and also support prescription lenses, a hefty price around $1,000. And then also, I just want to mention Amazon, which is up about 2%. Its price target was increased to $4,000 at Bank of America. Zach?
Yeah, quite the upside call there on a strong day for the FANG names outside of Netflix. And Esfer, I appreciate that. Going to take another quick break here, but on the other side, breaking down the expectations for the Biden administration on the labor front. We'll chat with one of the largest, the leading union group here. The leader of that union will join us on the other side of the break. Stay with us. Welcome into Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita. We got stocks taking a bit of a breather here today after the big inauguration day pop in the first full day of Joe Biden's presidency. President Biden wasting no time to take in signing executive actions that span everything from renewing the fight against climate change to battling COVID. But where does he stand on labor? We'll chat that with the leader of the largest federation of unions in the United States, the president of the AFL-CIO, Richard Trumka, will join us. Plus, we all know cannabis stocks have ridden the blue wave to new highs, but what does the rest of 2021 look like with serious reforms ahead? The CEO of one of the largest cannabis companies in the U.S., and Trulieve, will break that down for us later on in the show. But first, we want to start off the noon hour here specifically with the task at hand for President Biden following last night's Celebrating America inauguration closeout show, which culminated in Katy Perry singing Firework as fireworks exploded over the National Mall. I mean, Akiko, I don't know about you, but it was quite the sight to take in. And I want to chat now with Yahoo Finance's Rick Newman for more on moving past the celebratory phase and getting into the teeth of the work ahead. And Rick, I mean, when we look at this, obviously, President Biden made very clear that priority number one is going to be reeling in the pandemic. But when it comes to how he's going to be able to achieve that, what are we seeing in his first actions?
Well, yesterday, of course, Biden signed those 17 executive orders. By my count, only one of those was on the pandemic, and that was appointing Jeff Zients, who was kind of a wonder kid in the Obama administration, to head the pandemic efforts. But Biden's got more executive orders coming today on the pandemic, and he's going to do all the things that many critics of President Trump's response to the pandemic said we really need to do, which is a full mobilization of federal resources to address this problem. So Biden's he's bringing in a lot of people, former FDA Commissioner David Kessler, Andy Slavitt, a public health expert we've had on our air many times. And he's just putting everybody he can get into this problem of getting vaccines rolled out as quickly as possible, getting states and cities help. They need personnel to help distribute the vaccines and actually put shots in arms, more testing. What more resources so schools can open more quickly, and all these things. So his sort of tagline here is 100 million doses in 100 days. So since it requires 2 doses, that's 50 million Americans vaccinated within Biden's first 100 days. And we are going to find out if all the people who criticized President Trump's response, which was basically decentralize it to states and cities, if they were right, if this is actually going to make a difference.
All right, Rick Newman, appreciate you bringing us that. I want to extend the conversation here on that front with the idea and the focus here in on labor. Of course, frontline workers obviously very much wanting to see an increase in the seriousness in which this country approaches the coronavirus pandemic. And for more on that, I want to bring on the leader of the largest federation of unions in the United States, the president of the AFL-CIO, Richard Trumka, joins us once again. Mr. Trumka, good to have you back on with us today. Of course, Thanks. You guys endorsed Joe Biden for president back in May. We've come a long way since then. You were on with us just as President Biden was winning the election, and you made it pretty clear that a lot of workers out there felt abandoned by President Trump. So what are you going to want to see President Biden flex on the issue of labor? And I know you just spoke with him a few days before inauguration. So what are your expectations having connected with him?
Well, first of all, Zach, let me say this. I think workers woke up with hope in their heart today because dignity and humanity and optimism and compassion have been restored to the White House. Yesterday was a good day. But look, here's what we need to happen. We need some bold and decisive action to address the inequality of income, the inequality of opportunity, and the inequality of power. We need Democrats and Republicans to work together to get the pandemic under control first, to keep workers safe, to make massive investments in America's infrastructure, and then get rid of our antiquated labor laws that have prevented workers from getting fair wages and benefits and economic security. We think that the Biden administration is committed to that, and we're committed to working with them to make sure that that becomes a reality.
And you've got a potentially big ally in the cabinet there if, in fact, Boston Mayor Marty Walsh is approved or is confirmed as the labor secretary. He's a former union member. What conversations have you had with him? And how do you think having a former union guy in that post increases the likelihood of some of these reforms that you just mentioned getting passed?
Well, first of all, Marty, for the first time in recent history, the Secretary of Labor is going to have standing inside the cabinet. Also going to have standing up on the Hill with Democrats and Republicans alike. Marty carried the tools, so he knows what workers need. We don't have to go and tell him everything. He understands that, and he comes with a strength and a clarity and a power that most other people don't have because he was a worker. We also understands how to get things done. He was mayor of Boston. He knows how to work with people of both sides of the aisle. He'll do that. The most important thing is, I think, though, he has the ear of the president and the respect of the president. And now a worker's voice will be at the cabinet and it'll be heard loud and clear because one of us will be at the cabinet speaking at all times.
Yeah, Mr. Trump, as I said, you were critical of kind of the lack of protections in place before. You said OSHA has become a cadaver last time we chatted here. I'd be curious to get your take on maybe what protections you want to come see through here as we keep, hearing the Defense Production Act being flexed here, more concerns as cases continue to rise. So what protections do you want to see in the early days?
Well, first of all, I think we need a emergency pandemic standard. The administration is committed to getting that done so that we have enforceable standards on the job. Second of all, they're committed to using the Defense Production Act to get enough PPE on the jobs to protect our members. And then third of all, they're committing to helping us get flex grants to the states so that the states can actually help us at the job level. Our employers, if we work together with them and we work together with the state and local federal governments, I think we can get this pandemic under control. We can get the economy running back again, and we can protect workers in the process. President Biden is committed to worker health and safety. He knows that it's more than just coming home from work. If you come home from work sick, you've failed. So our job is to make sure that those essential workers not only come home from work safe and sound, but they're healthy as well.
Richard, you're talking about wages and benefits, but of course, safety, another key issue here that has emerged, especially for these essential workers you talked about. Where does the union stand right now on mandatory vaccinations? That's something a lot of companies are struggling with, whether in fact they should require their employees to get it. What do you think about that? Where do you stand on that conversation?
Look, we're going to encourage everybody to get vaccinated. That's the solution to all of this. If we vaccinate people, we really do get to the place where we can get the pandemic under control, and then we can actually move our economy forward again. We can create the jobs that have been lost. We can change the rules so that everybody wins in this economy. But it starts with vaccinations, and we're going to be for getting everybody vaccinated that we can. It's a complex issue when you come to mandating it. Should it be mandated at the federal level? Should it be mandated at the state level? Because if you go just employer to employer, you're going to get a high and a low there that may not be the best way to do it. So we're looking at it, we're working with the administration, and we're going to work with our employers to make sure that we can get everybody vaccinated as fast as we can.
Let's talk quickly about big tech. This is one of those sectors that have long resisted organization among their employees, and yet earlier this month, we had Google establish its union, the Alphabet Workers Union. We're talking still a very small part of the work base. So not necessarily the same kind of unions that we would think about traditionally. How does the AFL-CIO see, how do you see your role in helping facilitate some of these conversations? And have you had direct talks, at least with Google's union?
Well, first of all, we need to change the labor laws in this country because they're antiquated. They were drafted back in the 70s, and instead of helping workers get better wages and better benefits and job security, they're used to lower wages, take away benefits, and take away economic security. So first thing we have to do is change those laws so that they're modern, up to date, and they apply to people. like Google and Facebook and all the others in the tech sector. Second of all, we have had conversations with them. We want to work with them. We think that we can help them be better companies, better run companies, and we can help their employees. And I can tell you this, their employees sure are interested in having a voice on the job, because they've been getting ground up by those high-tech companies, just like they got ground up by coal mines back at the turn of the century. They don't get listened to. They don't get a fair shake. They don't get the security that they're entitled to. So we're working with the employees to make sure that they get a voice on the job as well.
Well, Richard Trumka, I appreciate you coming back on here. Again, just to maybe put an exclamation point on it, interesting symbolism of seeing President Biden also add and feature the bust of one of the nation's most celebrated labor rights activists in Cesar Chavez in that office. Very interesting to see there. Love to have you back on whenever you're free to continue this conversation, but thanks for joining us today.
Zach, anytime you want me on, give me a shout. I'll be happy to come back on. Take care and stay safe, my friend.
Right on. Likewise. Appreciate it. Also want to shift our attention back here to the market action we're seeing play out as we've been highlighting today. A bit of a rotation here away from the small caps back into some of those beaten down FANG names. So is that trend expected to continue for the rest of 2021? I want to bring on our next market guest here. Sean Cruz is TD Ameritrade Senior Market Strategist. He joins us again here. Sean, good to be chatting with you. I mean, this is something that's interesting as we get further and further along in earnings season. Of course, we saw a few beats. Netflix could perhaps maybe be the trigger for maybe some of these renewed looks at the major FANG names. So talk to me about what you're seeing play out right now.
Yeah, I think no matter what sector you're looking at here for the upcoming earnings season, forward guidance is going to be critical really to how investors respond in terms of either buying the stock or maybe selling it and finding a better place to park their investment dollars. And Netflix was a great example of that. And so if you look at some of the stocks that performed incredibly well throughout 2020, it's what do you call it, the FANG names, the stay-at-home trade. The question on a lot of investors' minds is, was that as good as it's going to get? Did you pull forward all the growth you're expecting for the next year or two, and in some cases 3 years, all into 2020? And we shouldn't expect as much growth moving forward. Netflix gave an example of one. There's still plenty of growth markets out there for them, and that's why they came in on the international front incredibly strong. They're able to improve profitability, and I think profitability is going to be key, because one thing a lot of these companies did over the course of the past year was very similar to what they did during the financial crisis, and that was really clean up their income statements in terms of expenses and optimize things on the expense front to sort of improve, at least protect margins, I should say. So the question now is going to be, is what you've done to clean up your margins, is that going to really put you to a place where you can continue to grow earnings moving forward? So that's really going to be the catalyst for a lot of these companies. And I think even if you look at small caps, the question is going to be, are you in a good place to benefit from any sort of stimulus or infrastructure deals that are going to come as well?
Sean, we're getting a clearer picture of what President Biden's legislative priorities are going to be, at least in the first 100 days. Give me some specific names here that you're watching that you see as big beneficiaries on the back of it.
Yeah, so I'm looking at maybe some of those names that were on the forefront of a lot of the trade tariff back and forth that we heard over the past couple of years, to see if any changes in policy maybe affect those stocks. You can think of companies like Caterpillar, companies like Boeing. You could even look at some of those tech names. That's really what I'm looking for from the administration in terms of on the international front. If you're looking domestically, I think you want to look at a lot of those industrial companies that are highly levered to the U.S. economies. And you can actually, U.S. economy, you should actually look at not just industrials, you can look at material companies as well. If we do get a lot of infrastructure spending, that can benefit those companies, as ultimately they're going to be the ones that are doing the work here. And then also you can maybe even look at some of those renewable energy type of plays, the electric vehicle market. A lot of those companies have done incredibly well, as the infrastructure is certainly expected to incentivize investment in those areas, on top of just more general roads, bridges that we're also used to.
Yeah, on the topic of maybe that trade-off in some of these stocks that have been beaten down due to the pandemic, interesting to see the moves we're seeing play out in United Airlines today. after we got the update from the CEO kind of stressing how some of this is going to be in place for a while, permanently reducing the cost structure by $2 billion a year and projecting a longer recovery for some of these. All major airline stocks in the red today, Boeing down in kind. So, I mean, what do you think about maybe the thesis that piling into some of these beaten down companies would be the best scenario or best strategy for 2021? Do you think that now is facing some dents?
Yeah, I think there's a saying in hockey, sort of skate to where the puck's going to be, not where it is. So if you want to position yourself for some sort of a recovery, and there's a lot of dispersion in terms of where economists and analysts expect that recovery to occur. Is it going to occur very quickly here in the first quarter? Is it maybe going to take a little bit longer to play out? But no matter what, I think the expectation is at some point over the long run, we will get back to what we expect to be business as usual. For the airlines, it's really going to be a matter of lifting restrictions and also consumer sentiment and how consumers are feeling about getting back to traveling. The one thing I will say, a lot of these airlines almost adjusted their business models to make up for the drop in passenger traffic and went into cargo deliveries, adjusted their fleets, modified their planes to be able to do that. And I don't think they're just going to completely move away from that. I think that's going to be part of the business model as it evolves moving forward. And that's going to have different implications for margins, going to have different implications for revenue growth. So I think as we see how these airlines recover, when we do start getting passenger traffic picking up, I think that's going to be a big tell of sort of who's going to maybe stand to benefit within the airline sectors. The Southwest is not going to recover to the same extent a United or Delta might, at least at first. But I think you're going to want to pay attention to how that changes as we start to recover. There's going to be different business models between these airlines, and you're going to want to make sure you're almost a stock picker in that regard.
Yeah, and all those airlines, we're seeing red across the board in that sector. It's certainly been a bumpy ride for those companies over the last year. Sean Cruz, TD Ameritrade Senior Market Strategist. Good to talk to you.
Thanks.
Coming up, improving transparency in the food supply. A CEO of Vital Farms is going to be joining us to discuss what his company is doing to address the increased scrutiny about the safety of our supply chains. We'll discuss after the break. Outbreaks at food processing centers early on in the pandemic have increased calls for more transparency in the food supply chain and stricter safety measures. We've got the CEO of Vital Farms joining us today, unveiling a new campaign that stresses ethical food production. Russell Diez-Canseco is the CEO. And Russell, let me just start by talking about how significantly you have seen the shift in this space, because it does feel like there have been more eyes on the way our food gets to our table. How does that fundamentally change the way that you operate?
Well, thanks so much for the question, and thanks for having me. So the first thing I'd say is that I actually think that it's a secular shift toward people being more conscious of their food choices, wanting food to reflect their values, and frankly, wanting to feel more confident in where their food comes from and how it's produced. And so it's the entire reason we have the right to exist and succeed in the markets in which we play, because we are a transparent brand and we bring transparency to what we do. And I think our consumers and our raving fans have really appreciated our approach to that.
Hi, Russell. It's Ali Canal here. So we've seen this shift into veganism, plant-based options, companies like Beyond Meat, Oatly really capitalizing on this trend. And it's one trend that doesn't seem to be going away anytime soon. So I'm wondering how you think that's going to affect the outlook of your business.
Yeah, great question and great brands that you mentioned. You know, I think brands that like the ones you mentioned and we are all trying to solve similar problems with our industrial food system, especially in the United States. We're trying to find ways to reduce the environmental impact on food production. We're trying to find ways to improve the unsatisfying animal welfare impact of the way we produce food in this country. And so I have a ton of respect for the work that those companies are doing. We're approaching it in a different way, but I think we're all trying to solve the same unmet needs in the marketplace.
To piggyback off of that, do you see those companies as competition for you guys?
There's so much industrial food to be disrupted in this world that I welcome the day when I feel like I'm going head to head with the brands that you mentioned, but I think there's a lot of room between now and then.
And Russell, you were just talking about just this increased scrutiny really on our food supply and the impact that it's having on the environment. Certainly there's a lot of people who are on board with the idea, but does that come at the cost of affordability?
You know, we are at historic lows in this country in terms of the percent of our income that we spend on food. And unfortunately, there's only one place to go from there. Unfortunately, the impact on the environment, the impact on the small family farms who generally kind of lose at the end of the movie in this country, those things have to be reversed. Those are not sustainable for the resilience of our food supply chain and for our country. And so, you know, doing things differently does come with a cost. What we found is that we are able to do things that really matter to our stakeholders, especially our consumers, and they reward us by being willing to pay more for the products we bring them.
Yeah, and Russell, I wonder how much of that kind of stems from the earlier days when the pandemic first hit, and people were panicking about the idea of maybe not having eggs or butter on the store shelves. What did you see in maybe retaining some of those customers that gave you a shot when you guys were one of the companies on the shelf, and how you've been able to retain them this far along in the pandemic when hopefully we're beyond a bit of those supply concerns now?
Yeah, I really appreciate that question, and it's certainly one that's top of mind for lots of folks. First of all, we were growing really fast before the pandemic, and certainly like many food companies, we saw an acceleration of that as more people ate at home and to some extent continue eating at home. I think two things I'd call out here. One is that if you look at the difference between the egg category overall and specialty eggs, which is the segment in which we play, overall for 2020, egg category grew 18.7% for the year, but has decelerated in Q4 to about 10%. Whereas for specialty eggs for the year, they grew 25.5% at retail, and it's decelerated to just 21% in Q4. So I think that's a great indication of more of a secular shift toward premium products, especially in this very commoditized category. The other thing I'd call out is that we attracted 440,000 new households during the stock-up weeks of March and April of 2020. And our analysis shows that about 20% of those households bought us multiple times
in the following 20 weeks when presumably their preferred brand or their original preferred brand was back on the shelf. And so with very little marketing or trade spend, we attracted and looks like retained a big chunk of new households that were excited to engage with our brand.
That's awesome. And this summer, you guys launched Vital Farms Egg Bites. You partnered with King Arthur Baking Company for a holiday kit. Do you see yourself going in this direction, more product rollouts, possibly more meal kits, especially as this pandemic is sort of slowing down in-store shopping?
Yeah, innovation is a key part of our growth strategy, although I'll tell you, we're still just barely scratching the surface in the big categories in which we play today, which are eggs and butter primarily. And so we'll continue to drive growth in those as we attract more and more households to our brands, and we continue to attract more and more retailers. But beyond that, Egg Bites were a great example. It's our first multi-ingredient product. We never made a recipe like that before. And so far, the launch has been terrific. We've added hundreds of retail outlets in 2020 and continue to focus on growing out distribution. And the consumer response has been tremendous. So yeah, we'll continue to invest in new categories that we'd like to bring products to the market in.
All right, the CEO of Vital Farms, Russell Diez-Canseco, alongside Yahoo Finance's Ali Canal. Appreciate you joining us today, sir. Be well.
Thanks so much. Take care.
All right, I want to shift over back to our focus here on the cannabis sector. Of course, it's early days for the Biden administration, but cannabis investors and companies are already looking forward to federal level reforms that could come later on this year. Last week, Florida-based Trulieve filed paperwork with the SEC in preparation for a possible uplisting on major exchanges, and other peers have been jumping in as well. Mainly, M&A activity has been picking up. We saw a U.S. operator based in Chicago, Cresco Labs, buying Florida cannabis company Bluma Wellness. For more on what to expect from the cannabis sector in the first year of the Biden administration, I want to bring back on the CEO of Trulieve, Kim Rivers, joins us right now. Kim, good to have you back on. Always love chatting with you. When we look at it, I mean, you guys just opened your 77th nationwide store this morning, so congrats on that. But first, what's the timeline you're operating with when we think about when these reforms should be expected?
Yeah, great question. I unfortunately don't have the cannabis crystal ball here with me today. But what I can say is that certainly, I think as we wake up, as many folks have indicated, this morning is a morning that's filled with hope and optimism. I think in the country for a lot of reasons, but certainly within our industry. And we fully expect that cannabis will reach kind of that next phase, which is the substantive discussion phase and the policy phase. I think up until this point, it was a very bifurcated question in the legislature. In Congress, it was either are you for cannabis or against cannabis? And now I think that we'll have the opportunity to actually dig into that next very important level of policy discussions, which of course are very nuanced and very specific. But we very much look forward to that next stage of discussions. I think that in terms of if I had to guess in terms of an order of what to expect, I certainly think that safe banking, which I know we've talked about before and has been on the table for quite some time, and that piece of legislation has passed 3 times out of the House under Speaker Pelosi. And so we would hope that to see safe banking included again in the House version at the very least of the next package to address stimulus. So we're hopeful that in the next 30 to 60 days, we could see safe banking pass again out of the House as part of that stimulus package and onto the Senate, which of course all eyes will be on this new Senate and how they move and how they work together. And hopefully we'll have, again, with that stimulus bill passing, the first meaningful piece of cannabis legislation actually, get approved in this country, which of course will be a watershed moment. That will lay the groundwork for additional discussions and with respect to, broader based reform, which we could see that ramping up, towards the end of this year.
Yeah, and I mean, the Safe Banking Act would obviously, as we've discussed, open up some of those financial channels to work with banks here and work on that. Depends on what rules come through at the federal level, though. If that still remains an issue, we'll wait and see as they discuss the nitty-gritty. But I assume it becomes an interesting question for you as a leader of one of these companies. Managing, you guys have posted 11 straight quarters of profitability. Not a lot of companies in the cannabis space have been able to show profitability. But when you kind of weigh the costs of maybe raising capital to invest on the opportunities as you see them today, how do you grapple with that? And maybe, you know, going down the road, we've seen some other companies go down with Curaleaf selling new shares. How do you weigh kind of the pro con of acting now before some of these reforms come through to keep Truliev's lead as we're seeing competitors move into Florida?
Yeah, I mean, what I can tell you is, right, Trulieve has always been very fiscally responsible. It's a foundation that we're very focused on, and will continue to be focused on because, you know, again, as we've discussed, you know, capital markets, the way that we view capital markets are a tool to either speed up or, move things along, but they're not a dependent tool for us. In other words, you know, we'll never use the capital markets to keep the lights on, which is a little bit different than some of our other peer set companies. You know, we do have positive cash flow from operations that we continue to invest in the business. And so, you know, for us, it's just a strategic conversation in terms of what makes sense given the opportunities ahead and where we are at the time. But, you know, look, I mean, the future is incredibly bright for Trulieve and as well as for our industry as a whole. You know, with Florida alone, we see, you know, patient increases week over week of over 2,500 folks entering the program in Florida. Pennsylvania, where we're located, similarly has amazing patient growth, of course, with a robust conversation around the move to recreational in that state. In addition, of course, Connecticut, the governor just this week mentioned that he is interested in retaining some of those potential tax dollars coming from a recreational program, which we operate there as well. Of course, Massachusetts already has both a recreational and a medical program. We'll be opening doors in Massachusetts this year as well. So lots and lots of growth ahead, not to mention, of course, the whole notion of potential recreational in Florida, which has a huge tourism base of 130 million people visiting the state per year. So I think that the message is that there's lots of runway ahead for our company and for others, kind of regardless of what happens on the federal level, right? I mean, I think that what we're watching for on the federal side is thoughtful policymaking and putting together good concrete structure that not only provides, you know, a roadmap for what's to come, but also provides answers to some of these very deep-seated questions around, you know, making sure that we are taking this opportunity to truly address, you know, the systemic concerns that have happened with the disproportionate effects of cannabis over time on Black and brown folks in this country.
Kim, to build on that point that you talked about, legislation that's expected on the federal level, but also changes on the state level, how is that likely to change your distribution model? I mean, if the expectation is here that you're going to be able to move your products across state lines a little smoother, what are you reassessing right now?
Yeah, so we've always thought about the country divided into hubs. And so I think, you know, from a distribution model perspective, you know, we think about regional distribution. So the Southeast, Northeast, Central, Southwest, Northwest, right? So if you look at Trulieve specifically, we're located at the very north part of the state of Florida. So we're about an hour from the Georgia border, very close to Alabama, Texas, Mississippi, et cetera. So from a Southeast perspective, we've been working on a scaled platform. And so we have, you know, just under 1.9 million square feet of cultivation. You know, we distribute 550 some odd SKUs across right now, currently the state of Florida, but could easily pivot and have distribution across the Southeast. You know, the Northeast is the next frontier for Trulieve in terms of really, again, amassing a scaled platform and gaining those economies of scale. It's also been very important for us as we think about efficiencies and supply chain efficiencies, again, in this very regulated industry. And so, you know, while I do think that there certainly will be changes from across, I'll call it cross-border, even though it's state to state movement, you know, standpoint, I also don't know that overnight we're going to go to a scenario where we're able to just, you know, drop ship, you know, product and leave it on people's front doors. So I would expect that there's going to continue to be some regulation and regulatory oversight and overlay on the distribution model, maybe similar to what we saw in alcohol initially, where states have their own you know, their own construct that is overlaid on top of a federal model. You know, you just have to remember that these states have spent years developing these very, very specific programs. And so I think that intersection of how federal laws will work within those state programs is going to be a very interesting conversation.
Yeah, there's a lot of moving pieces in this space, incremental changes, as you say, that leads to something a little bigger, or at least that's the hope for you. Kim Rivers, Trulieve CEO, good to talk to you today.
Thanks so much.
Coming up, the vaccine rollout paving the way for a big rebound in global trade. The CEO of TradeShift will join us to discuss his new study and why he says the U.S. is the outlier. Global trade recovered sharply in the fourth quarter, with the U.S. the clear outperformer. Transaction volumes nearly doubled the growth rate we saw globally. That's at least according to a new report out from Cloud Business Network and platform TradeShift. Let's bring in the CEO of TradeShift, Christian Lang. He's joining us from San Francisco today. So, Christian, before we get into the specifics of this, what kind of impact did you see overall, timed with the rollout of the vaccine? Because we have been talking a lot about how that is likely to bring back demand as people look ahead to a post-COVID world.
I think that first off, what's interesting, and remember our data sort of pre-reads GDP in the sense that it's orders and invoices happening. Typically is GDP the following quarters, right? And I think what's interesting is that the industry is getting ready to get back to business. It's the first time that we have levels that are above the activity levels we saw in March last year. So that truly means that from a transactional level, we are starting to be back to the same level of invoices and purchase orders as we saw in March 2020. And I think that's very encouraging. What's less encouraging is obviously that a lot of that growth has been led by the US and China, and not so much the Eurozone and the rest of the world, right? So there's still a lot of catch up. And I think what's also might be a little worrying is actually UK. We've seen continued drops in that growth. So we're actually further away than we were last quarter from where we were last year.
Yeah, there's been concern also of the impact on trade from Brexit as well over in the UK. When you talk about the US versus China, China obviously has been able to recover in a much more rapid rate than other Western countries for their economy. The US specifically, what did you see driving those trade volumes?
So what we hear from a lot of our customers is, I think, in a way, the election, no matter what you believe politically, drove, in a certain sense, certainty, right? We knew that there was going to be a pandemic response that was probably a little bit more structured from a federal level. I think we also know that, the big change for any economy is essentially vaccine distribution. We can only do so much with PPE, lockdown, social distancing, but the real driver in economic change is the vaccine. And the US have access to a lot of vaccines. The main thing here is distribution. Having the federal level step in with the Biden policy, I think also is driving a lot of certainty in retail, and other areas. So I think that's been a big driver for the US for this jump is just the certainty we know where we're going.
Yeah, and I mean, it would seem like an obvious point. It's something we've heard Fed Chair Jerome Powell kind of stress again and again whenever he's testifying here in front of Congress, but tying back a full economic recovery to seeing control of this pandemic be instituted. And when you look at the data we were just showing there, I mean, the UK returning back to lockdown would seem to be, a pretty strong reason as to why growth might be slowing. Of course, China seeing a very different scenario play out there with them kind of getting this under control earlier ahead of other countries. Are there exceptions to that rule that maybe you would stress when you look into this data and project where growth goes from here?
No, I think it's very clear, right? And I think the problem in the UK is not just lockdowns, but it has been the sort of flip-flopping on policy, right? We go into lockdown, we open up, and then, oh, wow, we're going back to lockdown. And I think that lack of certainty for industry, for retail, for restaurants, makes it extremely hard to predict growth, which makes it very, very hard to invest. You can sort of say in the US, good or bad, we haven't really, there haven't been a lot of changes in the sense that we've been going through the same and we knew where we were. And now with the vaccine coming, I think that's a very clear path. China did lock down the right way very early, and they were very clear in the communication, and that's what allowed them to come back to the level they have. I don't think any Western country could really replicate the version of the Chinese lockdown. I think that'd be extremely hard, and the pushback would be dramatic. But that's how they did it. Yeah.
Mm-hmm. Christian, let's talk specifically about TradeShift. You have long been rumored as one of those unicorns that is expected to come to market. Rumored last year, didn't happen. We're looking at 2021 right now. As you look to the public markets and the environment, especially around some of these companies that have come to market, how are you seeing some of these movements right now? In how do you assess your company's path forward in the face of what some say is a potential bubble that's brewing?
Yeah, I think, what's interesting is you've seen the B2B stocks continue to perform very strongly. I think, if you have sound fundamentals, we were just talking earlier about margins improving in tech companies. That's something that's been a big focus for us in 2020 and continue to be a big focus in 2021. Our prediction is as well that the tech companies that have great margins, great growth, they will continue to be hot assets, no matter if there's a bubble or not. So I think, as long as there's strong revenue growth and improving margins, I think you're good. I think if you're one of the FANGs, et cetera, there's a very big run up in value. I don't know how to predict that from a consumer company perspective, but I definitely know that the B2B stocks seem to still be doing well, and I think have pretty solid fundamentals across the board.
The CEO of TradeShift, Christian Lang, appreciate you coming on here and sharing with us the data you're seeing play out. Thanks again. Going to take a quick break here on Yahoo Finance Live, but breaking down the Apple iPhone Challenger. Dan Halley is going to join us here in tech support to break down the Samsung Galaxy S21 smartphone with his review right after this. Stay with us. Well, Samsung is stepping up its game to take on Apple's iPhone, longtime leader in the space. And here to break down what it's offering in that new phone, I want to bring on Yahoo Finance's Dan Halley with today's tech support. Dan.
That's right. I have right here the Samsung Galaxy S21. That's this guy right here. And the S21 Ultra. That's this guy right here. These are two of Samsung's 3 new smartphones. Now, I just kind of want to break down how they compare to the iPhone 12 line, because look, that's what people are going to be shopping for. It's either Samsung or iPhone. So let's talk about prices first. The S21 starts at $799. Now that's compared to the iPhone 12, which starts at $799. The mini iPhone starts at $699. The 21 Plus is $999, as you can see. The 12 Pro is $999, and then we have the 12 Pro Max at $1,099, and the Galaxy S21 Ultra at $1,200. So we were just talking about this before we came on, how expensive these phones are. $1,200 is a lot of money to put out for a smartphone. So why are the prices so different? What do you get? Well, the S21 has a screen size of 6.2 inches. That's the regular version right here. The S21 Plus gets a larger screen size of 6.7 inches, and the S21 Ultra has a big fat display of 6.8 inches. That compares to the iPhone 12 and iPhone 12 Pro Max. The iPhone 12 Pro has 6.1 inch, the 12 Pro Max has 6.5 inch. And basically what we're looking at in these phones is cameras. That's really what these phones come down to nowadays. And so Samsung put a lot of thought into that. You could see the backs of the phones have these kind of gigantic cameras on the rear. They really do provide a lot of capabilities. And so the S21 has a 3x telephoto lens as well as an ultra wide and wide angle, while the Ultra gets a 10x optical telephoto lens. And that's huge because Samsung wants it to seem like you only need this phone no matter what, whether you would normally use a DSLR camera, you want to zoom in at a ball game whenever that happens again, or just across your room at your cat, which is what I do now because of the lockdowns. But they do want to give you the opportunity to use your phone's camera as you would a normal camera. And they are doing that very well with these new phones. I don't know how much you're going to need to zoom in 10x on your smartphone, but hey, you have the opportunity. They also have this thing called Space Zoom, where you can zoom up to 100x. I guess if you want to, spy on people through their windows, that's cool. You can do that. Or, just take photos of planes flying above. That's something that you can do as well. And they had that in the last generation, but they improved that greatly with this version, with more AI and more software capabilities. And the phones also have wireless charging technology. That's something that the iPhone has as well. The iPhone, by the way, has ultra wide and wide angle cameras, as well as a telephoto lens. It's only the Pro and the Pro Max that have the telephotos though. And the Pro has a 2x while the Pro Max has a 2.5x. And finally, I just want to talk about the overall design of these phones. Samsung has this kind of leaning towards displays that kind of cascade over the sides. I'm not a big fan of that. They've been doing that for years. The Ultra has that, unfortunately. You do get that 100x zoom. So if you really want something along those lines, you would get this. I love the standard S21 though. The flatter design, the screen is beautiful. I was saying that I have an iPhone. I stick to it because of my Apple Watch and my obsessive use of the rings to track my activity, which has just become a debilitating problem for me. But if I didn't, I would get the S21 because it's a beautiful phone. And I just want to talk about the S21 Ultra real quick. Samsung has the Note line of phones where you can use a stylus. The S21 Ultra actually does that as well. So you're going to be able to use a stylus on this. So if you're a big fan of that, it is something worth getting. It doesn't, however, have a dock. The S21 doesn't offer the stylus capabilities. But again, this is really the phone that I think you should go with.
Yeah, Dan, isn't the irony though at $1,200 and you're talking about the camera being the best feature? You can actually use that money to get a camera that takes better photos in your phone, right? I mean, I realize that's not the convenience, but it's kind of interesting where we put our money now.
I agree with you. It's pricey, but I do think that overall the capabilities that these phones offer are worth it. $1,200, it's a little bit pricey. That's why I say the standard is probably the way to go at $799. A little bit cheaper and a really great camera.
Okay, and you can read all about it on yahoofinance.com. Dan Halley always here with those reviews. Thanks so much for that. Much more coming up ahead here on Yahoo Finance Live, including a look at the markets. Emerging markets finally breaking to record highs. Jared Blickery is going to break down that action for us on the other side. Welcome back to Yahoo Finance Live. The Dow and the S&P 500 in the red in the afternoon session. Now the Nasdaq, the only one in the green, up 0.3%. Let's bring in Jared Blickery, who is tracking the market action for us. And Jared, you've got your eye on emerging markets. A lot of this driven by the performance we've seen in Chinese tech stocks.
Yes, indeed it has. And let's look at the Wi-Fi Interactive on our world map here. We can see that the only green we're seeing right now, besides the NASDAQ, which you mentioned, is over in China. We're going to take a look at the emerging market space in just a second. Notably, the NASDAQ well off of its highs, but just being fueled primarily by the mega caps, finally getting some love after a couple over these last 2 days after a few months of underperformance. And you can see Apple up another 3%, Alphabet, Amazon, and Facebook each up more than 1%. But let's go to the sector action for today. The FANG sector is still the only outperformers and notably the only ones in the green, also notably all at record highs. Now, I want to take a look at emerging markets here. We can see the EEM ETF slightly off today, but just hit a record high, intraday high on the open and also set a record closing high yesterday. Now, this is over the last year. You can see it's been climbing steadily since that pandemic bottom. But you take a look at what's happened over the last 20 years, it's been trading sideways until the very last couple months here. And if you take a look at this, what appears to be 13-year consolidation, you got to think that there's a lot of tank in the gas for the future in the coming months, even if things are a little bit overbought right now. And these, the EEM ETF, as a lot of emerging market ETFs, are stacked with tech names. Now, this is an intraday look, but I'm going to take a look over the last month, and you can see just a lot of standout performers there. Tencent up 10%, Baidu up 32%, Pinduoduo up 16% over the trailing month. Guys?
Okay, thanks so much for that, Jared. Zach, we haven't talked much about the unemployment claims or initial jobless claims that came out today. Certainly that hasn't had a significant impact, at least in the moves in the markets, but another 900,000 workers roughly filing for unemployment benefits. It really does feel like a broken record every week, but it feels like that recovery is really stalling because of just the type of spread that we're seeing across the country right now.
Yeah, it's kind of crazy to think that, 900,000 Americans filing for unemployment, and we're not talking about it till the end of the show. And that's just because we've seen the numbers be so high for so long that you kind of become numb to it. And yes, it was better than the 935,000 economists were expecting. But keep in mind, we never topped 700,000 back during the Great Recession. So we're still running at historically high numbers of Americans filing for unemployment. When you stack that up, consider that it's not just this week, but it's been week after week after week for almost a year now. You see some pretty high unemployment rates when you look at it state by state. And it's interesting to maybe highlight the fact that the states that have been suffering the highest unemployment rates have gone in flux. Some states have improved. Notable that Hawaii has now dropped out of the top 10. We saw that happen a few weeks ago, but still consider the fact that that state implemented some pretty serious rules in terms of traveling and having to test negative before you travel to Hawaii to really get that issue under control. Obviously, it's harder for other states in the U.S. to maybe do that now, considering how widespread the coronavirus is in the country. But just take a look at some of those states leading here. I mean, when we talk about Kansas' 7.5% insured unemployment rate, that's, of course, the measure of citizens there on unemployment insurance relative to the labor force. 7.5%, the highest in the U.S. right now, 7.2% following that in Pennsylvania. But obviously, I mean, this is going to take different states, different times to rebound and come back, depending on the industries. We've talked about Nevada also being a state levered to travel. But just interesting to see this play out on a state level basis as President Biden steps into office to really implement some of his policies. And it's not just going to be how he tackles coronavirus. Akiko, I know you've also been looking at the way that he's tackling climate change with a key number of executive orders here.
Yeah, and when you talk about the workforce, the labor force overall, you can certainly bet that this administration is going to tie the climate policy directly to the jobs market, saying that if we can transform the way a lot of these companies operate, that will ultimately, many years from now, lead to a stronger economy. We've seen a number of executive orders already signed. The Paris Climate Accord, the U.S. rejoining that. The president also revoking permits for that Keystone XL pipeline. That's going to be an interesting one to watch, because we heard from the press secretary Jen Psaki yesterday saying that the very first call the president is going to have with the foreign leader will be to Canadian Prime Minister Justin Trudeau, who has been very vocal about the fact that he wants to keep the project going. So that's going to be an interesting conversation to have. And you look back to how this all began. It was back in 2008 when oil prices were still at record levels. The argument here was that this could bring things down up to 800,000 barrels that would be shipped across country lines here from Canada over to the U.S. Gulf Coast. But of course, environmentalists have really stepped in, saying that there simply is no guarantee that this won't have risks with an oil spill and contaminated water, other issues as well. So one to certainly watch. We're only in the first full day of this president, and climate already at sort of the center right now of the discussion. So as Josh Lipsky earlier said, this is not going to be just an environmental issue, but one that relates to the economy as well as sort of the broader macro picture. We've got much more to come here on Yahoo Finance Live. Zach and I wrapping it up here for the 2 hours, but Kristen Myers is going to pick up our coverage on the other side.
Welcome into the 1 p.m. hour here at Yahoo Finance Live. Let's take a look at market action right now. We have the NASDAQ at record highs, the S&P 500 and the Dow pretty flat right now, both in the red, however, down less than 1% right now. We had seen record highs in all three major indices after President Biden was inaugurated yesterday afternoon. Again, right now, stocks a fairly mixed bag. We're seeing the markets fairly flat after we had the new jobless claims numbers come in for the week. Slightly better than the report that we got last week, but we still have back-to-back weeks, which are some of the highest levels since August. You can see there, jobless claims coming in 900,000, a little bit better than economists had been expecting. They were expecting 935,000 for the week. And the numbers from last week were revised down to 926,000. Still, however, as I mentioned, incredibly high, the highest levels that we've seen since August. Continuing claims for the week ending January 9th came in at 5.054 million. That is also slightly better than what economists had been anticipating at 5.3 million. Let's take a look at some stocks right now. Let's start with United. United in the red, down over 5.5%, almost 6% right now. That is coming after they posted a $1.9 billion loss for the fourth quarter. Now let's take a look over at Apple. Apple in the green right now. We are seeing Apple shares popping ahead of their earnings. Some analysts are expecting a record earnings report for their fourth quarter. I want to take a look right now over at Moderna. Moderna also popping today, up, as you can see, over 7% right now. Now, some folks actually had an allergic reaction to the Moderna vaccine, which actually caused a pause. California has restarted using that Moderna vaccine, declaring that it is safe. Now, when it comes to the coronavirus pandemic, the case count in the United States continues to rise, with the total figures up to 24.5 million in the United States, with the death count now well over 400,000. So we want to start the show there. Presidential Biden planning to invoke the Defense Production Act, a presidential power used typically during times of war. He's doing that to combat the coronavirus pandemic. We have Yahoo Finance's Anjali Khemlani here with more details. Hey, Anjali.
Hey, Kristen. Yeah, so we know that the Defense Production Act, which President Trump did use early on in the pandemic when we were looking for things like ventilators as well as protective gear, but it seems like production of that sort of waned off. We know that there were companies that had started to do it, and then eventually all of that production did taper off. But it looks like we're going to get back into that with President Joe Biden saying that he intends to sign executive orders to that effect, also to include expanded testing, which is something that we know health experts have been desperately calling for, as well as vaccine supplies to include syringes, tubes, etc., whatever is needed to really get everything going. We also know that on the list is a testing expansion, as well as reopening schools and businesses. That is what those are two different strategies that the Biden administration is looking to tackle immediately in order to ensure that we start looking at the economy and reopening. Also looking at a health equity committee, as well as a memo to help with states get reimbursement from FEMA for their vaccine and testing supplies, as well as for the National Guard, which has been deployed past year, as well as will continue to need to be in order to help develop administer the vaccines. And we also know that this continues to be the focus. Yesterday at the inauguration, President Biden saying, quote, "We are entering what may be the toughest and deadliest period of this virus." Kristen.
All right. Thank you to Yahoo Finance's Anjali Khemlani with all of those updates throughout this pandemic. I want to bring on Dr. Rishi Desai, Chief Medical Officer at Osmosis and former Epidemic Intelligence Officer at the CDC. Always great chatting with you, Dr. Desai. So you were very critical of the previous administration and their coronavirus response. We just heard Anjali Khemlani really updating us on what the Biden administration now plans, invoking that Defense Production Act. But as she mentioned, that is a move that has been used before by the previous administration. I'm wondering if you think anything will be different this time, using the same act, but now with a different administration.
It's a good question. I mean, I think a lot of why I was critical is that I felt that for a long time we were fighting this war on science, and we saw that war playing out on social media and news outlets in the way that we talked about masks. And now it feels like there's truly a strategy that's a war on the virus itself, right? We're not fighting some political battle about whether to wear masks or not. We're trying to figure out how to get vaccines into arms. And I think that that is the big difference. It's using these acts; those are tactics, but the general strategy and the whole idea of like what we're even fighting has shifted from fighting science to fighting COVID-19.
So then, just to really make sure I am getting you correctly, it sounds as if some of the moves that the Trump administration was making, at least, invoking the Defense Production Act to have masks being produced, to increase testing, were the right moves to make. But that perhaps every time we took a couple steps forward, we were taking more steps backwards because we were at the same time publicly fighting very publicly about how important this virus was and how dangerous it was and what we needed to do in order to fight it. Is that essentially what you're saying here?
You're saying it exactly right. I mean, it doesn't make sense on the one hand to say that we're using the Defense Production Act to get more ventilators out there, and on the other hand say that we don't really need to wear masks or that doesn't need to be a mandate, because we know that if you have more masks out there, then you have less people getting sick, going to the hospital and needing those ventilators. So you can't say both, and that's the confusion that we've been dealing with for roughly a year now.
So to that point, we've been dealing with confusion for nearly a year. I'm wondering if you think that the damage has almost been done, right? We're invoking this Defense Production Act. So great. We get more testing. We get more masks. But it kind of really requires buy-in from the American public. And if the American public has spent the last year being told and being given very mixed messages, how effective can the Biden administration be going forward, do you think, after this virus has been politicized for so long?
It's a good question. I think what happened is that at a federal level, we had a vacuum of leadership. And so then what happens is that typically then people look to local leaders, their state leaders, their county leaders, maybe they're working in a company, their CEO. That's where the leadership has to come from. And that's hard because those folks aren't necessarily in the same, able to do the same things that a president can do. So I think now that you've got strong leadership at the national level, you've still got folks like Dr. Anthony Fauci saying the same things he's always been saying. I think now people are ready to get inspired and excited to fight this war, and it is a war that we have to kind of go out there and fight. Whereas before, when you've got confusion at the leadership level, you kind of throw your hands up and say, "Oh, I don't know what to do. Forget it. I'll just kind of go on my merry way, and I don't need to wear a mask perhaps today." And so I think now people are ready to hopefully listen and do the right thing.
So we have a bit of good news, which is that COVID cases seem to be on the decline, and we're at the end now of January. I always have to remind myself what day it is. But we've been told that winter was really going to be some of the hardest months. I'm wondering if you think that perhaps we're maybe turning things around, if that this decline in cases that we're seeing could perhaps be contributed to the vaccine rollout that we have.
Yeah, I think that this decline is real. I think we're going to see it continue to slowly go down. But the key is that although it continues to slowly go down, if you look at the curve you've got shown up there, it has gone down in the past and then risen again, right? So the moment we get complacent is the moment when the vaccine or the virus starts taking off again. And we're not nearly at the levels of vaccine where we can expect us to kind of feel safe and that we're out of the woods. So we're definitely not out of the woods. But I do think that if we continue to hunker down, wear masks, and have those folks that are eligible for vaccine go out and get it, I think that we're going to continue to see not just cases go down, but hospitalizations will slowly kind of tick down. Deaths will slowly tick down as well. But the key is, but we've done that 3 times now. So that's not the hard part. The hard part is, can we keep applied pressure and not kind of get complacent and see another rise again?
I have a question about that I'm going to ask you in just a moment, but I want to ask you about this new variant, or the several new variants that we have out there. Scott Gottlieb coming out and tweeting actually that the new variant could be a game changer, essentially, especially as we see these new mutations are more contagious. At the same time, as you mentioned, our vaccinations are not where we want them to be right now. So it almost feels like we're a little bit behind in this war, in this battle against this virus. So how much do you think that this new variant, these new mutations that we're seeing right now, are going to impact these case counts that we have going on?
That's a really good question. It's also why we want to make sure we're not fighting science. I mean, science is informing us about the variants. And think about each variant as having two potential kind of new powers. One is being more contagious, and the other is being more virulent. So you just alluded to the first one, being more contagious. If it is more contagious, then we need to be worried, because then that means that we need a higher threshold of folks immunized and have vaccine to be able to protect against this from kind of getting out of control again. So I am very worried about that from that standpoint. The other issue is virulence. And if we find that some of these variants are getting people more sick, landing them in the ICU and causing more fatalities, then that's another cause for concern in terms of how we treat these patients as well.
So going back to the point that you were making just a moment ago, I keep wondering, as you mentioned, we have this decline and then we see them spike back up again. And I'm wondering if we're setting ourselves up in a way for kind of like this perfect storm, because we do have these low vaccination rates. At least these vaccination rates are not where we say we either want them to be or even need them to be to reach herd immunity by late spring, early fall. But we also have folks going back outside again as much as they can. People are having pandemic fatigue and hanging out. It seems as if travel is starting to pick back up a little bit more slowly. We now have these new mutations, which, as you mentioned, could be more virulent, could be more contagious. Are we setting ourselves up to really get walloped in February, perhaps, or even in March?
One other thing that I would add to your long list of factors is also folks that might get one dose of the vaccine but not go back and get the second because they think maybe one is enough, or they've heard one is enough. Or even states that might say, let's just give out one dose because we're short on supply. All of those kinds of things are a setup for creating more variants, right? So that's exactly the environment in which a variant gets created, where you have one dose of vaccine, but not that second dose. So things like that are a setup. I personally feel like, based on all the data I've seen and what I've looked at, I think at this point, if we just really stick to the plan, get these 2 doses into arms, focus hard on that, I don't think that we're in for a setup. I don't think we're going to get walloped in February or March. I think that we're going to do okay. But I do think that we need to just keep with the game plan and not get fatigued on all those other things until everyone is getting the vaccine in their arms and is got 2 weeks after that to kind of get that full immunity and keep their masks on. Keep in mind, 95% is not 100%. So we might still need masks while the levels of COVID-19 are still quite high. Once those levels go down, we can at that point, way down the road, start saying, you know what, maybe at that point, masks aren't needed. It's not like I'm suggesting masks for life. But right now, while levels are high, even with vaccine, we need to keep our masks on.
Yeah, applied pressure is incredibly difficult when people just want to get out of their house and see their friends again. But it is an important reminder that we can't let up right now, because then we'll be back where we were back last March and last May. Dr. Rishi Desai, Chief Medical Officer at Osmosis and former Epidemic Intelligence Officer at the CDC, thanks so much for joining us.
Thank you.
And coming up today is the first full day of the new Biden-Harris administration. We'll be bringing you the latest from DC next. Welcome back to Yahoo Finance Live. Today marks President Biden's first full day in office, and he's already hitting the ground running. Meanwhile, Trump's impeachment trial still looms large. We have Yahoo Finance's Jessica Smith here with us to break down all of the latest in D.C. Hey, Jess.
Hey, Kristen. Well, of course, on the top of President Biden's to-do list is coronavirus relief. He is pushing that $1.9 trillion package that he unveiled right before he was inaugurated. And Speaker Pelosi did talk to reporters about that plan just a short time ago at a press conference. She said that it has many elements that House Democrats have been pushing for. The House is going to be out all of next week. She says they'll be doing committee work on COVID-related bills during that time, so they are ready to go to the floor when they come back to Washington in the first week of February. Now, Republicans are already pushing back on certain aspects of the plan, like the $15 minimum wage. Some others just think there is not a need for another massive package when they just got one done a couple weeks ago. Now, Senator Roy Blunt, a Republican, told the Hill Press Pool a little bit ago that there are some non-starters in the package, but he did say there are also some starters. The White House press secretary, Jen Psaki, told reporters that the White House wants to get bipartisan support on this, but if Republicans do not get on board, they're not going to take other options off the table. Of course, we've heard from Senator Bernie Sanders saying Democrats will use reconciliation if they have to. If Republicans don't support this, that move would require just a simple majority vote. When Psaki was asked if there is any wiggle room in that $1.9 trillion price tag, here's what she had to say.
It was designed with the components that were necessary to give people the relief they needed. So what's challenging is, what are you going to cut? Are you going to cut funding for vaccinations? Are you going to cut funding for unemployment insurance? Are you going to cut funding for reopening schools?
Kristen, you may remember that bipartisan group of lawmakers that met toward the end of last year to put together that $900 billion plan that really pushed leadership to hammer out a COVID deal. That same group of lawmakers is expected to meet with the Biden administration in the coming days, possibly as soon as this weekend. So we will see if they're able to find any common ground.
All right. Thank you to Yahoo Finance's Jessica Smith. Hopefully you can go get a nap or something. Yesterday was a bit of an exhausting day for us all. A little bit interesting, though, to see Jen Psaki up there. What a change of pace in that press pool there from what we've had in the previous administration. But go get some rest. We'll definitely have you up to update us a little bit later. Thanks, as always. Now, I want to talk now about the impact of some of those policies, particularly on stimulus, on economic growth going forward. We're joined now by Kristen E. Brody, Policy Director for the Hamilton Project and a Fellow in Economic Studies at the Brookings Institution. Kristen, thank you so much for joining us. It's not often that I get a name twin here with me on the show, so I very much appreciate it. I want to start first with that stimulus plan. How critical is it to get that extra $2 trillion, roughly, it's $1.9 trillion package to the U.S. economy, especially as we're hearing, our own Jess Smith there updating us that there are some non-starters. So it might be a little bit scaled back, the final version, which happened the last time we went through these stimulus negotiations. So how critical is that $2 trillion package?
First of all, thank you for having me. And that is going to be absolutely critical. When we look at the millions of workers who are unemployed right now, both short-term and long-term, we need money for workforce training. We need money for higher education to prepare those workers, some of whom don't have a job to go back to. When you look at the fact that in December, 23% of workers teleworked, and telework is going to continue. Automation is going to accelerate many of the things that we've seen during the pandemic. So we're going to need training for many of these workers so that they can be prepared for jobs that will exist after the pandemic.
So speaking about that, training the workers, you guys have a study out at the Brookings Institution on this very thing. Let's step back a little bit. And when we're looking at this post-pandemic world, what are some of the biggest challenges that are facing, the workforce once it's over? You started to allude to some of them. Let's dive into that a little bit deeper.
So I think when you think about the group of people that are working from home and that even once the pandemic is over, we'll be able to continue to work from home. When you think about the fact that business travel and conference travel is likely to decrease. And so when you think about workers in hotels or in restaurants or leisure, as many people stop traveling or decrease their travel, those jobs may not come back, many of them, even once there is a vaccine. We've gotten really good at using Zoom and using these other platforms over the pandemic. So for many of those workers, they're not going to have a job. While on the other hand, jobs in computer design and technology are increasing. So we need to be preparing for people for jobs that will exist and providing them with the skills, with the internet, broadband, and resources so that they will be prepared to do those jobs when it's time.
So on that piece, education, obviously a critical component in order to train the next generation, essentially, of the workforce. Wondering, because your study actually highlights that we're seeing declining enrollment when it comes to higher education. We were just showing everyone some of the graphics just a moment ago. How do we address that piece?
So I think that we need more investment in higher ed. And I think that the college professors and administrators are the ones who really know what their students need. So one of my big pushes is increasing funding for remedial education and other kinds of training so that more people can be ready to enter college. Universities know exactly how to prepare students if we fund them and allow them to do that. Furthermore, I think that we need partnerships between state and local governments and also partnerships between corporations and universities. And one of my, again, pushes is so that companies can say these are things that we need for students to know and be able to do for jobs that are going to be available, so that universities can then prepare them. Those kinds of partnerships, internships, apprenticeships create pipelines for people to come out of school into employment, and for current workers to maybe go back to school or get a credential while they're working to help them get a promotion on their current job or to get a new job that will exist after the pandemic is over.
So I want to pick up on something that you were just saying really quickly with you here, Kristen. I think we romanticize higher education a little bit. It's a time for us, to pursue our passions, really figure out what we love. And then sometimes we find that you go out into the workforce and your passion, frankly, there's not a huge demand for it, or you can't get a lot of money for it. I'm wondering if you think that we really need to start having a conversation about training folks in jobs where there is demand, training folks for jobs where they are going to be able to make a livable wage, instead of so much that, education in your passion piece. We do see other countries starting to do this more and more. Do you think that the United States really needs to move down that path?
So I don't want us to be telling people what they should and should not do. But I do think that companies should express what jobs are going to exist or what jobs they think people need more training in so that people can then go and get training in those areas. They still have a choice, right? Their passion may be in one of those areas, but having that communication between corporations, between government agencies, and higher ed would allow people to choose to go into fields where jobs are going to exist and pay a livable wage.
All right, Dr. Kristen E. Brody from the Brookings Institution, thank you so much for joining us today.
Thank you for having me.
And coming up, we're going to be hearing from New York City mayoral candidate and former Citigroup exec Ray McGuire. That's next. Welcome back to Yahoo Finance Live. Let's take a quick look at the market action right now. We are continuing to see the NASDAQ in the green. It has now been joined by the S&P 500 and the Dow. It had been in the red at the start of the show. However, the S&P 500 and the Dow trading fairly flat right now. The NASDAQ up about 0.5 percentage point. On a sector basis, we are seeing tech right now, the leader, make no surprise there with the NASDAQ at record highs, up over 1% right now. Laggard on the day is energy, down almost 4% right now on a sector basis. Well, former Citigroup exec and now candidate for New York City Mayor Ray McGuire sat down with Andy Serwer to talk about his mayoral run, but also how badly stimulus funds are needed. Take a listen.
And it begins, we're suffering. We got the existential crisis with this pandemic. COVID has ripped through our communities and wrought havoc on many communities, especially disproportionately on Black and brown communities. We saw today the announcement of the budget deficit, which is going to be material in this city. We need to repair that. We need leadership that can address that directly. So yes, welcome the assistance. We will need more. We will need more in order for this country to make certain that it addresses the least of these. Americans, New Yorkers are suffering. COVID, the economy, injustices across the system. We need to address that, and we need leadership that's going to bring this city and this country together. That's what we need today, because absent that, as Lincoln said, a nation divided cannot stand. And as my dear mother says, and we talk about the scripture, when the foundation is falling and when the foundation is crumbling, what will the righteous do? Who's going to stand up for all of us? Who can lead us forward? Who can do that? Who's got the relationships and the lived experiences and the leadership and the management skills to pull all this together? That trifecta, which is going to be necessary to bridge all the divides, which have gotten worse, they've gotten broader.
Have you thought, Ray, about, let me ask you two things. Have you thought about how to get more aid for New York City from the federal government? Because that money has not come for the most part, number one. And number two, how to boost up small businesses, which are hurting so much. Because you walk down the street here in New York, Ray, you see the Chipotle is open. You see the Chase Bank is open, but then the small independent store is closed. How can you help them?
So let me give you, I'm going to answer both questions. One, small businesses, as you've identified, my visions go big, go small. Go small is the lifeblood of the city. Small businesses represent half of New Yorkers. Half of New Yorkers work for a small business. So I want to do a couple of things. One, I want to give a lifeline to those small businesses. I want to put money into the community banks. I want to make certain that the bureaucracy that exists for small business formation, that we eliminate that. I want to give a lifeline to the existing small businesses, one of three which are out of work now, that are shut down and may not come back. And I want to make it easier and incentivize the formation of small businesses. I want to have a small business advocate, and I want to have a shot clock. Small business advocate that is there to help the formation of small businesses, to aggregate all the permitting. Then the shot clock says that, and I'm going to say illustratively, 60 days, you get a chance to apply. And if the city hasn't responded in 60 days, shot clock runs out, business gets formed. I want to give them grants, low interest loans, and equity capital to start these small businesses. I want to advocate for them. Small businesses should be clients of, customers of the city, which is the way this city survives. That's going small. That's fundamental to our inclusive economic recovery.
And what about that aid from the federal government piece?
So the federal government has given us some, we need more. I am encouraged a bit by their focus on infrastructure, because that's part of my go big, but we'll need more. And we have the relationships in Washington to make the case, We have a track record when we make the case of those decision makers in Washington today who know us. I introduced Kamala Harris to New York, to the business community in New York, Vice President-elect. We have relationships in Washington. And also what it's going to require here, which you haven't mentioned, is the private sector needs to get involved. We need to have active, robust public public-private sector partnerships in order for this city to have the growth, for me to lead that growth that I'm describing. Public-private, and we have the relationships there, meaning I know the people who can help us out. I'm a phone call away from any key decision maker in this country. We could bring it all together, which is what's going to be needed, is what we're going to need in order to have this recovery, this comeback, the greatest comeback in the history of New York City. That's what we're going to lead.
Biden has promised another round of spending in February that will be funded in part by a tax hike on the wealthy and corporations. Is that a good idea? And will you have to raise taxes in New York City to get the city back on its feet?
So the answer is you have to look at the budget in total. I want to focus on the New York City budget. We have to grow our way out of this. As we've seen today, you have at least a $5 billion budget deficit. We saw the decrease in the largest part of the budget, which is property taxes. We saw a decrease in that, in its contribution. We have to look at the budget entirety. And as you know, I've been in a leadership role in business, leadership role for 13 years, which means I had to manage a budget every quarter. I know how to manage budgets. And I've managed budgets from the depths of the crisis. We have to grow our way out of this. Everything needs to be on the table, including taxes. We can't tax your way out of this. And those who have the resources, like me and others, will have to contribute more. But we need to make certain that those tax dollars are well used. So yes, we're going to have to do what you have to. Everything's going to be on the table. Everything will be on the table. But we have to grow our way out of this.
And what about, and this sort of is adjacent to that last question, what about wealth inequality? Because the wealthiest people in this country and in New York have just gotten wealthier during the pandemic. It's kind of astonishing, but they're part of financial services like you are, or tech, and they did just fine over the past 12 months. So how do we bring them together? You talked about taxes as a part of it. Are there other mechanisms?
So taxes are part of the budget. I want to be clear. It's part of the overall budget. You got to go line item by line item. But this divide that you've described, I've written about this in one of the definitive pieces on the impact of racial inequities in this country. And what I've said is that George Floyd and COVID have been the big reveal. And what the study shows is that the impact on 40 years of systemic inequity economically to the U.S. economy has been $16 trillion. Look at the analysis. I wrote the foreword, and we go through and analyze the components of that. And then we say, if we begin to address it now, that's $5 trillion that gets added to the U.S. economy. So what we're seeing now has been systemic. We need to address the systemic inequities, which is why when I describe the greatest comeback, it's the greatest inclusive comeback, because far too many, as you've referenced, have not been included. And we've created, that wealth gap has only gotten larger, gets reflected in home ownership, gets reflected in just the net worth. 1954, we saw the extraordinary decision of Brown versus Board of Education. 1954, we saw the creation of the beacon of suburbia, which is Levittown, that had as part of it systemic redlining, so Black folk and brown folk couldn't be part of that. Home ownership, 66 years of inequities. We need to address that today, which is go big, go small, beginning to address those inequities. It's going to take us a while to address what's happened during the course of the history of this country, but we can begin with the right leadership. Having identified the problem, we now know what the prescription is, which is included in my vision of how we're going to do this.
And you can watch that full episode of Influencers with Andy Serwer on yahoofinance.com. And coming up, we will be talking about those jobless claims numbers. That's next. Welcome back to Yahoo Finance Live. Checking market action. All three major indices are in the green right now. S&P 500 and the Dow, however, trading a little bit flat. The Dow up less than 10 points right now. The NASDAQ hitting record highs, up about 0.5 percentage point right now. So no surprise on a sector basis. We have tech, the leader on today, up over 1% right now. Energy, the laggard, down over 4%, accelerating some of those losses. But let's talk now about those jobless claims. Came in slightly better than expected, 900,000. That's compared to the 935,000 that economists had anticipated. Of course, those levels are still elevated. So let's talk about this more with Anik Sen, Global Head of Equities at PineBridge Investments. Anik, great to have you with us. As always, starting with those jobless claims numbers, I was reading one economist calling it essentially this spike that we saw last week, and now what we have this week, essentially calling it a big fluke, putting it all down to seasonal adjustment problems. I'm wondering what your take is.
I don't think so. I think that, when you look at certainly the US and certainly, around the world, the economic expansion is for real. And you're seeing some shortages of labor even starting to crop up in a number of manufacturing industries right now. So clearly, a lot of the virus-affected sectors and industries are still struggling. And for that, we have definitely some expectation of large stimulus to come. But I think this is for real, Kristen.
So then do you see these high levels persisting, or do you think we're going to be seeing a big drop back into that 700,000 range on the jobless claims that we had been seeing for quite a bit of time?
I see a relatively quick recovery that is taking shape. Obviously, when you look at the trajectory of the virus, it looks as though we've made a peak, not just here in the US, but also in Europe. So the direction of travel actually is looking quite positive. And of course, governments around the world are ramping up the vaccination program. So that, I think, is extremely powerful in terms of the time it takes to return to some kind of normality, let's hope. But essentially, when you look at the manufacturing industries right now around the world, we see a very solid V-shaped recovery that has been in the making now for a while. But we see no sign of deceleration right now. Obviously, countries like China are actually doing great. You see a lot of industries that are early indicators of manufacturing and early indicators of the economy looking very strong. One thing that I will note is that the housing market in the US is a very important driver of employment, and it always has been and continues to be. So when you look at all of the statistics around housing permits, house values, the mortgage rate now is well below 3%, 2.88 or so. I think all of these things bode well for the employment numbers.
I want to talk about something that I saw in your note, which I thought was really interesting, that you call 2021 that there's going to be a stock selection driven market, because right now we of course have a lot of investors trying to figure out how to navigate given these continued and persistent risks, but also the knowledge that there is opportunity out there, and there will be a lot of opportunity out there this year. So talk to us a bit about that stock selection driven market this year.
Well, the context is that obviously valuations are high. Whichever way you cut it, at the index level, valuations are definitely, much higher and significantly elevated versus history. But the point here also is that you have to temper it with the fact that, a lot of things have changed versus history. And notably, the most important thing that has changed is the propensity of the Fed to be much more patient. So their mandate now is a different mandate. It's a 2% average inflation targeting mandate. And as we've heard from Fed speakers recently, from Chairman Powell down, they are indicating a very strong stance towards being patient in terms of tolerating a reflationary period. So I think this is a very pro-risk environment. You have a very positive stance from the major central banks around the world. You have plenty of pent-up demand Generally speaking, the last 5 or 6 years, there hasn't been much investment that has been going on. And, I think CEOs and CFOs have struggled to see the visibility to make those investment decisions. And I think, come the first quarter results, later on this year, you'll start to see a very positive tone developing, which we already detect in the Q4 numbers that are coming through. So we think that this is a stock selection market largely because valuations are relatively elevated. So the market is very dependent now on positive earnings revisions. And actually, what we're starting to see is that across the board, in any region, in any country, the number of companies that are seeing earnings upgrades is now higher than the number of companies that are seeing earnings downgrades. So the point here on stock selectivity is that because of elevated valuations and elevated expectations in stocks, any disappointments will be very harshly treated by the market.
And on that point, we're seeing Apple actually popping because of some of what you're talking about right now. Upgraded expectations on earnings. Apple right now up about 3.5%. Onyx Sen, Global Head of Equities at PineBridge Investments. Thanks for joining us as always.
Thank you for having me. Bye.
And coming up in a victory for environmental activists, the expansion of the Keystone Pipeline has been blocked by the new Biden administration. We'll be talking that next. Welcome back to Yahoo Finance Live. All right, the Keystone XL pipeline, an expansion of the Keystone pipeline, which carries Canadian crude into the United States, has been blocked by President Biden. We have Yahoo Finance's Rick Newman here with us now to talk about it more. So, Rick, you and I were actually just chatting about this in the break. So give us a really super brief overview, because this project has been ongoing for over a decade. And as you and I were just chatting, it's the Keystone XL pipeline that is being impacted, not the Keystone pipeline that already exists. So give us a brief overview for those at home that don't know.
That's right. This proposal dates to 2008. And if you go back to that point in time, oil prices were up well over $100. They peaked at $150 per barrel back then. They're obviously much lower now, but at any rate, the idea with the Keystone XL pipeline was to build a new way to get oil from certain fields in Alberta, Canada, all the way down to Nebraska. And then they would, at that point, enter a different pipeline system that would take the oil to the Gulf Coast, where it would be refined. Now, this pipeline is uniquely problematic. First of all, the oil that we're talking about here comes from tar sands in Canada, and it tends to be thicker, dirtier, and more corrosive than typical light crude, which means it pollutes more, and it's more likely to leak out of the pipeline. So there has been opposition to this pipeline from day one. It looked as if President Obama might approve the permits for this pipeline, but he didn't. He actually declined to issue the permit in 2015. Then President Trump came into office, much friendlier toward energy companies. He actually approved the permit, and construction of this pipeline began last year. Some construction was scheduled to start this winter in U.S. states like Montana and South Dakota. But of course, Biden got elected in November, and he has kind of telegraphed that he was going to kill this plan all over again. So it looks like this pipeline is dead for good.
Right. And as we were talking about, and we showed everyone a map while you were talking about this project. So a huge win, of course, for environmental activists. A lot of Native American activists had been protesting against this project and against these permits. So then let's talk to us about the impact. What is the impact going to be on jobs, on the energy industry?
Well, the company that runs this pipeline, it's a Canadian company, not an American which I think is a factor here. But it's called TC Energy, and they're saying they're going to have to lay off about 1,000 people. They haven't made clear what percentage of those would be Canadians and what would be Americans. So I think we should assume some of those would be Canadians. But look, these are job losses, and we're going to see a lot more of this under the Biden administration. And I think it's something Biden really has to be conscientious of. If he makes other decisions like this, and there are other decisions such as drilling permits on federal land, what to do about new fracking permits and things like that. If he just kind of casually kills a few oil and gas and coal jobs here and there, it's going to start to make it hard for him to get buy-in for this big transition he wants to make, the shift from carbon energy to much cleaner sources of energy. So one of the things the United States has actually been really terrible at is what to do about workers whose jobs disappear as the economy evolves, as some factories go overseas, as the digital revolution takes over. We've just done a terrible job with the safety net for workers who kind of lose out. And Biden has to be really careful about this, or his big plans for a shift to more green energy are going to run into a lot of opposition.
I just want to give a quick reminder for everyone at home. Energy sector is lagging today, down over 4%. Crude right now, down about 0.5 percentage point. Thanks so much, Rick.
Yeah.
And coming up, we'll be talking about financial regulatory picks from the Biden administration. We have Yahoo Finance's Brian Chung to break that down for us. Welcome back to Yahoo Finance Live. We have Yahoo Finance's Brian Cheung here with us to walk us through who President Biden has tapped for his financial regulatory agencies. Hey, Brian, so walk us through all of these picks.
Hey, Kristen, well, it's only been one day since Joe Biden did take office, but it seems like his financial regulatory team is already coming together. The Wall Street Journal reporting that Michael Barr will be their pick for the Office of the Comptroller of the Currency. And for those who aren't familiar with what that agency is, it's a sub-agency under the Treasury that's a major banking regulator alongside, of course, the Federal Reserve and the Federal Deposit Insurance Corporation. So a little bit more about Michael Barr himself. He's the Dean of Public Policy at the University of Michigan's Ford School, and he did serve in the Obama administration at the Treasury itself. So he's familiar with the halls, at least at that building, although the OCC is in a separate part of DC. He was also a key architect for the Dodd-Frank Act, which many will recall was that post-financial crisis framework for putting guardrails on the banking industry. Now, this coming alongside Bloomberg reporting saying that Nellie Liang could be headed to the Treasury as an undersecretary of domestic finance. That would put her in a very influential role in the Treasury markets, especially as Janet Yellen telling Congress on Tuesday that they could explore the possibility of a 50-year ultra-long bond. Now, of course, this all comes with some changes that could come at the Federal Reserve. Nothing immediate, but worth watching that there are 7 members of the Federal Reserve Board. Only 6 of those seats are filled, and one of those seats belongs to Randall Quarles. He is the vice chairman of supervision. He was appointed in that role as one of the first people to have that specific title under Dodd-Frank, but his role as the vice chairman of supervision actually expires in October of this year. That could allow the Biden administration to replace that Trump appointee with someone that might be more sympathetic to the kind of capital regime that was put in place post-crisis. So a lot of moving parts there, but it seems like a lot of it is starting to come together in these early days, Kristen.
All right, Brian, we've got like 45 seconds. So I'm hoping you can walk us through what we can expect with some of these picks. If we can expect that the Biden administration will undo some of the deregulatory moves that we saw during the Trump administration.
Yeah, well, very quickly, I mean, the Trump administration did pare back some of those post-crisis Dodd-Frank regulations. They kind of tweaked, especially on the community bank level, what types of regulations and supervisory requirements are there for those small banks. But it seems like in all, the Janet Yellen-led Treasury would probably be very sympathetic to where capital levels are right now. So basically, in summary, I saw one Wall Street analyst said, this is really just going to be continuing the trajectory of where regulations were before the Trump administration. But as far as rollbacks, probably don't expect anything too dramatic.
All right, that was the quickest way to tell us what we can expect in 2021 and beyond. Yahoo Finance's Brian Cheung, thanks so much for being here and breaking that down for us. Now, we are expecting President Biden to speak on his coronavirus plans and a way to tackle the pandemic. Alexis Christoforous, oh my gosh, I can't speak today, will be picking up our coverage in the 2 p.m. hour next.
Good afternoon, everyone. Welcome to Yahoo Finance Live for this Thursday, January 21st. I'm Alexis Christoforous. Stocks are taking a bit of a breather. In fact, the market's got to catch its breath after its best Inauguration Day performance since Ronald Reagan was sworn in back in 1985. Right now, we have the Dow up about 10 points after being lower just a bit ago. The S&P 500 holding on with a gain of 2, and the NASDAQ rallying 57. We should note all three major indexes hit record highs yesterday. Now, President Joe Biden is expected to announce details of his ambitious COVID-19 response plan shortly. He promises to deliver 100 million vaccine shots in 100 days, and we'll take President Biden's comments live for you here on Yahoo Finance once he begins to speak. Meantime, investors are betting the economy will get a big boost once Congress passes another stimulus package. Also, the market got off to a pretty good start this morning. That's after the day's economic reports painted the picture of a pretty good economic recovery. First, jobless claims. They declined more than expected last week, but they still held at elevated levels. Initial unemployment claims totaling 900,000 last week. This is as the pandemic continues to take its toll on the U.S. economy. And demand for new homes pushed home building up 5.8% in December. Low mortgage rates continuing to support things there. And building permits, which we know are a good sign of future home construction, spiked by 4.5%. Now, we may just be a couple of weeks into 2021, but already the stock market's putting in a pretty solid performance. And early on, we saw the small caps outperform the large cap stocks. In fact, the Russell 2000 small cap index was up more than 8%. That hasn't been the case, though, the past couple of days. Jared Blickery has brought that to our attention. He's here now to talk about the rotation out of small cap, right, Jared, into the mega caps.
Yeah, and this has happened over the last 2 days. The mega caps have not been getting much love recently. So let's go to the Wi-Fi Interactive. A couple things to point out here. First, that underperformance by the Russell 2000 and the small caps, that's very obvious from right here, down 0.8% today when you compare that with the outperformance of the NASDAQ. And if you look in the NASDAQ 100, you can see the mega caps to the left largely in the green there outside of Tesla. Apple's up 3%, Alphabet's up 0.25%, Amazon up over 1%. And we got a note yesterday, late yesterday, from Piper, and they are actually upgrading Alphabet and Snap in the digital ad space. So this group contains Alphabet, Snap, Facebook, Pinterest, Twitter. And on Alphabet specifically, they're saying that they continue to innovate in core search with value accretive franchises emerging in cloud and YouTube. Price target is now 2,056, and you can see that's a cool, let's say, about 140 points or so, 130 points above current levels. And we also have new price targets on Snap. That is a price target of $66. And you can see Snap also close to record highs here. It is at 55 and change recently. And then also Facebook, target 275. Facebook has been one of the biggest underperformers, except over the last couple days. They have a performance target of 275 on that. And finally, Pinterest, a target of 70. Alexis?
All right. Also want to shine a spotlight here on Home Depot and Lowe's, because it looks like analysts are saying that our appetite for fixing up the house isn't going away anytime soon, and that's going to help those companies' bottom lines.
Yeah, and you mentioned in the intro that U.S. home construction starts rose in December, and this has been the best pace we've seen since late 2006. We know those building permits just on fire here. Now, Bank of America is upgrading these stocks based on what it has. It's a proprietary, they call it a Reno barometer. So it's kind of like home construction starts, but proprietary. And they're saying that this measures the outlook for consumer spending at home improvement stores. So for Home Depot, which, by the way, was a top pick for them in 2021, they are raising their fourth quarter comparable sales growth estimate to 19% from 70%. And their price target is now 355 from 350. You can see Home Depot is up 2% today. And if you take a look at what it's done over the last year, it's kind of been languishing over the last 5 or 6 months, waiting for a breakout. I would add that the home builders ETF, or excuse me, XHB, there we go. XHB just recently hit a record high. So these stocks have a little bit of catching up to do. Now for Lowe's, they're upping their fourth quarter comparable sales growth estimate to 20% from 18%, and their price target to 215 from 212. And we can see Lowe's has been consolidating as well, but it's closer to its record highs. And finally, I just want to point out Floor & Decor, a smaller stock. That's up 4% today, and really a nice chart from the lower left to the upper right after that COVID sell-off, 113% over 1 year. Now, Bank of America is upping their price target on this company to 110 from 105, and their comp sales estimate to 17% from 15%, Alexis.
All right. Speaking of raising your price target, I know that Yahoo Finance Premium is bullish on Disney today. There's a price target raised there by a street analyst. What can you tell us?
That's right. This is Argus Research, and part of our Yahoo Finance Premium package here, they're raising their price target to $200. And we can see on a chart here that let's go to a 6-month chart. You can really see the liftoff that we've gotten since November, up 45% over that time period. And here's Argus Research's reasoning for that. And just reading this a little bit here, here's their reasoning. Disney has been hurt by the pandemic and continues to spend heavily on its direct-to-consumer streaming video business. However, direct-to-consumer and Disney Plus have rapidly become central to the company's strategy. The success of Disney Plus is nothing short of remarkable, even considering the tailwind of stay-at-home consumer behavior. Alexis.
It really has been a remarkable run up, and the number of subscribers they've been able to get in a short amount of time. All right, got to get our daily dose of Bitcoin here. I know that it's come well off its highs. What can you tell us there?
Yeah, we were pointing out yesterday that it was in the process of breaking down, and now it is really broken down. Volatility is nothing anybody should be a stranger to with regard to Bitcoin here, but you take a look at what it's done over the last month. Yesterday, I was noting this consolidation pattern, this pennant formation. We're just beginning to break down, and now we have stair-step down, actually fallen almost to 30,000, just below 31,000. Now, we do have additional potential support areas at 25,000 and from 19 to 21,000 roughly. So we could stair-step down a lot lower, and that would be trimming roughly half of the gains that we saw from inception in Bitcoin. However, we could still find support at 30,000 and maybe stair-step up to those record highs again, Alexis.
All right. Thanks a lot, Jared. Want to stick with the markets now and bring in Sam Stovall, Chief Investment Strategist at CFRA. Sam, always good to see you. So do you think the stock market's going to have its honeymoon period with President Biden here and it's in his first few weeks in office?
Hello, Alexis. Well, if history is a guide, for it's never gospel, I would say yes, because if you go back to JFK, what you find is in the first 100 days of a new Democratic administration, the market has risen 3.5% and has fallen only once, and that was under poor Jimmy Carter's first 100 days in office. Every other Democratic president had a positive welcoming by the stock market.
Well, when you look at the market's behavior of late, do you think that it is warranted, the fact that we keep hitting these record highs? When you look at the fundamentals, I understand that investors are looking out and banking on more fiscal stimulus to help the economy get back on track. But when you look at things like earnings season, of course, just begun, and you look at the economic reports that are coming in, I mean, the job market is still in a lot of pain right now during this pandemic. Should the market really be rallying to record highs the way it has been?
Well, I would probably feel more comfortable if it did digest some of these gains. Just recently, we had the Russell 2000 almost 40% above its 200-day moving average, which is the highest on record since this index was created in the late 1970s. We're also looking at the price to earnings ratio on NTM, next 12-month earnings forecast for the S&P 500. And there we were 45% above the average over the last 20 years. So I would tend to say that it probably wouldn't hurt for us to digest some of those gains. And besides, history also makes us feel a little more confident that should we end up with a digestion of gains before August, there is a 95% chance that we end up with a positive full year, despite going into a year-to-date decline sometime before the end of August.
What are you forecasting there at CFRA for the market for the year 2021? Do you see gains, and if so, how big? I know RBC Capital came out recently and raised its target for the S&P 500 to 4,100. The S&P is around 3,800 right now. Where do you stand there at CFRA?
Well, back in December, we initiated our year-end 2021 target at 4,080. So 4,100 probably would be easier to mention, but about a 9.5% price appreciation. So maybe that makes me a bull, but with a lowercase b. I think that we are going to be seeing an improvement in economic activity as the year progresses. We will likely see an improvement in earnings. We're going to be coming out of this earnings recession in the first quarter of 2021, and gains are expected to be anywhere from 10% to 45% on a quarterly basis. So a lot of upward ramping, I think, is likely to take place.
What do you think will some of the catalysts be to get us to that place that you're talking about, Sam? I know that former Fed Chief Janet Yellen will have her confirmation hearing tomorrow to become the first female Treasury Secretary during this Biden administration. Do you think that she's going to be a dove for this market going forward in very much the same way she was when she was head of the Fed?
Yes, I do. I also think that Wall Street has a lot of confidence in Janet Yellen. She's a straight shooter and really does what is needed to be done to put a floor under the economy and to help propel economic activity. Right now, the estimate is for about $167 in earnings for the S&P 500. But I think we're going to have to get up to about 190, maybe even 200 by the end of the year in order to make Wall Street feel more comfortable with the current valuations. That would bring us closer in line with a multiple of 20 times rather than the 23 and change that we're looking at right now. So I would tend to say that coming in with another stimulus package that is more infrastructure and long-term oriented rather than simply putting a floor underneath those who have been furloughed or laid off, I think is what is needed to help propel the economy, share prices, and earnings.
We'll see how much Congress agrees with you when they take a look at Biden's $1.9 trillion stimulus package in the coming days. Sam Stovall, Chief Investment Strategist at CFRA. Thanks for being with us.
My pleasure. Thanks, Alexis.
Coming up here on Yahoo Finance Live, we're going to take a look at the airline sector as more big carriers are out with earnings and which exchange-traded funds stand to benefit the most under a Biden administration. We're back after this. Welcome back to Yahoo Finance Live. Time now to check in with Todd Rosenbluth, head of ETF and mutual fund research at CFRA. Hey, we just spoke to your buddy Sam Stovall in the previous segment. Todd, always good to see you. So just give us an overview before we really dive into specific ETFs. How is the market or demand for ETFs shaping up here as we enter the third week of the new year?
It's been really strong. We saw record inflows in 2020 for equity ETFs, for fixed income ETFs, for thematic ETFs. I could go on that. And the trend has continued thus far to start 2021. We've shifted a bit. Some of the themes that have become in focus have, of course, moved with the marketplace. But we think infrastructure, which I see you're showing on the screen, is a key theme that we're going to be focusing on in 2021, particularly with the Biden administration and the Democratic control of Congress taking this as a higher priority.
What are some areas? I mean, infrastructure sort of encompasses a lot, right, Todd? Are there areas within that? Can you get a little more niche for us? Where might we see the biggest opportunities during the Biden administration?
So these ETFs that we're showing on the screen are a combination of industrials and materials companies. In the case of PAVE, which is the Global X Infrastructure ETF, this is our favorite of those three ETFs we're showing on the screen because it's U.S. focused. So the other ones, the one from FlexShares and the one from iShares, are global in nature. So you get a mixture of Canadian companies, European companies. There's some exposure to Japan as well. And you also get exposure to various different themes like communication services and for example, consumer discretionary companies. We really think PAVE is a great way of focusing on this. You're going to see focus on bridges and road repairs, and the companies that are tied to construction equipment, United Rentals, for example, the companies that are tied to the materials that are going to go in to doing the roads and bridges are going to really be big beneficiaries of this. And this is why PAVE has not only done so well, but we've seen strong interest in this. It's now $1 billion ETF. It's gathered over 700 million of net inflows in just the past year. That's tremendous.
It really is. That is tremendous. All right, I want to stick with these thematic ETFs and talk about the environment, climate, ESG. It's been hot for a long time, but now with Joe Biden in the White House, one of the first things he did, he signed an executive order yesterday, including the U.S. once again in the Paris Climate Accord. What can you tell us in terms of those ETFs?
Well, we saw strong demand for this in the fourth quarter. We actually saw the amount of money and amount of assets actually double in just the fourth quarter alone for these clean energy related ETFs because of expectation. One, the fact that expectations that Biden would be the winner, that he ultimately was the winner, and then now the Senate has flipped to Democratic control. So we think that you got a lot of opportunities here in the global related products. There's ETFs like PBW that we're showing on the screen here from Invesco, which is our favorite ETF of the three. But we also see exposure more narrowly focused to TAN, which is solar energy related. And then iShares has a global clean energy ETF, ICLN. So solar, wind, other alternative energies have been in demand. These all ETFs have outperformed in 2020. They more than doubled in value. But we still think there's room to be able to go, as of course, as you mentioned, the Paris Climate Accord is now something that the United States is a part of. So we think there's still a lot of headroom to go for these related ETFs.
You know, I don't know if you'd call it a theme, but something we saw a lot of in the fourth quarter was more companies feeling comfortable initiating dividends again or raising their dividends. Is that something you believe will continue this year? And if so, where might investors want to look in the ETF space?
Right. So let's just backtrack a slight bit. What we saw in the second quarter, the end of the first quarter and the second quarter, companies were suspending or cutting their dividends as there was concerns about what was happening with COVID-19 and what impact that would have on the overall U.S. economy. Fast forward to the fourth quarter, we actually saw 10 times as many companies raise or initiate a dividend versus cutting or suspending the dividend. And we saw lots of sectors in the whole year of 2020 with disproportionately more dividend increases. Technology sector, utilities sector to barbell the growth and the more defensive sides of it. So DGRO has more exposure to those cyclical sectors like technology, whereas NOBL from ProShares is a bit more of a defensive. It requires companies to have raised dividends for the last 25 years. So you'll get exposure to industrials, but you'll also get exposure to utilities and other companies, whereas technology companies haven't been raising dividends for the last 25 years. We still think 2021 is going to be a great year for dividend investing. Companies that suspended or cut the dividend are likely to stop doing so, and perhaps maybe if they suspended, reinitiate that growth of what they saw. We think it's really a good time to be a dividend investor using the benefits of diversification that ETFs provide.
All right, Todd Rosenbluth, head of ETF and mutual fund research over there at CFRA. Always good to get your insights.
Thank you.
All right, want to take a look at the airline sector because it's in focus as more of the big carriers release their earnings. So far, we've heard from Delta, United Airlines, the latest, and again, pointing to all the problems this pandemic is causing the carrier. Emily McCormick has been on this one for us, and she's here now with the very latest. Coming under a little pressure here, United Airlines, huh, Emily?
Absolutely, Lexus. Taking a look here at these results, United Airlines swinging to yet another quarterly loss in the fourth quarter of 2020. That came out to an adjusted loss per share of $7 versus earnings of $2.67 in the same period last year. We also saw operating revenue come in at $3.41 billion, a bit light compared to estimates, and also nearly 70% over last year. Now, United also said that it expects first quarter revenue this year to be down 65% to 70% compared with the same period in 2019. So clearly continuing to see a lot of weakness here at the hands of the ongoing coronavirus pandemic. Now, one of the things that really concerned Wall Street, though, was what CEO Scott Kirby had to say on this morning's earnings call. And what he actually mentioned was, quote, what we are confident about is that the turning point is coming. And while our base case is that the turning point is coming a little bit later than maybe some others think, that turning point is coming, and it's going to come at the same time for all airlines. Now, that said, he did sound a bit hesitant to give a definitive answer on when that demand inflection point would take place, whether it's over the summer this year or in the second half of this year or beyond. The key date that United really pointed to was 2023 as the key year to watch. Scott Kirby said he believes that getting back to 2019 EBITDA margins will likely take place that year. And he also highlighted that we're likely to see leisure travel actually come back faster than business travel. And that's something that a number of other airline executives and analysts have also highlighted. Now, finally, I do want to highlight the cash standpoint that we have for United. They ended the fourth quarter with $19.7 billion in available liquidity. The company said that that would be enough to last them the rest of the crisis. We also saw that their fourth quarter cash burn was at an average daily rate of $33 million. So a bit more than we saw in the third quarter of last year, but a bit better than the second quarter when the pandemic first really hit the US. So all in all, we are seeing shares of United taking a hit today, of course. We are seeing some other airlines, including Southwest and Delta and American, also dropping in sympathy. So still a little bit of trouble here in the near term for these airlines, Alexis.
All right, thanks so much, Emily McCormick. Coming up on Yahoo Finance Live, Skybridge Capital's Anthony Scaramucci joins us as we look ahead to President Biden's first 100 days in the White House. Welcome back. Just want to remind everybody that we are waiting for President Biden to make his public remarks regarding his very ambitious plans for how to tackle the COVID-19 pandemic. Once he makes those remarks, we will bring them to you. Well, now that President Biden has taken office, he faces the reality of governing in the middle of a pandemic with narrow majorities in Congress and a lengthy list of policy goals.
We must end this uncivil war that pits red against blue, rural versus urban, conservative versus liberal. We can do this if we open our souls instead of hardening our hearts, if we show a little tolerance and humility, and if we're willing to stand in the other person's shoes, as my mom would say, just for a moment, stand in their shoes.
All right, joining me now is Anthony Scaramucci, founder and chairman of Skybridge Capital and Trump's former White House communications director. Anthony, thanks for giving us your time today. So you just heard that quote from Biden's inaugural speech yesterday. He talked a lot about unity. How difficult might that be in this current environment? I mean, we saw just a couple of weeks ago the staunch Trump supporters and how they feel about our democracy when they ransacked the Capitol. How difficult is it going to be for Joe Biden to be able to attain unity in this country over the next 4 years?
Well, listen, I think it will be difficult, but I don't think it's impossible. I thought the speech was very good. If you read the transcript, it was well delivered, but the transcript, the words themselves were absolutely beautiful. And I think he's on the right track. But I have this opinion, it may be right or wrong, that economic aspiration solves the ills of anger and the potentiality of violence. And so that's true in other countries, not just the United States. If people feel like their family's doing better and their children are going to do better than they are, they dial down the acrimony. And so, you know, one of the things that President Trump did in the last several weeks of his term was incite a lot of different things. And that's the reason why he was impeached again. If President Biden can come up with the right economic plan and economic policies to create more aspiration for lower and middle income people, I think this thing will abate itself faster than others think.
Do you think that he's going to get cooperation from Congress, where now in the Senate, the Dems have a very thin margin of error there? Is he going to get the support he needs for this $1.9 trillion stimulus package? Or might they work with him, but not too much, because maybe the Republicans want to take the White House back in the next 4 years?
Yes, and of course, they're not only the White House, they're playing for the congressional midterms. They obviously want to see if they can take back the House. And so obviously, you know, the Senate's in more or less a tie, but you get the point. And so, yeah, there'll be some resistance, but I don't think, again, this could be contrarian. I think what's happened here after watching the Capitol stormed, an insurrection, the potential violence on elected leaders, calling for the death of Vice President Pence and Speaker Pelosi, I think what's happening here now is people are like, whoa, this has gotten a little bit out of hand. It's a little bit too far. Let's see if we can put some things together that can put the country at ease and transition us into a different environment that's more cooperative. And I think that's in the best interest of both parties. So if you're a Republican strategist, you're saying to yourself, okay, we got to do that because it'll help us win the midterms. And if you're a Democratic strategist, you're saying the same thing. We got to do that so that we can expand our majority. So the good news is I think both parties recognize that that's probably the best choice for them in terms of where the incentives lie.
If you were advising President Biden right now on what he should be focusing on in the first 100 days, I mean, he has said that it is the pandemic. In fact, we're waiting for him to make some comments on his plan right now. But what would you advise him as it pertains to the economy?
I would go for the biggest possible stimulus. If you read any of my writings last March, I said this is a catastrophe for middle and lower middle income people. This is a war. I just want people to think about it this way. Imagine if a sovereign government invaded the United States last March. They killed 400,000 of our fellow citizens, on its way to 500,000, and hundreds of thousands of people, if not now millions, were being wounded by this sovereign governmental army. Imagine the governmental response from the United States, our civic leaders, our state and local governments. And so even though it's an invisible organism that's killing our fellow citizens and impairing us, we have to think of it like that. And when you put it in that context, a $1, $2, or $3 trillion stimulus to help our fellow citizens right now is absolutely necessary. Think of it as a war. Get together, drop the partisan rancor, and do what's right for America right now. And that would be my message to President Biden. And I think he knows that. We just got to convince the other people around him.
What would you tell him with regards to taxes? We know that he wants to raise taxes, roll back the tax cuts during the Trump administration, raise the corporate tax. And so many analysts we've talked to say that's going to stymie the stock market rally in 2021 if that indeed does happen. What would you tell him on the tax front?
Well, I would say that you've got headwinds, and you've got the pandemic plus economic desecration through the country. Go back to 2008 and 2009. You were part of the Obama administration. You couldn't get taxes raised until the economy healed. But I would also respect the idea that moving from 21 to 28 or back up to 39.6, given the massive amount of deficit spending that we're doing, I would respect at some point that will be likely, whether people listening to us right now like it or not. But now is not the time to do that, and any more than it was the time to do that in the 2009, 10, early part of 11 time period while we were digging ourselves out of the global financial crisis.
So you think raising taxes does make sense, especially given the fact that we've really dug ourselves in quite the debt hole with all the money that we need to spend during this pandemic?
Well, remember, if you're not going to raise taxes, deficit spending is unfunded tax liability. So someone's going to ultimately pay it. If you want to push it off to our children and grandchildren, we can do that. I don't think that's necessarily responsible. The flip side is if you never want to pay it off, you could do that as well. You could just monetize the debt. But we know from sociology, when you're monetizing the debt, it weakens the living standards for lower and middle income people because they're mostly getting their money in wages. When you devalue money, if you own assets, the assets go up in price, but wages usually don't. So I'm more in the camp today as an older person of deficits don't matter, but I do recognize they matter somewhat. I would encourage people to read Stephanie Kelton's book, The Deficit Myth. She's a modern monetary theorist, writing a very compelling book about the need for deficit spending right now, but also recognizing that at some point you don't want to overdo things. And so we just have to find that inflection point. But now is not the time to raise taxes any more than it was with the first part of the Obama administration.
All right, you're not an older person, by the way. You're still a youngin' there, Anthony.
All right. Well, I mean, look, there's a lot of Botox and hair dye. Okay, I've Joan Riverized a little bit. You know what I mean? I think I look pretty good for 105.
You are preserving very, very well. All right. I want to talk a little bit about your former boss, Donald Trump, who did not attend that inauguration yesterday. The first time that's happened where an outgoing president has not gone to the inauguration of the incoming president in more than 150 years. So I just want to run a soundbite from what he said yesterday in his last public appearance as president, and then get your reaction.
The things that we've done have been just incredible, and I couldn't have done it without you. So just a goodbye. We love you. We will be back in some form. So have a good life. We will see you soon.
So, Anthony, you know Donald Trump personally. Hearing that, what form might we see him come back in?
Well, I know him well enough to know that the body language was horrific all day yesterday. That was a defeated person for sure. He's saying have a good life. He's never acknowledged that 400,000 people died under his watch and as a result of his malpractice and malfeasance and the 33,000 plus lies that he told while he was president of the United States. So when he says he's coming back in a form, I guess he means he's going to be a political power going forward. I personally would like to get out of politics and back to business. But if Mr. Trump thinks he's going to be a political power going forward, then we're going to continue to hit him as hard as you can hit him from a metaphorical perspective in politics, because white ethnocentric nationalism and the dividing of the country through anger-based politics and tribalism is not the answer for the United States in 2021 or beyond. The answer for the United States is unity. America first is a bunch of nonsense. We need to think of ourselves as Americans first, or first we are Americans, and we've got to unify the country. And so President Trump's message is off key. It's not the right message for us. It's not the right message for America's reflection upon the world. And so if he thinks he's coming back, my bet is he won't be able to. You will remember last year, you and I were in Davos together. The entire elites in Davos said he was winning re-election. You can find the tape where I said to you, there's no way he's winning re-election. He's going to lose because of his personality. And I'll say very declaratively today that there's no chance he'll be the 2024 nominee for president of the Republican Party. And we will work tirelessly to make sure that that happens.
You were right. We were in Davos, and of course, it seems like a lifetime ago, and it was only a year ago, and so much in our world has changed. But Anthony, as an entrepreneur, as a businessman, as Trump goes back to civilian life, what happens to his companies? What happens to his businesses? We've already heard that the city of New York wants to start to sever ties. Buildings are taking his name off of them. You know, how is he going to be able to survive as a business person?
Well, listen, he's a resourceful person. So people that are going to report on his demise as a business person should go back to the early 90s when he had a series of bankruptcies that he survived and ended up flourishing after those bankruptcies. I think he's done a lot of favors for people. Remember, he's curried favor with autocrats and dictators around the world for the last 4 years. He unclipped his executive order related to lobbying the government. And so he's going to be looking for favors from all those people that he put into powerful positions. And so I wouldn't write him off necessarily. I do think that he has assets in his favor, and that would be my recommendation to him. If his business is weak now as a result of the pandemic or his destruction of his personal brand and his business's brand, focus on the business, get out of politics, and try to revitalize it.
All right, so if he gets out of politics, and we don't know if that's really going to be the case, what about other Trumps? Don Jr., Ivanka, can you see them having a future in politics? Might one of them become the face of the GOP?
Well, listen, I've made it a matter of policy not to talk about the family because, when President Trump attacked my wife on Twitter, on his presidential Twitter feed in August of 2019, I just made a decision. I'm not going to really talk about them. I wish them well. I always got along with them, whether it was Jared, Ivanka, Eric, or Don Jr. One of them, I'm not going to mention who, said to me a long time ago, I don't really want to be fighting with you. Your fight is with my father, and I don't really like the idea that my father's fighting with you. You raised him $1 million, hundreds of hours of media advocacy. I'm sorry, I gave him $1 million, raised him tens of millions of dollars. But, listen, he's hurt them from a political perspective, but I like them, and I would prefer not to overly comment about them.
All right, fair enough. But when you look at the Republican Party right now, a very divided party, where does it go from here? Who is it going to look to for leadership? What happens with Mike Pence, who we saw in the final weeks of the presidency distanced himself more and more from President Trump, whom he was very close with?
Well, but that happens. Remember General Kelly, who I've become personal friends with now. General Kelly fired me from the White House. We're good friends now. That's the strange bedfellows of politics. He would tell you that all relationships end badly with Donald Trump. So it's no surprise to me that even how loyal and supplicant almost to President Trump, Vice President Pence was, that they would be in this situation at the end, because obviously he couldn't do what President Trump was asking him. So I think the vice president may run for president. He'll have standing. He's a credible guy. There are 10 people in that party that see themselves as president or a future president. And what I would say to all of them is there's a tremendous vacuum of leadership. Don't fall back on Trumpism. There's a venality to it. There's almost a evil malevolence to it. Inspire people, look to the future and grow the party, and think about the wonderful, colorful mosaic of the American people, and see if we can expand the tent of the party to reflect more of what the American people are, both demographically and culturally. And you don't have that right now. You've got a lot of standard, cynical politicians in the mix, but you never know. Maybe somebody will come around and sort of restate those principles and have an audacious vision for the future that can knit that party back together. I certainly would love to see that.
Before we let you go, the number one thing you think President Biden could do, should do to help corporate America through this pandemic?
Well, learn something from President Trump. I would say to President Biden, let's not focus on left or right policy or currying favor with special interest groups right now. Let's focus on what's right or wrong for America. And one thing that President Trump got right was a lighter touch on regulation. Have more trust in the business community. That will help these companies grow. It'll give them confidence to invest and deploy capital as we come out of the pandemic. Don't be cautious on raising taxes. Let's create more jobs. Let's get the wheel moving in the system. Don't overregulate. Don't virtue signal in a way that's going to be damaging to jobs creation. That would be my message.
All right, and we are going to leave it there. Anthony Scaramucci of Skybridge Capital. Always good to chat with you. Be well.
It's a lot of fun for me. Thank you for having me.
Thanks. All right, switching gears now. Our nation's capital looked a lot like a military staging area, right, at yesterday's presidential inauguration. It was the largest security presence of any president swearing in. And of course, it came just 2 weeks after those deadly riots at the U.S. Capitol. Joining me now is Bill Bratton. He is former chief of police in New York, Boston, and Los Angeles. He is currently an executive chairman, at Teneo. Bill, always good to see you. Thanks for your time. We haven't had a chance to talk since all of the insanity at our Capitol just a couple of weeks ago. I'd love to get your initial thoughts on what happened and then law enforcement response.
Well, I think everybody is well aware of the many failures on January 6th on the part of law enforcement, particularly Capitol Police. Good intelligence analysis, but no follow-up in terms of planning or placement of resources. That's going to continue to be investigated, continue to be discussed. But the good news was it happened 2 weeks before the inauguration. So you can only imagine if that had occurred on Inauguration Day. The turnout of resources for Inauguration Day, based on what happened on the 6th, as well as some of the ongoing intelligence gathering and analysis, was appropriate. Good news is that it was not necessary in the sense of having to be used to deal with large-scale demonstrations or any type of violence being directed against anybody or any event during the 20th yesterday. In terms of going forward now, it'll be a matter of how quickly they disassemble the very large security presence they put into place. I would advocate, without having any intimate knowledge of the intelligence that they're looking at, that the faster they do that, the better.
You know, President Biden spoke about political extremism recently. I'd love for you to take a listen, for us all to take a listen at what he had to say.
A rise of political extremism, white supremacy, domestic terrorism that we must confront and we will defeat. To overcome these challenges, to restore the soul and secure the future of America, requires so much more than words. It requires the most elusive of all things in a democracy: unity.
Of course, that was during yesterday's inaugural address. Do you believe, Bill, that domestic terrorism is this country's biggest threat right now?
Certainly, and it will remain so for the foreseeable future. ISIS, Al-Qaeda have been somewhat boxed in after the failed attempt to establish and keep a caliphate on the part of ISIS. We still have very good intelligence capabilities to keep an eye on what they're up to. Neither of them has ever been able to successfully penetrate the United States, with the single exception of 9/11. A lot of their efforts to form cells have failed. A lot of their initiatives to try to encourage Americans to basically become terrorists. Some have succeeded, but fortunately, we were able to get most of them before they were able to engage in their acts of terrorism. So putting them off to the side, I shouldn't say put them off to the side, we're going to still have to focus on them. But the immediate danger, and for the foreseeable future, was in evidence on January 6th, where so many of the names that have become now so commonplace in terms of these right-wing militias and some of these organizations, that they are the clear and imminent danger to our country at the moment. And the focus on them by both local law enforcement and by federal agencies will be intense. And we benefit from their activities on January 6th because it gave us a trove of intelligence relative to who they are, what they intended to do on the 6th, and what some of their future plans might be.
You know, you mentioned 9/11. Of course, the events that happened that day changed security throughout the world, especially when we fly a plane forevermore. What we saw happen at the Capitol just a couple of weeks ago, how is that going to change law enforcement? How is that going to change security for us as citizens of the U.S., for those of us who might be wanting to go to D.C. and visit the monuments and the Capitol one day?
Well, I think you're going to find a lot more focus on security systems as we're moving forward into the 21st century. New types of systems are being developed all the time, new, more efficient metal detectors, facial recognition types of systems, drone technology. So the idea of visible security, as well as a lot of security that you're not even going to be aware of, is going
Bill,
to continue.
I have to interrupt you. I'm so sorry. We're gonna join President Biden, who's speaking about his COVID-19 plan. We'll be back in a moment.
A few moments to thank all the law enforcement folks for all they did, the military personnel from all across the federal, state, and local agencies that secured yesterday's inaugural activities. And a special thanks to the members of the National Guard from around the country. It was an unprecedented situation. Hope will never have to be renewed again. And everyone handled with the most professionalism and duty and honor that you could be expected. The President, as Commander-in-Chief, I always respect and revere their service and that of their families. But now to today's announcement. Vice President Harris and I were joined by members of our COVID-19 team, response team, Dr. Tony Fauci, our Chief COVID Medical Advisor, Javier Becerra, our nominee for Secretary of Health and Human Services, Dr. Vivek Murthy, our nominee for Surgeon General, Dr. Rochelle Walensky, she's going to be the Director for the Centers for Disease Control and Prevention, and Dr. Marcelo Nunez-Smith, who will be leading our equity work and the COVID response, and Jeff Zients and Natalie Quillen, who are managing this whole effort. Yesterday, during my inaugural address, I offered a salient prayer and a silent prayer. It was both salient and silent. I thought it was important that people understand what had happened, that we all pay tribute to our prayers for those 400,000 Americans who've lost their lives in this pandemic. On Tuesday, Jill and I, Kamal and Doug, we stood at the reflecting pool in front of the Lincoln Memorial and joined Americans all across the country to remember those 400,000 moms and dads, husbands and wives, children, sons, daughters. And I said at that moment that to heal, we must remember. To heal, we must remember. It's important to do that as a nation. We must also act, though, not just remember. Yet for the past year, we couldn't rely on the federal government to act with the urgency and focus and coordination we needed. And we have seen the tragic cost of that failure. 3,000 to 4,000 deaths per day. To date, more than 24 million Americans, 24 million Americans have been infected. To put that in context, America makes up 4% of the world's population, but 25% of the world's confirmed COVID-19 cases and only 20% of all the COVID-19 deaths when we have 4% of the world's population. The pandemic, has disproportionately impacted on Blacks, Latinos, and Native Americans, who are about 4 times as likely to be hospitalized and nearly 3 times more likely to die from the COVID-19 pandemic than white Americans. Hospitals are out of beds. Businesses are closed for good. Schools are caught in between. And while the vaccines provide so much hope, the rollout has been a dismal failure thus far. So I understand the despair and frustration of so many Americans and how they're feeling. I understand why many governors, mayors, county officials, tribal leaders feel like they're left on their own without a clear national plan to get them through the crisis. Let me be very clear. Things are going to continue to get worse before they get better. The memorial we held 2 nights ago will not be our last one, unfortunately. The death toll will likely top 500,000 next month. The cases will continue to mount. We didn't get into this mess overnight, and it's going to take months for us to turn things around. But let me be equally clear. We will get through this. We will defeat this pandemic. And to a nation waiting for action, let me be the clearest on this point. Help is on the way. Today, I am unveiling a national strategy on COVID-19 and executive actions to beat this pandemic. This plan reflects the ideas I set forward during the campaign and further refined over the past 3 months. It consists of my transitions teams, the task force, Tony Fauci and the team here today and other experts put this plan together. Our national strategy is comprehensive. It's based on science, not politics. It's based on truth, not denial, and it's detailed. You can review this entire plan by going to whitehouse.gov. It is so detailed, it is over 198 pages in complete detail what we're going to do. Our plan starts with mounting an aggressive, safe, and effective vaccination campaign to meet our goal of administering 100 million shots in our first 100 days in office. We're on day 1. This will be one of the greatest operational challenges our nation has ever undertaken. And I'm committed to getting it done. We're committed to getting it done. And as I explained last week, we'll move heaven and earth to get more people vaccinated for free and create more places for them to get vaccinated, to mobilize more medical teams to get shots in people's arms, and to increase vaccine supply and get it out the door as fast as possible. Yesterday, we got started. We directed the Federal Emergency Management Agency, FEMA, to start standing up the first federally supported community vaccination centers with the goal of standing up 100 centers within the next month. The Centers for Disease Control and Prevention will launch the federal pharmacy program to make vaccines available to communities in their local pharmacies, beginning early within I think it's by the 7th or 8th of February, but in very early February. We'll also task the Department of Health and Human Services to prepare and expand the pool of medical professionals who can administer the vaccine, and to ensure we have enough vaccinators, the people doing the vaccines, to meet the nation's needs and quickly. In addition to this effort, our administration will be asking Congress to fund for the funds to grow the public health workforce. We also are going to take immediate steps to partner with governors, mayors, and other local officials who we've been talking to all along, who are on the front lines of this fight. We directed FEMA to establish a COVID response liaison for each state, which means every state will have a point person at the federal level to maximize cooperation between the federal government and the states, and where it falls short, to be made known about it, be made known immediately. This is a model we used to respond to Hurricane Sandy, which I was deeply involved with. And in just a few moments, I'm going to sign a declaration to immediately begin reimbursing states 100% for the use of their National Guards to help COVID relief efforts, something Democrats and Republican governors alike have called for. But the brutal truth is, it's going to take months before we can get the majority of Americans vaccinated. So, while we increase vaccinations, we're going to take steps necessary now to slow the spread of the disease as well. One of our 100-day challenges is asking the American people to mask up for the first 100 days, the next 99 days. The masks have become a partisan issue, unfortunately, but it's a patriotic act. But for a few months to wear a mask, no vaccines, the fact is that they're the single best thing we can do. They're even more important than the vaccines because they take time to work. And if we do this as Americans, the experts say by wearing a mask from now until April, we'd save more than 50,000 lives going forward, 50,000 lives. So I'm asking every American to mask up for the next 100 days. Yesterday, I signed an executive action that requires masks and social distancing on federal property. Today, we'll be signing an additional executive action to extend masking requirements on interstate travel, like on trains, planes, and buses. And in light of the new COVID variants that you're learning about, we're instituting now a new measure for individuals flying into the United States from other countries. In addition to wearing masks, everyone flying to the United States from another country will need to test before they get on that plane, before they depart, and quarantine when they arrive in America. Our national plan launches a full-scale wartime effort to address the supply shortages by ramping up production and protective equipment, syringes, needles, you name it. And when I say wartime, people kind of look at me like wartime. Well, as I said last night, 400,000 Americans have died. That's more than have died in all of World War II. 400,000. And this is a wartime undertaking. Today, I'm signing an executive action to use the Defense Production Act and all other available authorities to direct all federal agencies and private industry to accelerate the making of everything that's needed to protect, test, vaccinate, and take care of our people. Well, we've already identified suppliers, and we're working with them to move the plan forward. Now, look, our strategy includes a plan to safely reopen schools and businesses while protecting our workers. Today, we're directing the Department of Education and the Department of Health and Human Services to immediately provide schools and communities with clear guidance and resources to safely reopen the schools and child care centers. We're putting, and by the way, when you do that, think of all the people who can get back to work, be able to get back to work, all the mothers and single fathers who are staying home, taking care of their children. We're going to put the full force of the federal government behind expanding testing by launching a COVID-19 pandemic testing board. This effort will ensure that we get testing to where it is needed and where it's needed most, helping schools and businesses reopen safely and protecting the most vulnerable, like those who live in long-term care facilities. And for the millions of workers, many of whom are people of color, immigrants and low-wage workers, who continue to put their lives on the line to keep this country going through the pandemic, I'm calling for the enforcement of a more stringent worker safety standards so that you are better protected from this virus while you have to continue to work to protect the rest of us. Our plan also protects those most at risk and works for everyone of all races and urban and rural communities alike. Today, I'm formalizing the Health Equity Task Force that we announced in the transition, led by the brilliant Dr. Marcela Nunez-Smith, who is going to ensure that equality is at the core of every decision we make. That includes addressing vaccine hesitancy and building trust in communities, as well as fighting disinformation campaigns that are already underway. Above all, our plan is to restore public trust. We will make sure that scientists and public health experts will speak directly to you. That's why you're going to be hearing a lot more from Dr. Fauci again, not from the president, but from the real, genuine experts and scientists. We're going to make sure they work free from political interference and that they make decisions strictly based on science and healthcare alone, science and health alone, not what the political consequences are. The Vice President Harris and I and our entire administration will always be honest and transparent with you about both the good news and the bad. We will level with you when we make a mistake. We'll straight up say what happened. And I said at the outset, the honest truth is we're still in a dark winter of this pandemic. It's going to get worse before it gets better. It's going to take many months to get where we need to be. Progress from our plan will take time to measure as people getting infected today, they don't show up as case counts for weeks. And those who perish from this disease die weeks after their exposure. Despite the best intentions, we're going to face setbacks, which I will always explain to you. But I also know we can do this if we come together. That's why, ultimately, our plan is based on unity and all of us acting as one nation. It requires families and neighbors looking out for one another, healthcare providers, and business and civic and religious and civil rights organizations, and unions, all relying together on a common purpose with urgency and purpose and resolve. It requires reasserting our global leadership, which is why I took an action yesterday for the United States to rejoin the World Health Organization and to reestablish our global pandemic office in the National Security Council. It requires Congress coming together to provide the necessary funding in the COVID relief package and the American Rescue Plan that I will soon be sending to the Congress. I know these bold, practical steps will not come cheaply, but failing to do so will cost us so much more dearly. I look forward to working with members of both parties in the Congress. We're in a national emergency, and it's time we treat it like one, together with a national plan as the United States of America. As I said yesterday in my inaugural address, there are moments in history when more is asked of a particular generation, more is asked of us as Americans than other times. We are in that moment now. History is going to measure whether we're up to the task. I believe we are. The American people have given so much already, but I believe they're ready to set big goals and pursue them with courage, conviction, and honesty, because the health of the nation is literally at stake. It's not hyperbole. I'm convinced the American people are ready as well to spare no effort, no expense to get this done. What could be more important? The more people we vaccinate and the faster we do it, the sooner we can put this pandemic behind us, and the sooner we can build our economy back and build it back better and get back to our lives and to our loved ones. We can do this. We can do this if we stand together as fellow Americans as the United States of America. So God bless those lost souls in this pandemic and their families, all they left behind. And may God bless all of you on the front lines who define the best of who we are as Americans. Thank you very much. Now I'm going to go over to this desk and sign these executive actions. But again, this is the plan. This is the plan. You can go online and get it. I know it's a lot of heavy reading, but it's all laid out in stark detail here. Thank you.
You're looking at a live video feed of President Joseph Biden actually signing his executive order on the plan he has just outlined to ramp up vaccinations of the COVID-19 vaccines that are available here in the United States. And as we head toward the closing bell and we watch the president in action, just want to let you know that markets right now are trading higher. They've been going back and forth between negative and positive territory, but it's details of the plan which are most important. And Shauna Smith is obviously here. She is one of the anchors for these 2 hours here at Yahoo Finance. And among the things that the president was promising, Shauna, is 100 shots in 100 days. What else?
He was. And Adam, I think the one thing that stood out to me in what we just heard from President Biden was, once again, it was a continuation from yesterday. And he was reiterating the fact that we can beat this virus, but we need to do it together. So really putting an emphasis on the unity message there, similar to what we heard from yesterday. But yes, Adam, you're right. He said that it's going to take time. He was encouraging Americans to mask up, saying that if Americans do wear masks until April, it could save up to 50,000 lives. So once you put numbers like that, it really puts in perspective the change that we could possibly see happen here within Biden's first 100 days. A couple of other things that he did outline that stood out to me was really just the details that he was able to present. He said that there is a 198-page long national strategy that anyone can get access to. You can go to whitehouse.gov, get access to that, and that really outlines how the U.S. is going to get this virus under control, how they will try to get the virus under control over the next several months. But once again, Biden saying that he's asking Americans to mask up, saying that if you are arriving from outside the country, you do need to get tested before you enter the U.S. And also, once you do get to the U.S., that you will need to quarantine for that recommended time period at this point. And he was saying that he's reopening guidance will be given to schools as well. And he's starting a COVID pandemic testing board. So all this here just giving us a little bit more details on how the Biden administration plans to deal with COVID when we're getting these record high numbers day in and day out, Adam.
That's right. To get a much more detailed look at what's coming down the pike, because the president is also talking about using the Defense Production Act to speed up production of vaccines. We want to bring into the stream Anjali Khemlani. She covers all things COVID related for us here at Yahoo Finance. And what are you picking up from what the president has just said, Anjali?
Well, Adam, we know that right now he's signing those executive orders. That does include invoking the Defense Production Act for what he said is all things related to the COVID-19 response. That could include tests, treatments, syringes, and for vaccination. Basically anything that's necessary. And it seems like this is exactly along the lines of the federal coordination that health experts have been calling for so long. The direction and the emphasis on reimbursing states. He said this multiple times now. Reimbursing states 100% for their efforts, for using their National Guard for any of these efforts as well. He said specifically, we are in a national emergency. It's time we treated it like one, clearly defining the shift from just sort of keeping everything in-house. Also noting that we're going to hear more from the health officials like Dr. Fauci and others that we haven't heard from. That is definitely going to be a shift as well. But of course, these executive orders very specifically going to be helping with a lot of other strategies as well. We know that reopening schools, reopening businesses is also a part of that, as well as looking at all the different states and how they can be helped with standing up these vaccination sites, noting that they're already starting the centers through FEMA with 100 set to be set up by next month, and looking at pharmacies, which is something that some experts have doubted. We did hear CDC Director Rochelle Walensky earlier today saying that vaccinations broad scale in pharmacies probably unlikely in February, but right now President Joe Biden saying by February 7th or 8th, we could start to see that. So a lot going on, a lot to unpack here, but definitely seeing that momentum continuing from yesterday, as Shauna mentioned. Back to you guys.
All right, Anj, thanks so much. We want to continue this conversation here and bring in our next guest. We want to bring in Dr. Asha Shah, Associate Director of Infectious Diseases at Stanford Health. And Dr. Shah, great to have you on the program. I'm curious just first to get your reaction to what we just heard from President Biden, clearly stating and laying out the Biden administration's focus here as we do work to combat the spread of the virus. Do you think it's going to be effective at this point?
Hi, thank you for having me back on the show. Yes, it's just a sigh of relief, and we're very happy and relieved that these new plans are being put into place, and it's hope. And I do think that it's possible if we have the resources in place and the supplies in place to get vaccines in people's arms as quickly as possible to beat this virus. So very happy on our end.
When we hear the president say that we're going to have more than 500,000 dead in a month, and it'll take several months to turn this around, aren't those vaccines which are already approved, aren't they already at max capacity of production? What are we missing here?
Well, I think the main two issues, at least that we're experiencing here locally, is our vaccine supply as well as staffing. But it's really about that supply chain and increasing the production of the vaccines. If we can get the supply and get the materials that we need, we've experienced here locally that the community is ready to help. And we have recruited a fair number of individuals for our vaccine clinics and our vaccine hubs, but we need the vaccine. And so I think that's the key.
Dr. Shah, Anjali here. Looking at what we know about the variants, both from the UK and South Africa, it seems like the South Africa one is specifically a concern when it comes to the vaccines. We seem to be in this race against time. So with the sort of elongated timeline, the not knowing whether or not we're going to get broad vaccinations by February, are you concerned at all with what the impact is going to be then for hospitals and health systems?
It's something that we're watching very closely. At this point in time, we don't believe that the variants that are being seen have any effect on the vaccine efficacy. But the viruses can continue to mutate and change. And so it's kind of, we're racing against this. And I think that's what makes it even more important to vaccinate as many people as fast as we can. What we do know about the mutants is that it can make the virus more transmissible, which makes it even more important for everyone to mask up and socially distance and continue to practice those infection prevention measures until we can get enough vaccines into arms.
Dr. Shah, I'm curious just if you could give us a better picture on what the situation is currently like in your hospital and whether or not you have had access to all the supplies and everything that you need at this point in the pandemic.
Sure. So we started our vaccination campaign back in the beginning of in the middle of December, and we were initially administering about 1,500 vaccines a week. Now we have ramped that up and expanded to giving about 1,000 vaccines per day, starting this week, in line with the rollout of Phase 1B in Connecticut. So we are receiving vaccine supply. We are keeping a close eye on our supplies, including syringes, gloves, and all of the things that we need to run a vaccine clinic safely. However, we have been working very closely with the state as well as our hospital association. And, the allocation may change in the weeks to come. And that's what's really going to affect how many people we can vaccinate. It's how many vaccines that we can get in the state and in that supply chain.
Looking at where we are right now, some states are trying to reach out to the companies to get the vaccines. We also know that President Joe Biden just talked about standing up vaccination centers with FEMA. All of that put together, where do you see sort of the most potential right now and what can help move that forward?
I think that we've had great success here in our state with our collaboration. So I think working very closely with our State Department of Health and other hospitals in the region has really proven to be successful. So I think that collaboration statewide is a very effective strategy to move this forward, so that we're all on the same page and we all have the same priorities and we're vaccinating the same groups of people at the same time. In an organized fashion. I think that's the key.
So when we hear the president talk about creating a task force to allocate resources to the communities that have been hardest and using outcomes by race, ethnicity, geography to do that. For instance, we know Staten Island, the Bronx in this part of the country have been hit very hard. How would that get us closer to this herd immunity goal if we do the vaccination programs that way?
I think we've recognized that here as well, those at-risk groups. So not only individuals that are in the elderly population, but it's individuals that are in minority groups, underserved populations. And so I do think that getting the vaccine physically to those communities and making it easy for them to line up and get a vaccine, I think is key, because those are the individuals a lot of the times that we see in our hospital that are sick and in our ICUs. And so those are key populations that we need to reach. And we also need to address the vaccine hesitancy amongst those groups and answer any questions or concerns they may have about the vaccine safety.
Doctor, we got news today, the study of one of Eli Lilly's antibody drugs really showing that it reduced the risk of COVID-19 in nursing homes. I guess my question to you is, how do you see this fitting into the prevention efforts that could be enacted here in this country? And then when do you think it would make sense to potentially use a drug like this going forward?
So we've been using monoclonal antibody therapy here at our hospital for about 2 months now, both therapies put forward by Lilly and by Regeneron. And we are using these infusions on COVID positive patients who do not require hospitalization. It's an outpatient infusion, and it has been shown to decrease the risk of hospitalization and decrease the risk of adverse outcomes from COVID. We've set up a very successful program here, and I think that it's another tool in our toolkit that we did not have back in the spring to help kind of tackle this infection. And it's almost like a bridge to a vaccine. It's really giving folks with COVID that extra kind of immune response to fight the COVID that's in their system, to prevent them from ending up in the hospital. So I do think it's a nice strategy, and the one that we have used here pretty regularly.
Dr. Asha Shah is Associate Director of Infectious Diseases at Stanford Health. We appreciate your being here on this breaking news moment as we confront the COVID-19 pandemic along with President Biden. We're going to have much more for you as we are roughly 43 minutes away from the closing bell.
Day two for President Biden. The new administration is not wasting any time. They've already taken steps to address key issues with executive actions. We want to bring in Jessica Smith, who has the latest on this for us down in D.C. And just specifically, you're looking at the plan that Biden laid out last week when it comes to the COVID-19 relief package, the $1.9 trillion package. Where does that stand in the odds that he could get something like that passed in Congress?
Right. And you heard him talking about just how important it is to have legislation in addition to those executive orders that he signed yesterday and today. We did hear from Speaker Pelosi earlier this morning. She was praising the plan, saying that has many elements that House Democrats have been pushing for all along. She did say that the House is going to be out all of next week. She said they'll be doing committee work on COVID bills during that time, so they'll be ready to go to the floor when they come back during the first week of February. Now, of course, Republicans are already pushing back on several aspects of the $1.9 trillion plan, including that $15 minimum wage. Some Republicans think they just don't need another package right now since they just passed one a couple of weeks ago. The new NEC director at the White House, Brian Deese, said today's jobless claims were a stark reminder that more help is needed, though. And White House Press Secretary Jen Psaki told reporters yesterday that the White House wants to get something done in a bipartisan way, but they're not taking any options off the table if that's not possible. We have heard from Senator Bernie Sanders, who said that they could use reconciliation to get that done if need be. That only requires a simple majority vote. And here's what Speaker Pelosi had to say when she talked to reporters about all of this earlier today.
We have a responsibility to find bipartisanship where we can, to find our common ground where we can. We have that as not only a goal, but a responsibility. When we can't, we must stand our ground. That's Thomas Jefferson, standing the ground like that. But it is, if we're talking about what the country needs to crush the virus.
Shauna and Adam, you might remember that bipartisan group of senators that we saw late last year come up with that $900 billion relief bill. It really pushed the leadership to hammer out a deal. That same group is expected to meet with the Biden administration soon, possibly as soon as this weekend. So we'll see if they're able to find any common ground.
All right, Jessica Smith, thanks so much. Let's talk about what all this could mean for the markets, because we just have under 40 minutes to go in the trading day, and you are looking at gains across the board. Dow, S&P, and NASDAQ all in the green, although by a slight margin here. The Dow up only 28 points, S&P up just 7 points. The NASDAQ, though, hitting a new record today. Here to break all this down, we want to bring in John Trainer. He is the Chief Investment Officer of People's United Advisors. And John, great to talk to you. Let's just start with what the Biden administration means for the markets, because we had a record day yesterday, stocks continuing to push higher today. What's your read on that and what we could expect here over the next, I guess, couple of months, or if we want to look out even further, next couple of years?
Yeah, really, over the last couple of months, we've seen the vaccine rally and the Biden rally, and I think they're both combining to really set us up for a good year ahead. I mean, what you've seen really since the election is that cyclical stocks have done well, the financial stocks have done well. All those stocks that are tied to a reflation have done well, and we think they're going to continue. I think Joe Biden is setting a good course for the economy. He's setting a good course for the market going forward.
So, John, I'm curious, when you talk to clients, and a lot of investors always want to know, where should I go? One of the things you mentioned are industrials, and that sector today, and I realize one day does not the future make, it's off by 0.5%, but it's underperformed other sectors over the last 52 weeks. It's only gained about 6%. So why do you think it has more room to grow at a better pace?
You know, that's a great question, because we are talking to a lot of clients. I'm doing, I don't know how many presentations on a weekly basis. And one of the things we're advising them is that, you know, again, unfortunately, a lot of us invest through a rearview mirror. And if you take a look at all the great funds that did very well last year, they were very, very loaded up on technology, very, very loaded up on growth stocks. And we really think we're seeing an inflection point now. So we're spending a lot of time talking with clients thinking, you know, don't look at last year's winners. You know, certainly they were good stocks and we hope you own them. But really what you want to do is look forward and get yourself exposed to a cyclical recovery. You know, I put together a chart for clients where I said, normally, you know, if I was speaking to them just a year ago at this point, I'd be saying you should have a late cycle portfolio. Lots of growth stocks, lots of large cap stocks, defensive stocks. I said, right now, you should have an early cycle portfolio. Be exposed to beta. Small caps we think are going to do very, very well. Value stocks are doing very, very well. So you really need to, number one, we're spending a lot of time talking with people, but you really need to shift your thinking to that early cycle reflation type portfolio.
And John, when you talk about shifting your thinking, I think the one thing that investors have been trying to wrap their heads around. And this has been the case now for several months. And that's the disconnect that we're seeing between the market and the economy, right? So today we're at record highs once again, and we got another pretty dismal jobs report when we look at the jobless claims number coming in at 900,000. Yes, better than expected, but still extremely high. How is the market looking at this continued elevation of claims? And I guess, how do you think, or do you think it will end up catching up to the market at some point?
Well, you're raising a good point. And that, again, that comes up in client conversations all the time. We raised our equity allocation from neutral to overweight equities in April last year. And a lot of people said, what are you doing? Aren't you reading the newspaper? Well, we were anticipating, this reflation trade. What I believe the market is doing is it's looking through and it's looking at two things. Number one, the stimulus spending. And if we get even a half of what Joe Biden has proposed, that would be a great boost to the economy. And then they're also looking at the Fed. The Fed has basically said, look, we are behind the financial markets. We're going to keep rates low. You get those two supports under the economy, fiscal and monetary policy. I think there's an awful lot of good news that is baked into the market already. And there is still a lot of good news to come because you still have a lot of disbelievers, people looking at the headlines right now. And I don't want to minimize, what's going on with the coronavirus and it's a tragedy. But we really think once people start to get vaccinated and we start to get closer to that herd immunity, maybe that's mid-year this year, you'll see the consumer come back out. You'll see confidence rise, and the economy should. You should see it in the economy.
John, very quickly, that reflation trade formula of yours, it's got to take into account rising interest rates. Is there a threshold where it would change your formula? I had a guest on yesterday, talked about when we get to 2%. No one's saying that'll happen till 2022. 2% on the 10-year, by the way.
Yeah, 2% on the 10-year. That would shock an awful lot of people. We don't see that happening for a while. What I am nervous about is some news this spring on inflation. We're going to be going year over year to some very, very low numbers last year. So you could see the market get a little spooked when we see some higher inflation numbers, let's say in the spring, which could drive interest rates higher. So if there is a kink in the story right now, it is interest rates, but we don't think that rise would be sustainable.
All right, John Trainor, great to have you back on the show as Chief Investment Officer of People's United Advisors. Thanks so much for taking the time to join us.
Thank you.
Coming up next on Yahoo Finance Live, Congressman Steve Stivers, a Republican from Ohio. He'll join us to talk about the new Congress and plans to deal with some of those old problems. We're back with that in just 2 minutes. Welcome back. It's time for News on the Move. At least 5 people are dead after a fire broke out at the Serum Institute of India. It's the world's largest vaccine plant. The company, which has been contracted to manufacture doses of the AstraZeneca Oxford University vaccine, said the fire will not affect production. A Tesla 3 model exploded in a parking garage in China after the bottom of the car struck a manhole cover. According to local media reports, Tesla said the incident was likely caused by damage to the battery. And the Powerball, we've been talking about this for weeks. The Powerball finally has a winner. A single ticket sold in Maryland matched all 6 numbers of the Powerball drawing last night. The winner got $730 million. It's the 4th largest jackpot in Powerball history. But don't worry, if you didn't have last night's winning ticket, you still have a chance to win big tomorrow. The Mega Millions jackpot is still in play with a grand prize, $970 million, Adam.
Shauna, I hope we all win that. But let's turn our attention back to politics and the U.S. economy. Compromise, right? That's what politics sometimes is about. Our next guest will not compromise. He's a Bengals fan, so we'll forgive him for that. But he is one of the leaders in Congress who's already talked about working with the new administration. Please welcome into the stream Republican Representative Steve Stivers of Ohio. And the district you represent is just south of Columbus, Ohio. I was making reference to those of us who love the north coast of Ohio. Let me ask you, you actually attended the inauguration. You made a statement. You said, I am committed to uphold the peaceful transition of power. We're looking at an administration that is going to very quickly take steps with climate change and immigration, even the pandemic response. You know, a couple of those are things where they might be at odds with Republican leadership. What would you say to leadership and the administration to forge compromise?
Well, I think there will be things we disagree on. That's how America works. But hopefully there are things that we can come together on. You know, even the pandemic response, it's so important that we build herd immunity as soon as we can. While I am not for giving a $1,400 stimulus check for anything, I'd be willing to sign off on a stimulus check of $1,400 for people who take the vaccine. And I hope the administration will look at that option, because we actually buy something with our $1,400, and that's herd immunity.
Jessica, I think you might be muted.
Oh, can you not hear me?
Oh, we've got you.
Congressman, I'm going to jump in here. I think our DC reporter, Justin, is having some audio problems. But going off of what you just said, you said that you would support $1,400 if people were to take a vaccine. What are some of the other items in that $1.9 trillion package, or an item in that $1.9 trillion package, that you would support, where you think Republicans and Democrats can come together and reach some common ground?
Well, clearly the vaccine distribution, getting that out as quick as we can, is very, very important. I think that is super important. Many of us would be willing to take the aid to state and local governments that has already been spent or already been allocated and extend the timeline, as opposed to increasing the dollar amount. Just let them use it into the new year, because much of that money expired at the end of the year. So I think there's ways to do things that don't cost as much and still give some relief to some of the folks involved here. So I think there are elements of common ground that we can reach. But we just passed the $900 billion coronavirus package a few weeks ago.
Congressman, there's a lot of spending that's going to come out of Congress. And one of the things we hear from Republicans is, how do we pay for it? How do we pay for it? We are going to take on more debt. But is there a limit to how far Republicans are willing to go?
Well, I think it should be debt for the right things. You know, we're willing to take on debt. But, you know, one of the things that my dad taught me is, you know, you don't want to take on debt for operating costs. You want to take on debt for something where you're getting capital. You know, you take on debt for a car, a house, some type of physical asset. So, you know, I'd be willing to do some debt for an infrastructure deal that's a real infrastructure deal. But I'm hopeful that we aren't just going to keep doing operating expenses and borrowing more and more money for that. So, and that's how I feel about a lot of these coronavirus relief packages. They're ongoing expenses, and we just keep borrowing more and more. The quickest thing we need to do, if we really want to help the American people, is get this economy turned back on, get people back to work, get kids back in school, get ourselves some herd immunity, get the vaccine distributed as quick as we can, and get the uptake rate up. That's why I'd be willing to accept a $1,400 stimulus check if people were willing to take the vaccine.
Congressman, as we're trying to get this legislation done, as the Biden administration at least is trying to push some of their legislation through, of course, we also have the impeachment trial. How do you see this affecting future legislation, and do you see it holding certain things up in Congress?
Well, last time the legislation or the impeachment trial took 6 weeks in the Senate, and it doesn't take 6 weeks to go through the evidence. It takes 6 weeks because under the Senate rules, everybody wants to talk and everybody gets to talk. And so it will likely take at least 4 weeks. It's going to slow down. The big thing it's going to slow down in the Senate is the confirmation of President Biden's cabinet. But then obviously it'll take up floor time that could be used to pass a coronavirus package, an infrastructure package, housing packages, a lot of other issues that are important to this country. So, I wish we weren't spending time impeaching somebody that's already gone, but that horse is already out of the barn, I guess.
And let's turn our attention as we take a deep breath. Let's go past the first 100 days. Eventually, the Biden administration is going to come to the House with proposals on tax increases. One thing that's getting kicked around is a capital gains tax increase. You're on the committee that oversees, House Financial Services. That has impact on this kind of legislation, especially when it comes to securities. What would you say if you're approached about a tax increase? Is it true that Republicans have never met a tax increase they would ever pass?
Well, I don't know that we would never pass any tax increase, but I think a capital gains tax increase would be bad for economic growth. And it would result in people holding investments or property because they don't want to take tax gains as opposed to they don't want to sell it. So I think that is an issue that is not the best way to look at taxation, because I think it will negatively impact economic growth. There are other things I'm willing to look at and willing to have a conversation about, but I would not start with things like a capital gains tax increase.
Representative Steve Stivers of Ohio, just want to let you know that I am biased, whether they be Democrat or Republican. When it's someone from Ohio, I am always thrilled that they're joining us. I hope you will come back. All the best to you, sir.
Thanks. I hope to talk to you again soon. Take care.
We'll be right back.
Earning reports that keep on rolling in. One of the big names out this morning, Union Pacific. And Adam, you got a chance to speak with CEO Lance Fritz about the results that they reported this morning. What did he tell you?
Well, they had a very good earnings quarter, even though it was a tough year. And basically, he's got his sights set on an economic recovery across the country.
The women and men of Union Pacific did a tremendous job of overcoming a fair amount of headwind. And while you highlighted fuel costs being down, what really drove the quarter was a bit of growth, 3% up in units, and a lot of productivity, $170 million in productivity. So it was a great close to the year. That postures us when we pivot and look to 2021 for the guidance that we provided this morning. We said we expect growth to be something like 4 to 6% in units. We expect another $500 million in productivity. We expect pricing to be above inflation. And we expect all that to generate 150 to 200 basis points of margin improvement. All in, that's a really good look at 2021.
The reason you're one of our top CEO interviews during quarterly reports is because you are shipping so much of the stuff that is necessary to keep an economy on track. So let's talk about some of the freight picture here. Coal and renewables in full year 2020 for the quarter, at least, that was down. What was it, about 16%? Yet grain and grain products was up 20%. I imagine we're going to consider the grain and food shipments are going to increase going forward.
Yeah, so as we look at the two commodities you just mentioned, we talked this morning about specific headwinds in coal. And that is related to the conversation that happened before I got on in terms of climate change. There's a long-term decline in the use of coal in the United States as a power generating fuel, and that's continuing. And we said, as we look into 2021, we think the decrease in coal shipments might be as much as a 1 percentage point hit to our overall unit volumes. So offsetting that is going to be a pretty strong grain market. And grain right now is about export, and export's about the Chinese into the US market for soybeans. Part of that is they're supplying their own hog farms that have been rebuilt after a big swine flu epidemic that they faced earlier. And also it's about fulfilling some of the commitments they made in the phase one China deal. There's other strength in the economy. We think housing is going to be pretty good. We think the automotive industry continues to recover. What we really are keeping a strong eye on is what the consumer is going to do. Are they going to stay as strong as they are in e-commerce and build off that? And what's going to happen in the industrial economy?
Now, shares of Union Pacific today are under a little bit of pressure, off about 4%. But over the last 52 weeks, the stock price has almost doubled, and the yield on this stock is about 2%. So for a conservative investor, this might be something you still want to look at, although short interest in the last couple of weeks has been increasing. Shauna?
Certainly does. It makes sense for those dividend-seeking investors. All right, coming up next here on Yahoo Finance Live, we're going to talk to the CEO of Logitech, Bracken Darrell. He'll join us about the company's latest quarter and also what to expect about future growth. We're back with that in just 2 minutes.
14 minutes to the closing bell. Indices are all trading positive. One of the stocks that's trading higher today, Logitech International, is up almost about 4%. They had earnings on Monday, which set some records and really hit it out of the ballpark. To discuss all of this, let's invite into the stream Logitech CEO Bracken Darrell. Good to have you here. And
Thanks so much
where
for
was
having
the
me.
growth? Because when I think of Logitech, I think of why spend $100 on an Apple-produced mouse when I can get a mouse from you folk for a lot cheaper? Is the growth in the accessories, or is what's driving this?
Yeah, we're really driving our growth behind four big megatrends that have been going on for years. The first one is the one that a lot of people are talking about now, which is video everywhere. So I'm on a Logitech webcam right now, and we also enable conference rooms. So that business grew dramatically. We're also in the gaming business. So, gaming's been on a very long-term trend. Esports will become the biggest collection of sports in the world. Strong growth there. Work from anywhere. We do make mice, we make keyboards, we make headsets. So setting up new workspaces and then upgrading those workspaces is a big growth trend. And then the last one is this democratization of content where, people, our kids and everybody we know seems to be creating a podcast or streaming something. And we enable that with microphones, with a service called Streamlabs, with our webcam. So we're in a lot of the spaces that are really critical to what's going on right now. And those trends are going to continue.
Bracken, there's been a lot of demand for your product. We talked about it in the previous couple of quarters. You've had trouble keeping up with that demand. And have you addressed the supply issues? Are you still seeing some supply constraints with some of your products?
We've addressed some. We're still constrained in a few categories, webcams, microphones, but we're trying to unlock more and more demand where it's really needed in the marketplace. And, webcams in particular, they're used by educators and doctors and of course people like you and me. So we're really working very hard to unlock that supply, and we're getting there.
Bracken, Dan Roberts here. You mentioned those four trends that are helping your business, and you talked about those trends 1 quarter ago when you came on our show. And at the time you said, look, it isn't just the pandemic. It's not just a pandemic boost. And of course, as we hope to see the light at the end of the tunnel here with the pandemic, we're now talking a lot about which trends that accelerated during this time are going to end and come to an abrupt halt, and which ones are here to stay and are going to continue. What do you see happening in terms of kind of the future of the office? A lot of people are betting that remote flexible work is now here to stay even beyond the pandemic. And how might that affect your business since your sales have really seen a boost thanks to people working from home?
Yeah, I can't, I think I could speak for a lot of CEOs and a lot of companies out there. While people are tired of being at home alone, kind of working in their home kitchen or home office, they like working at home. And I think when people start to open up offices again, and they will, we're going to be in a world of hybrid work where a lot more people are going to be working part of the time in the office, 2 or 3 days, 2 or 3 days at home. So the result of that for us is going to be that we're going to continue to see a very strong, a robust workspace market, whether it's keyboards or mice or webcams and headsets. And we're also going to see people enabling conference rooms with lots of conference rooms, because they're going to need video in those conference rooms to do the video calling with all the people who are outside of those. So I'm quite optimistic about where this is going to go long term for us.
When you talk long term, though, do you put a timeline as to when that growth might peak? Because there will come a point where it reaches saturation, won't it?
I don't really. I mean, these are super long term trends. If you think about the four that I just named, take gaming, for example. It's hard for me to imagine that gaming doesn't become the biggest collection of sports in the world. Biggest in spectatorship, biggest in participation. The same thing for streaming your own content. I think those are going to be huge. And when you think about work, even as people go back to work, we've got lots of opportunities to upgrade, whether it's ergonomics or aesthetics because it's part of your home decor, or just functionality. We've been innovating a really long term for a very long time. We see opportunities across the board.
Bracken, real quick, we only have about a minute left here, but I just want to ask you about prices. When you're seeing the type of demand that you have seen over the last several quarters, looking ahead, are you looking at adjusting your pricing at all, potentially raising your pricing or changing your promotional strategy as a result?
Well, we certainly did. We really pulled back on promotions dramatically in the beginning of this, because promotions were normally used during this, especially during seasonal periods, to really go after market opportunities that wouldn't be there if we didn't. But we really haven't promoted, so we've really pulled our promotion way back this year, and I think it'll stay back for another quarter or so. and then we'll put some promotion back in.
All right, Bracken Darrell, great to have you on the show, CEO of Logitech. We hope to talk to you next quarter. Thanks for taking the time.
Thank you so much. Thanks, Shauna.
Coming up, we just have about 9 minutes to the closing bell. Dow, S&P, and NASDAQ holding on to gains. We're back with more in 2 minutes.
We've got breaking news regarding Intel. Their quarterly earnings are out a little bit early, and Jared Blickery is watching as the shares are popping. Jared?
Yes, they are. Stock's up about 6%, had already been up nicely on the day. Might have been a fat finger error by somebody holding their button by the release. But let's take a look at the numbers here. So their fourth quarter adjusted EPS came in at $1.52. Estimate was for quite a bit lower at $1.11. They're seeing revenue of $275.3 billion, and that is higher than estimates of $70.4 billion. They're seeing 2021 adjusted EPS at $4.90. Estimate was for lower, $4.53. And also they're raising their dividend by 5%. And everybody on the earnings call is going to be interested in their new strategy here. It was only 2 days ago that ASML, they do fabrication work for not only Intel, but a bunch of other large producers. They said that they were shifting some of their production from one big company, probably Intel, to others. That would be somebody like Taiwan Semi. So it looks like part of their new strategy, they're not going to be doing as much fabrication. They're going to be outsourcing that and mainly concentrating on design. They may still make some of the lesser chips, but the high-end ones probably going towards somebody else now. Also looking at some other headers on Intel that are just coming out right now. This is their revenue number. So that came out at 20 billion. The estimate was for 2.5 billion, lower at 17.5 billion. So kind of a strange earnings release here, as it was quite a bit early by about 10, 15 minutes. But you can see the stock there getting a nice pop just before the bell. Guys?
All right, Jared Blickery, thank you very much. And we're heading toward the closing bell right after this.
Got just over 2 minutes here till the closing bell. Dow, S&P, and NASDAQ holding on to gains. We want to bring in John Adams. He's a senior investment strategist with BMO Global Asset Management. We're also joined by Patrick Palfrey, a senior equity strategist at Credit Suisse. And Patrick, let me go to you first. We're seeing some buying action today. Record highs yesterday, once again today. What do you make of this? What's driving the action?
Well, I think when I take a step back, the hope that we're going to have an overwhelming stimulus package coming out of Washington, combined with already record levels of consumer saving, which is likely going to be released as consumers venture out and we get COVID vaccines deployed. It's not next week, but it's on the horizon, and that's really what's driving stocks here.
John, when you take a look at where we're headed for 2021, you expect the accommodative policy to continue, but very quickly, emerging markets or the United States, where would you go?
We're actually overweight both areas, but we have a slight bias toward emerging market equities. We think that the policy stimulus, the reflation trade will be beneficial to higher beta areas like emerging markets. Also, we expect the dollar to weaken modestly, which should, at the margin, be supportive of those emerging markets. I would say one risk there is with the vaccine rollout being a bit slower in emerging markets, that could be a concern, but we think that the reflationary issue will really overwhelm any kind of concerns around the vaccine.
All right, John and Patrick, stand by. We want to bring in our markets reporter, Jared Blicker, here for a closer look at some of these movers here into the bell. Jared.
Yeah, it's been an interesting couple days here because it's been a real reversal of what we saw actually in the last 2 months or so since November. And let's take a look at the NASDAQ 100. This is where the mega caps have been getting a lot of attention. And in fact, we're going to go to a 2-day look. That Apple up 3.73%, that becomes Apple 7.1%. Amazon up over 6%, Facebook 4%, and Alphabet over 5%. Here's the closing bell on Wall Street.
All right, before it, we've got a closing bell, and you can see we're going to settle roughly. It's going to be a mixed picture. The Dow's going to be negative, down about 12 points. S&P 500 will be up about 1 point. NASDAQ's going to settle up about 73 points. And again, when we talk about the sectors which have been performing strongly, earlier we were mentioning that industrials were off today, but had been up about 6% when you look at 52 weeks. The real gainer today, as far as sectors, was information technology. Let's go back to our guest to talk about this and how you might want to be looking at where we're headed in 2021 and 2022. Let's go back to John. And when you talk about this reinflation cycle and people get worried about the Fed, we're going to have the first Fed meeting coming up very soon. What do you think? I mean, we're not going to have any real interest rate moves till at least 2022, right?
I think that's correct. We're not really worried about the Fed tapering this year or thinking about raising rates this year. You did hear some chatter from some Fed speakers about that a couple of weeks ago. I think the core of the Fed walked that back, in particular Powell and Clarida. And so if you listen to those two individuals, they're telling you that they don't foresee tapering at any point this year. We think that it's a very high bar to the Fed withdrawing stimulus at this point. And if you listen to what they're saying that we think that the downside to withdrawing stimulus more quickly is much greater than the downside to keeping on stimulus perhaps a bit too long. So we'll see what this average inflation targeting, what that means, but it does appear the Fed's looking for inflation to run for at least 12 months above that 2% target before they'll consider raising rates.
Patrick, we have seen a bit of a bump here in the 10-year yield, still over 1%. What does that mean for equities? And I guess at what level do you start to get concerned for the pressure that could ultimately put on the markets?
Well, when people commonly think about interest rates, the idea that higher interest rates is an inhibitor for stocks is actually not true. And in reality, higher interest rates signal greater economic vibrancy, particularly when we're at the levels we're at now. So there's a long runway for interest rates to continue to move higher and for equities to respond positively to higher interest rates. You know, that level historically going back decades is around 5% on the 10-year. It's likely going to be a lot lower now because of the structurally lower interest rate environment that we're in. But I would imagine we would be able to see higher rates for at least the next half a point or so before we see an issue with stocks. And as interest rates rise, the pro-cyclical bet, the financials, the industrials, the materials, those groups that have been working so far year to date are areas where you're going to want to be focused because they're responding to that economic vibrancy.
You know, Patrick, one of the things you do for your clients, I'm looking at right now, your growth dashboard in a note that you recently sent them. And I'm wondering, what is what's the impact of what happens with interest rates in, say, the next 6 months? Because we're going to have fluctuations in the 10-year yield on things like you lay it out here very simply as far as fourth quarter revenue, margins, and earnings. And you break it down, not only to sector, but the kinds of things all of us relate to, automobiles or durables and apparel. So what do you think is going to happen?
Well, I think interest rates have an opportunity to move higher, and it's likely going to be at least for another, at least half a point on the 10-year in terms of where we can go, just looking at the reflation trade that's taking place. So we're going to see strong stock market performance on the back of higher interest rates. And if you're asking in terms of what groups are benefiting, not just in terms of performance, but in terms of their business, banks are really the area where you're going to want to be in. The fact that the yield curve is going to be incrementally steepening because the short end is being held down by the Fed, and then you have higher rates, both of those are very, very favorable for their net interest income. And that's really what drives bank profitability. So the opportunity in our mind is really in financials, and that's really our favorite sector right now.
Hey, John, in your notes, I noticed that you were talking about the likelihood of additional stimulus, and you were saying that we're likely going to get a, quote, watered down version of Biden's economic agenda. I'm curious what you think the market is forecasting or what the market is anticipating that we'll get over the next few months.
Sure, yeah, I would say policy is really driving everything right now. We talked about monetary policy earlier, but from a fiscal policy perspective, I think the expectation is that we'll get something like $1 trillion potentially of additional fiscal stimulus. That's very significant when you add that to the $900 billion that we saw in December. And there will likely be some horse trading as far as what the composition of that package really is when it's passed. The Biden administration's talked about $1.9 trillion as a starting point. We don't think Republicans in the Senate will support anything larger than, say, $1 trillion. But that's still a very significant package. And if you add to that maybe a second part of the Biden economic package a little bit later in the year, focused on infrastructure and green energy, that's really a lot of stimulus that's feeding through. And again, that drives reflation. We think that's very good for equities overall.
Patrick, I'm pulling out one stock here, and I'm not going to ask you to comment on Home Depot, but it was the leader in the Dow today, up about 1.7%. I would imagine that a lot of the stay-at-home related type of businesses are those that are at least going to gain for another 6 months. Would that be an accurate call?
I think there's still an opportunity for many of these companies to be winners in this environment, at least for the next few months. At some point, the comps, the fact that they are cycling these hard year-over-year comparisons get more difficult, and that's where we'd actually recommend investors begin to look more at some of the value sectors, like a financials or like an industrial, something that was perhaps beaten up and is watching their profits recover through last year's easy comparisons, and it really drives some of the success that we're likely to see in those names. And I think it's important, consumers are sitting on record savings, and the fact that they may get more stimulus and stimulus that is going directly to them, the opportunity for companies to really benefit from this reopening trade as the economy improves is tremendous. And I think that can't be underestimated. And that's really what's going to be driving stocks over the next couple of months. So anything that is tied to the reopening trade is going to just take off.
All right, Patrick Palfrey, Credit Suisse Senior Equity Strategist, and our thanks to John Adams, Senior Investment Strategist with BMO Global Asset Management. Thanks to you both for joining today.
Thank you.
Coming up next here on Yahoo Finance Live, we'll take a look at the housing sector. Housing starts surging to end 2020. Is this momentum going to continue throughout this year? We're back with that in just 2 minutes.
Everybody's got to live somewhere, and that's why housing is so important. Let's look at this that we've got, because we're eve of some more tomorrow. We want to invite into the stream Tendai Kapfidze. He is Lending Tree's chief economist, and he knows more about the need for space than a lot of people with triplets. 2 of her already standing and about to start walking. So, we invited you in to talk about housing starts. I can't think of anybody poised to need more space than you. So what the housing starts makes you smile or worries you?
Makes me smile. I think there's definitely a lot of demand for housing right now, both for reasons like my own, where I need more space because my family is growing, but also with the pandemic, we've had a lot of kind of shuffling in people's requirements around the space that they live in. And we also had, because of the pandemic, some slowdown in activity last year. So there's a bit of catch up in today's numbers. But yeah, it was a big jump, the strongest since 2006.
We also got that home builder confidence number out yesterday, and the demand obviously is still strong there, but there are some issues, and you pointed this out in your notes, talking about material affordability and also a lack of labor. How do you see this affecting home construction this year?
Yeah, so likely what it will do is I think it's going to add to costs, which is going to add to prices. I think in terms of volume, we're probably going to be getting a record year this year, since 2006, essentially. We'll probably jump, I think, between 15 and maybe 20% over 2020's numbers. So it's going to be a strong year. Builders are optimistic. Demand is strong. Mortgage rates, I think, are going to remain low, even though they might drift upwards a little bit. I think they'll still remain under 3%, which is going to drive a lot of demand in the housing market. And then the final factor is that there's very little inventory in the existing home sales market, which makes new home construction even more important.
And I'm glad you just mentioned that, because we'll get into home sales tomorrow. But, right now, is this an income inequality story? Because who can afford to build a new home? Is it going to be the top 10%? Who is it?
Yeah, so I think, one of the things everybody's been talking about is the K-shaped recovery. And it's really clear to see this in the housing market. At the same time that we're having, these really high housing starts, we're getting a lot of home buying activity. The Biden administration just had to extend the moratoriums on foreclosures as well as on rental evictions. So you really see this bifurcation in the marketplace where a certain part of the population is doing really well. They're able to work from home. They didn't get disruption to their jobs or their income, and they're benefiting from really low interest rates. And additionally, because of the coronavirus last year and the slowdown in the economy, they've been able to save a lot of money. So compared to kind of a baseline year, last year we saw about $1.6 trillion in excess savings for households. A lot of that is at the top of the income curve, and I think some of that is going to flow into the housing market. So you do see this split in the marketplace between wealthy people who are able to afford housing, or the upper edge of the K, and then the other leg of the K where people are concerned about eviction, foreclosure, people have lost their jobs and they're under a lot of pressure.
One of the things that's driving the housing numbers that we've seen, obviously, is the low mortgage rates. How do you see the new administration, how do you see the Biden administration affecting their direction at all?
I think in terms of mortgage rates, the Biden administration, doesn't necessarily have policies that directly affect the mortgage rate. Where it would pass through would be from the 10-year Treasury. So if we get, this big stimulus package, some people are concerned about inflationary effects, which might raise the 10-year Treasury. I am not as concerned about inflationary effects. One thing that we've been seeing with all the monetary and fiscal policy that's been going on is that, things like the money multiplier have been decreasing. So I think we can get a lot of stimulus without generating inflation, and that should keep interest rates, I think, below 3% for the year.
And of course, when we're talking about local, some markets are going to be stronger than others. We see rents, for instance, drop in major metropolitan area. People have left out. Do you see the cost of purchasing dropping as dramatically, or is it going to be a little bit lower?
I don't think the cost of purchasing is going to drop just because we have these inventory challenges. In the existing homes market, people are actually locking themselves into their houses by refinancing at these record low rates. So that reduces the churn or the number of people who are looking to move houses. So I think because of supply constraints, we're not going to have price drops in the purchase market. But yeah, in the rental market, I just signed a new 2-year lease where I got 7 months free. It was a ridiculous deal, and I just had to take it. But I think that's part of the bifurcation to difference in the rental market versus in the home purchase market.
Tendai Kapfize, it's always good to see you. All the best to your triplets and your other half, your wife, because you have your hands full. Tendai is also the chief economist at Lending Train. We appreciate your being here. We're going to be right back.
Samsung unveiling its new Galaxy S21 phones are set to launch at the end of the month. Our tech editor, Dan Halley, got his hands on these early. And Dan, you've been giving them a look. What do you think? Because there's a lot to hype surrounding these new phones. Hey, Dan, I think you're muted.
Hey, sorry about that. This is the S21 and the S21 Ultra. The S21 Plus is the third offering in the line. As you can imagine, it's a little bit bigger than this guy, but I want to give you a breakdown of how this compares to Apple's iPhone. So we have the S21 starting at $799, the S21 Plus starting at $999, and the Ultra starting at $1,200. That's a lot of money. Yikes. The iPhones, meanwhile, start at $699 for the Mini 12. The 12 regular starts at $799. The 12 Pro is at $999, and then the 12 Pro Max is at $1099. So we're seeing kind of a kind of middling of these types of prices for these devices. And just to give you an idea of what the difference between all of these Samsung phones is, as the size, really what it comes down to, the displays that they have and the size of those displays. So we have the S21 here, that's got a 6.2-inch display. The S21 Plus has a 6.7-inch display, and then the S21 Ultra has a massive 6.8-inch display. Those kind of roughly line up with Apple's offerings. Those go between 5.4 inches and 6.7 inches. But I think really the big thing to do with these phones is their cameras. And that's really what we talk about now when it comes to smartphones. Every phone out there has gorgeous displays. They all have face recognition technology. I just use them to unlock both Samsung phones. I think really it's the cameras, and I'll give you a look at them. This is the Ultra here. You could see that I don't even know what's going on back there with all those cameras. And then this is the standard S21. Now, what we have is a wide angle, an ultra wide, and telephoto lens on the S21 and the S21 Plus. The Ultra has those as well. The difference between the telephoto is what really matters here. And so the telephoto on the S21 and S21 Plus is 3 times optical zoom. That's really great, especially when you're trying to zoom in on friends and family. Maybe you don't want to have to take that big step forward and get really awkwardly close to people, especially now. The S21 Ultra has a whopping 10 times optical zoom. Now, that's essentially going to replace any kind of DSLR that you might not want to lug around. Of course, if you need to take really high quality photos, stick with that DSLR. But I think what Samsung really is trying to do here is ensure that they can market their phones not just based on the size of the displays, the quality of the software, but the cameras as well. And we're going to continue to see more companies do this. Between you and me and the rest of the people watching, I like the $799 S21, despite the fact that it doesn't have that 10x optical zoom, just because it's smaller. The display is cooler. I don't like this rounded edge that we have on the Ultra that Samsung has been sticking to. And it's $799, so it's not too expensive, but it is a little pricey.
When you talk about these phones, how much of a competitor are they, though, to the Apple iPhones? I mean, in the United States, it's all Apple, but outside of the US, people love those, don't they?
Yeah, I mean, look, Samsung, yes, the iPhone is the majority smartphone in the US, but Samsung is number 2. And globally, it's back and forth between Samsung and Huawei. So these are going to be the flagships for one of the biggest smartphone makers in the world, and they will sell well. I think that their design is fantastic. Battery life looks really good so far. Screens are incredible, and those cameras are outrageous. I got to mention, by the way, the 10 times optical zoom can also be used to do 100 times zoom with some software and AI flourishes. No idea why you would want to do that unless you're trying to take a picture of a moving plane or just spy on your neighbors. But it's there if you want it.
All right, Dan Halley, thanks so much for breaking that down. We want to get to some breaking news. Sticking with the tech sector here, IBM is out with its earnings results. Jared Lickery has those numbers for us. Jared?
That's right. The stock is down about 4.5% right now, and that is off of a miss from the top line number coming in a little bit short. So revenue was $20.4 billion for the fourth quarter. Estimate was for slightly higher, $20.7 billion, but nevertheless a miss. And it looks like expectations not being met in the cloud and cognitive software division. Now, that came in at $6.84 billion, but the estimate was for materially higher at $7.26 billion. Looking through the other segments here, it looks like just about everything was in line. Global business services revenue, $4.17 billion. In line. Global technology services revenue, $6.57, just a little bit, I'd call that in line too. Systems revenue, $2.5 billion. Estimate was for slightly lower. And then here we have operating EPS of $2.07 for the quarter. The estimate was for quite a bit lower, $1.79, so a nice beat there. And then adjusted gross margin also coming in over about, it looks like 130 basis points higher than expected at 52.5%. Total cloud revenue up $7.5 billion. That's up 10%. And Red Hat revenue is up 19%. So on the call, people are going to be interested in what the CEO, Arvind Krishna, has to say about the company's turnaround and what that miss might mean from that cloud division. So we're seeing that stock still down about 4.5% in after hours trading here.
Jared, I want to go back to Intel Corporation, and after hours, those shares are now negative. They're trading off about 2%. Investors don't believe the forecast. I mean, what's going on here? Why down after that big pop?
Well, there could be some disappointment around that. I think overall it's a decent report, and we just got some word. We got some news that the incoming CEO, Pat Gelsinger, is going to be on the call. And so what I was talking about before, when the earnings were released accidentally before the bell a little bit early, was this is part of a new turnaround strategy. Intel is probably not going to be fabricating their own chips, at least on the high end anymore. And that news came from ASML, kind of reading between the lines, but they said they're shifting their production to some of the other major players like Taiwan Semi. So the turnaround strategy is going to be the focus here. Also some headlines from the earnings release. They're going to give their full year forecast on the first quarter call. So we're going to have to wait 3 months for that. Also boosting their dividend by 5% to 34.75 cents. So overall, not the worst report. Their outlook did come in better than expectations. For instance, first quarter revenue, they saw 18.6 billion. Estimate was for lower at 16.18 billion. And that number was misreported early on, right after that release before the bell. So that may have been a source of confusion there. But overall, I think the focus is going to be on the call here, guys.
Hey, Jared, so investors, they'll be watching IBM, they'll be watching Intel tomorrow. Something else that investors have been keeping a close eye on is what's going on in crypto. And recently, over the last 2 days, we've seen some selling in Bitcoin. Bitcoin off just around 10%, right around 32,000. I'm curious just what you attribute some of this selling pressure to and what that could possibly mean for the future of Bitcoin here.
Well, I'll tell you what, sometimes selling begets more selling. And we had this incredible run up in Bitcoin. And I'm going to go to this chart that I've been trotting out for the last few days. We had this consolidation over the last couple weeks. We broke down slightly yesterday and we just continued breaking down today, hit 31,000 around that price. So we do have some potential support. We can see just some price action around that big figure number, 30,000, 31,000. But we still could drop lower to 25,000, even as low as 19 or 20,000. So we'll have to see how this plays out. For now, the short-term trend is down over 25% from the recent highs, guys.
All right, Jared Lickery, something we, of course, will watch tomorrow. But speaking of other things that are on our radar, Adam, what I'm going to be watching, it has to do with housing. We were just talking to Tendai from LendingTree about the outperformance of housing here over the last several months. Tomorrow, we're going to get existing home sales numbers. Of course, that will be closely followed by the street. The forecast is for 6.5 million. That's down from the previous month of 6.69 million. But remember that housing start number that we got this morning, the fastest pace since 2006. We got the strong home builder confidence number out yesterday. It's hard to imagine that we'll get a disappointing result, but we'll see. What's on your radar?
The first phone call between President Biden and a foreign leader, and we learned last night that first phone call is going to go with Canada's Prime Minister, Mr. Trudeau. They're also our largest trading partner, depending how you look at this. But after that, the other question was at the press conference yesterday when we heard from the new press secretary, Jen Psaki, would the president be speaking to Mr. Putin? And there's nothing on the agenda yet regarding that. So Canada gets the first phone call. Shauna?
All right, well, we'll see how that all plays out. But again, just recapping how we settled today. Again, day 2 of the Biden presidency, and we're seeing a mixed picture here. The Dow closing off just 12 points, so right around the flat line. S&P and NASDAQ, though, holding on to gains. It's a record close for both of those indexes, with the NASDAQ up just around 0.5% and the S&P up just around 1 point. We'll stick right here on Yahoo Finance Live, because coming up next, our new episode of Influencers, Yahoo Finance editor-in-chief Andy Serwer sits down with Ray McGuire, a former Wall Street executive who is now running for mayor of New York City. That all starts in just 2 minutes.
Ray McGuire overcame incredible odds to make it atop Wall Street. Now he's running for mayor of New York City so more people can achieve the prosperity that he did. McGuire jumped into the race after 15 years at Citigroup, where he served most recently as the global head of corporate and investment banking, after climbing through the ranks of an overwhelmingly white profession. He was raised by a single mother in a modest home in Dayton, Ohio, and went on to Harvard, where he also earned law and business degrees. On this week of Influencers, Ray joins me to talk about corporate America's response to the attack on the Capitol, what's wrong with COVID vaccine distribution, and his plan to help the country's biggest city bounce back.
Hello, everyone. I'm Andy Serwer. Welcome to Influencers and welcome to our guest, Ray McGuire, candidate for New York City mayor who spent 15 years in various roles at Citigroup, most recently as chairman of banking, capital markets, and advisory. Ray, nice to see you.
Nice to see you, Andy. How you doing? Thank you for having me.
Doing all right. Thank you for joining us. So, Ray, let me ask you straight off, why do you want to be mayor of New York City?
You know, Andy, that's what my 94-year-old mother asked me when I told her I quit my job to pursue this journey. Listen, I love this city. I love the city. It's where I met my lovely wife, Crystal, and where we're raising our 3 children, Leo, who is 8, Ella, who's 18, and Cole, who's 20, who will this evening start as a starting point guard for the Orlando Magic. But, you know, right now, this city is suffering. We're managing 3 existential crises: crisis of the pandemic, crisis of the economy as a result of that, and crisis of racial and religious segregation. So what I've done is kind of how I got here. Who I am will inform why I want to be mayor and why it's so important. Who I am, and is I came from the other side of the tracks. The other side of the tracks. I was raised by my single mother. I didn't know my father. My single mother and my grandparents raised me and my 2 brothers in a home that at any point in time had half a dozen foster children with us. And I grew up across the street from the Howard paper mill. And sometime it emitted fumes that were so strong that the only way that we could breathe was to open the refrigerator door. And I knew when my mother, who was a social worker, had to make the debate between putting food on the table or paying Dayton Power and Light the gas and electric bill or putting tithes in the church. And I know what it's like when you hear that conversation taking place. And I know what it's like when you have no money and you have to wash the tin foil. And what it's like when you get to the end of a bar of soap, you put as many of them together as you can and boil them to convince yourself that you have a bar of soap. I know what that's like. So I know what it's like not to have. And I know what my mother sacrificed for me and my 2 brothers to get here. My mother sacrificed so I can have an education. And it was education and her sacrifices that allowed me to get here. And so when I came to New York, I had 3 things. I had a great education, I had a lot of debt, and I had no money. And New York has been great to me. It gave me the opportunity, with all the sacrifices and with the education, to come here and to compete in one of those most competitive fields that exist anywhere. And to do that for 36 years at the highest level. So, Annie, I take my lived experiences, how I got here, my foundation, and my knowing what it's like not to have, and what I've been able to do in business on Wall Street, in business, managing and leading for 36 years, and the relationships. And I bring all that together, and it's a city that I love, and it's at a point in time where you can make a difference. And so I can make a difference in the lives of so many, especially those kids, Black and brown, who look like me. And that's what this is about. And that's why I'm running.
You propose, Ray, an economic recovery plan called Go Big, Go Small that calls for major investments in infrastructure, skills for training workers, support for small business. And you say it'll be the biggest job plan in generations. Why focus on those areas in particular?
Because right now we are in the midst of a crisis. And what I've written about is today, George Floyd and COVID have been the big reveal to 400 years of systemic inequities in education and in the economy, in healthcare, and in the criminal justice system. And what my go big, go small vision is to make certain that we do, and I lead the biggest economic recovery, inclusive economic recovery in the history of this city. It is fundamental. It is fundamental for this city to achieve the greatness that it so deserves, that we fix the economy. You got to go big, you got to go small, you got to fix your small businesses, and you got to put people to work. So my strategy is to employ hundreds of thousands of New Yorkers, all of whom live in New York within the 5 boroughs. I don't want to import the talent, so that we can grow our way out of this crisis. And we can do that. We did in the 70s. At the height of the Great Depression, we built the Empire State Building. We built the Chrysler Building. We got out of the 70s when business, labor, and government came together. And we can do this today. We got to make it inclusive, because up to this point, it hasn't been.
Let me ask you about COVID, Ray, because there's news that New York City is running out of vaccines. So how would you assess the way that Bill de Blasio and Governor Cuomo have handled the pandemic and the distribution of the vaccine, and what would you do differently?
So what I would do differently is you have to plan for this. And given what I've been able to do for 4 decades, is plan. You have to plan for worst case scenarios, and you have to not only plan, you have to go through scenarios, and you got to get the right team in place. We knew the vaccine was coming. We knew the vaccine was coming. We should have spent endless days planning for how we're going to distribute it, for one, endless days planning on informing New Yorkers of the impact and necessity to take the vaccine, while also emphasizing what we have been somewhat effective at, social distancing and mask. I would have overplanned for this and communicated with the New Yorkers in a way that didn't actually happen, which is why we're managing today through the poor management of the distribution of this and the poor management of how we inform New Yorkers.
We'll be right back with more from former Citibank executive and New York City mayoral candidate Ray McGuire. Welcome back to Influencers. I'm Andy Serwer, and I'm here with Ray McGuire, former Citibank executive, now running for mayor of New York City. And I want to ask you more about New York, Ray, but if you are to become mayor of this city, you will be asked to weigh in on pretty much every subject under the sun, because as mayor of New York, everything is part of your purview. So I want to go around and ask you some of those questions. And let's start with what has been transpiring in Washington, D.C. Recently, maybe for quite some time, but especially recently. And I'm talking about the storming of the Capitol by Trump supporters. What was your take on that?
Total unmitigated travesty. Total unmitigated travesty, which reflects the deep divide to which I've referenced here. Deep divide. There are people who don't feel that what has occurred over the past few years, for many of us over the past few centuries, reflects the ambitions that we as a country set out to give all of our citizens. And so that divide that is increasing, that divide played out in so many stark contrasts in what we saw last week. Compare the photographs to when you saw a peaceful protest against 8 minutes and 46 seconds of a cold-blooded murder. You saw these protests against George Floyd and that abuse, and the country came together. A collage of the great of this country from all kinds of creeds and colors and religions say, we don't stand for this. Look at that movement and look at how the Capitol Hill steps were guarded, armed militia. And then look at what was an insurgents movement, and there were no guards guarding the steps. None. They broke into our Capitol and threatened our leadership. That's a travesty against justice. That's a travesty against democracy. Travesty. We should have zero tolerance for that. Zero. And New York City will stand up as the united city. One New York. One New York. And that's what I stand for. You cannot tolerate what went down in Washington. We will not tolerate that under my administration in New York City, because it's going to reflect the entirety from the bricks to the boardroom. Everybody's going to be included in this growth, which is the only way this city is going to survive and be the greatest city on the planet going forward. The only way.
Do you think Donald Trump should be convicted by the Senate and prevented from ever serving in office again?
I don't think Donald Trump should ever serve in office again. And yes, he should be. If he incited that, by all means, yes. Anybody who creates those crimes against the U.S. government, against democracy, yes. He should not ever serve in public office again, ever. And anyone who supports him, we should make certain that we do the correct and appropriate condemnation of that.
Let me ask you about businesses, including your former employer, Citigroup, which said they would suspend political donations in the wake of the Capitol siege. Do you think that's been the right response?
That begins the conversation. Yes, we begin that conversation there. We should have zero tolerance. I want to be bright, clear, and unequivocal. Zero tolerance. Zero.
Right. Let me ask you about the stimulus package that President-elect Biden has proposed, $1.9 billion, expanding unemployment benefits, $1,400 checks, $15 minimum wage, among other measures. Is this too much, too little, or the appropriate response? What's your take?
It begins, we're suffering. We got the existential crisis with this pandemic. COVID has ripped through our communities and wrought havoc on many communities, especially disproportionately on Black and brown communities. We saw today the announcement of the budget deficit, which is going to be material in this city. We need to repair that. We need leadership that can address that directly. So yes, welcome the assistance. We will need more. We will need more in order for this country to make certain that it addresses the least of these. Americans, New Yorkers are suffering. COVID, the economy, injustices across the system. We need to address that, and we need leadership that's going to bring this city and this country together. That's what we need today, because absent that, as Lincoln said, a nation divided cannot stand. And as my dear mother says, and we talk about the scripture, when the foundation is falling and when the foundation is crumbling, what will the righteous do? Who's going to stand up for all of us? Who can lead us forward? Who can do that? Who's got the relationships and the lived experiences and the leadership and the management skills to pull all this together? That trifecta, which is going to be necessary to bridge all the divides which have gotten worse, they've gotten broader.
We're going to take a quick commercial break. We'll be right back with more from Ray McGuire, former Wall Street executive, now running for mayor of New York City. Welcome back to Influencers. I'm here with former Citibank executive and New York City candidate for mayor, Ray McGuire. Biden has promised another round of spending in February that will be funded in part by a tax hike on the wealthy and corporations. Is that a good idea? And will you have to raise taxes in New York City to get the city back on its feet?
So the answer is you have to look at the budget in total. I want to focus on the New York City budget. We have to grow our way out of this. As we've seen today, you have at least a $5 billion budget deficit. We saw the decrease in the largest part of the budget, which is property taxes. We saw a decrease in that in its contribution. We have to look at the budget entirety. And as you know, I've been in a leadership role in business, leadership role for 13 years, which means I had to manage a budget every quarter. I know how to manage budgets. And I've managed budgets from the depths of the crisis. We have to grow our way out of this. Everything needs to be on the table, including taxes. We can't tax your way out of this. And those who have the resources, like me and others, will have to contribute more. But we need to make certain that those tax dollars are well used. So yes, we're going to have to do what you have to. Everything's going to be on the table. Everything will be on the table. But we have to grow our way out of this.
And what about, and this sort of is adjacent to that last question, what about wealth inequality? Because the wealthiest people in this country and in New York have just gotten wealthier during the pandemic. It's kind of astonishing, but they're part of financial services like you are, or tech, and they did just fine over the past 12 months. So how do we bring them together? You talked about taxes as a part of it. Are there other mechanisms?
So taxes are part of the budget. I want to be clear. It's part of the overall budget. You got to go line item by line item. But this divide that you've described, I've written about this in one of the definitive pieces on the impact of racial inequities in this country. And what I've said is that George Floyd and COVID have been the big reveal. And what the study shows is that the impact on 40 years of systemic inequity economically to the US economy has been $16 trillion. Look at the analysis. I wrote the forward, and we go through and analyze the components of that. And then we say, if we begin to address it now, that's $5 trillion that gets added to the US economy. So what we're seeing now has been systemic. We need to address the systemic inequities, which is why when I describe the greatest comeback, it's the greatest inclusive comeback, because far too many, as you've referenced, have not been included. And we've created, that wealth gap has only gotten larger, gets reflected in home ownership, gets reflected in just the net worth. 1954, we saw the extraordinary decision of Brown versus Board of Education. 1954, we saw the creation of the beacon of suburbia, which is Levittown, that had as part of it systemic redlining, so Black folk and brown folk couldn't be part of that. Home ownership, 66 years of inequities. We need to address that today, which is go big, go small, beginning to address those inequities. It's going to take us a while to address what's happened during the course of the history of this country, but we can begin with the right leadership. Having identified the problem, we now know what the prescription is, which is included in my vision of how we're going to do this.
We talked a little bit about small businesses, but what about people who work at big companies, Ray, in New York City, in Manhattan in particular, but also in Brooklyn? How and when can we go back into those big buildings?
Well, we can go back when it's safe to go back. So I'm listening to the scientists. I'm encouraging us for a disseminate or distribute this first. We need to inform the public that it's okay, that it's safe, because the history that many Black and brown people have had with vaccinations don't immediately say, oh, I'm going to run and take the vaccine. So we need to inform the public that it's okay. I will take the vaccine. As soon as it becomes available to me, I will take the vaccine. So we need to make the city safe, which means the vaccine, for one, a fair distribution that gets monitored to make certain that all New Yorkers have the opportunity to take the vaccine. Other countries have done it. Other cities are doing it. We need to do it. We need to improve on that. Once we make the city safe, health-wise, we need to make it safe and secure and get the quality of life to which we all have been experiencing, which we become used to. Not everybody's used to that, but we need to address that. And so when that happens, and you can, in many of these instances, create bubbles inside of offices, inside of entertainment, and just be reflected that the CARES Act did include stage live performances in the arts, which are so essential. But once we can do that, we then begin to return to the livelihood that created the premium experience in New York. And so we have to make it safe. Once we made it safe, then we can outline, then we can begin to roll out many of the parts of the vision.
Another critical part of New York City, Ray, is the MTA, the subway. What is your understanding of the budget and the situation there? How dire are things right now, and how will you shore that up?
So let's be clear, the MTA is critical to how New York functions. At any given day, you have 4 million people who come into the city. They generate 59% of the retail revenue, and they take the income and then go into the boroughs. Many of them stay here. Many of them go into the boroughs. The MTA is critical to the vibrancy of New York. So the MTA must survive and it must thrive. One of the benefits to the federal program is that the federal program has given support to the MTA. We need for them to continue to give that support to the MTA. It's fundamental to the city.
I want to ask about some of the people that you're running against, because there's a bunch of them. Let's take Andrew Yang. He's a high-profile guy. How are you different or better than Andrew Yang?
I will say, I'm different to all of them. I'm different to everyone. I'm not a politician. Remember, on October the 15th, that I delayed it because I knew the reaction, I called my 94-year-old mother. I said, Mama, I quit my job. If you've ever had a conversation like that, she says, boy, you have lost your mind. What? I thought you had a good job, a good paying job. I said, Mama, yes. And I explained to her why I decided to do that. why I decided to do that. And so I'm doing this because I love this city, and it is the only opportunity that I see where we can make a difference for all New Yorkers, all the children out there, all of them, to be able to get an education so that they can experience the same thing that I experienced coming from the neighborhood. So that the teacher who's so vitally involved in their lives can have the same impact in their lives as they had in mine. So I will make that distinction. I don't owe anybody anything. I didn't get termed out. I'm not looking for a promotion. I haven't lost a race. I quit my job to do this. So I will say that's what distinguishes me from everybody else. I'm not like the rest of them.
Now, what about someone like Scott Stringer? You know, people like that are going to say, this guy, Ray McGuire, he doesn't know about government. Okay, sure. Okay, he's an outsider. Great. But you have to know about government to make this city work. How would you respond to that?
Well, I'm looking at a track record here of lots of years of knowing about government, and situations gotten worse. Situations gotten worse. I'd look at my track record of having successfully led and managed a big business with budgets that are sometimes bigger than state budgets. The business of New York is the business of New York. You have to manage New York with a set of skills that manages a business. And I get all the rhetoric, but I'm looking at the track record. Look at my track record in business. Look at my track record as a private citizen, and I'm prepared to put that track record of success, of tangible, demonstrable success, with promises filled with under-promising and over-performing, which is the only way that anybody who looks like me could have lasted in that job for 13 years. Nobody else in the history of Wall Street, longest in the history of Wall Street. I will put that track record up against anybody who's in this race and look at that track record and what I've accomplished, especially for Black and brown folks, relative to what's been accomplished by all the others. I'm prepared to put that track record up there. Look at the facts. So they say, look at the lily work. I'm prepared to have that lily work judged.
Just a couple
relative to all the rest of them. So I see what has gotten, I see what has resulted in all the people who can manage this. Situation's gotten worse. The divide has grown larger. What's that look? Where's that got us?
All right, we're going to have to leave it at that. Ray McGuire, candidate for New York City mayor and former Citigroup executive. Thank you so much for your time.
Thank you for having me, and let's go New York. The greatest comeback in the history of this great city. Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.